can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Or other authorities.
Could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Welcome back to the opening trade. Happy Friday. 20 minutes into the session. You're seeing modest upside coming through for European stocks, up 0.3%. US futures have turned as well into positive territory. Some data came through from China. It was welcomed by the markets. Then they gave up the gains, and the CSI 300 ended down about 0.3% because the headline number came in higher than expected in terms of inflation. That's what policymakers want to see. An increase of 0.5% higher than expected. But you lift the hood and you realise that it's not all that it necessarily seems when it comes to China's inflation trajectory. Let's get more then on this story with Bloomberg's Balazs Pence with the details. Balazs, what does this data then tell us about the current state of China's economy and whether or not consumers are feeling a little bit more optimistic?
Well, as you said, the whole name of the game in China is demand. And like you said, when the number first came in, it seemed very positive on the surface, CPI beating expectations finally. But when we drill down, we see that that was a result of food prices rising, which was almost entirely driven by the weather. It's been a very hot and wet summer in China. So when we look at the products that actually help us measure demand, like cars and consumer electronics, smartphones, and appliances, we see that those prices are actually still falling. And as we saw, core inflation is actually the slowest since January, and producer prices are still on a downward trajectory. So that suggests all of that put together tells us that demand still continues to struggle in China.
Right, so demand continues to struggle. And so how will policymakers respond, Balazs? We've seen the PBOC attempt to do things. We've seen plenaries take place where policy announcements were made, but market voices suggesting it wasn't enough. So what are policymakers thinking?
It certainly appears that Chinese consumers have so far been impervious to the stimulus efforts. It's widely expected that the response will come in both the monetary policy and the fiscal policy front. In monetary policy, it does look like the PBOC has more room to cut, especially if the Fed moves aggressively. There are some analysts who now expect as many as 3 more rate cuts in China. And there are other things they can do. There could be more immediate measures, like an adjustment in banks' reserve ratios. On the fiscal front, the government last week announced a 20-step program to encourage more spending, to encourage more consumer demand. Unfortunately, we don't yet have a lot in the way of details that tell us about the shape of that package or how the government intends to fund it.
So a question is, and this has been a question all year really, Balazs, as you know, is whether or not these measures are actually going to work, because we've heard the rhetoric from Chinese policymakers, we've heard and seen some of these steps being implemented, but so far he hasn't really moved the dial. What is the expectation from you, the team, investors, economists, as to whether or not these measures this time will actually make a difference?
Well, as the evidence shows us, it's really hard to move the needle on the short term. And so far, like you said, the measures that they have undertaken have not had a huge effect. Certainly, we do know that the government has stepped up borrowing, so they do have a healthy war chest if they do want to embark on more stimulus. And the conventional wisdom is that it will take something quite impressive to change consumer sentiment. But if that does happen, there is a chance that consumers will start spending more, opening up their wallets. For now, though, it looks like the gloom is here to stay.
Okay. Thanks so much. Thanks, Balazs. Bloomberg's Balazs Pens with the latest on the Chinese economy. Let's pivot from the Chinese economy to Chinese diplomacy, shall we? And soft power. And yes, we're back to talking about pandas again, a topic we have visited in the past, Tom. It seems that a new home has been created for some pandas coming from China, on loan, of course, as they all are. We've had that conversation before as well, at San Diego Zoo. I was interested in the detail that Ken Griffin and others at Citadel are partly responsible for funding this return.
Yeah, so we don't have a number from Citadel, or from anyone, in fact, from the zoo in San Diego, which, by the way, is a fantastic zoo if you ever get the chance to go. But he is apparently supporting this effort. So the diplomacy is important, of course, when it comes to pandas. You have to wonder how long they're actually going to be there, given the politics of the US and what happens after November, of course. I also have a question as to whether or not we should be spending all this money protecting pandas, frankly, because they're cute and cuddly, but as a creature, they're just pretty rubbish. So they have to eat 40 pounds of bamboo a day. Bamboo's only found in certain regions, of course, in Sichuan, around Chengdu. I've been there, I've seen them. They're lovely, but they don't do much for the ecosystem. They're very, very bad at breeding as well.
They are.
And if you spent more of that money on things like, let me give you some examples, the yellow-faced bee, ever heard of them? The Snake River salmon, they need our help, they're facing extinction.
You're making the point that we shouldn't just look after the cute and the cuddly.
Yeah,
is
exactly.
that the thing?
That's my campaign.
That's a serious point. Ken Griffin apparently does a lot for the conservation of Komodo dragons and iguanas as well. He has places named after him in the United States for conserving these creatures. So
okay, Griffin's doing his bit.
There we are.
Around conservation and panda diplomacy as well. They're the pics. You can't get too many pics of the pandas.
You can for Tom, apparently.
Even if they do need to be just.
Yes. Careful how you end that sentence. Coming up, it was a bumpy start to the Olympics. We'll look at the major sporting moments, of course, and what will be the legacy of the Paris Games. We have the closing ceremony taking place this weekend. We're not quite done with the action. What on earth will I be watching in the late afternoon after European markets close after this week? All I've been doing is watching the Olympics. So we will talk about the au revoir in Paris to the Olympics, and we'll see where the city has benefited, what it has gained. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
This is the opening trade. We are 30 minutes into the Friday session. European stocks currently up 0.3%. And here's some good news. If you are on Wall Street or invested in an investment bank, or working in an investment bank, I should say, because Wall Street bonuses, according to our reporting, set to jump by as much as 35% this year. And bankers who help companies sell debt expected to see the biggest payouts. They could swell bonuses by as much as 35% if you've been involved in underwriting deals in the debt markets. In terms of equity underwriters, they could see gains of about 30%. But across the board, bonuses are expected to jump. Barclays as well, also making some moves after we removed the cap here. The government did, at least,
in the UK.
In terms of bonus caps here.
Yeah, so that data on Wall Street coming from Johnson Associates, and they're talking about that possible 35% pop. And you're right, it's different in different sectors, but they talk about debt underwriting. Also, equity market M&A, if we are going to go back to that, we were talking about private equity with dry powder and wanting to get deal flow moving again. So we'll see whether that comes to pass, especially if rates drop a little bit. But on the UK side of things as well, yes, this Barclays move follows others in the sector, doesn't it? And it's a year ago since we got the then Conservative government removing the cap. It was a European Union legacy policy. They removed it, and the Labour Party said at the time they wouldn't oppose that or stand in the way of it, or reverse it, rather. Once they came into power, they did come into power, and so no sign that that changes. So now we could see bonuses at Barclays going to 10 times earnings for some risk takers, a very narrowly defined group of people, I think. So we could see that. Of course, that won't be the case for most people at Barclays, but that is what we're learning about the bonus story.
Yeah, potentially 10 times, as you say, base salary for those at Barclays within that category. Goldman Sachs, JP Morgan, as you say, also removing that cap on bonuses.
OK, let's talk about the Olympics a little, shall we? 8:31 here in London, 9:31 in Paris, and the Paris Olympics wraps up on Sunday, which has been globally seen as quite a success, with spectators enjoying iconic open-air competition venues at the Eiffel Tower, Versailles, and along the banks of the Seine. But after the Games, what will be the legacy for Paris? Time to start thinking about that a little. Let's bring in Bloomberg's Benoit Berthelot, who is in Paris for us, has been enjoying the Games. Maybe not. Maybe it's not your favourite thing, Benoit. How good has it been for Paris, though? How much benefit has it brought to Paris?
I did enjoy it a lot. I've seen many of the games. And it's been great for Paris. Look, people have been a bit skeptical about the games beforehand because they were told it would be difficult to move around. There could be security issues, etc. None of that happened. Quite the contrary. Like it's been good for the city in terms of security, transports. So far, some Parisians left the city and are now coming back to enjoy the rest of the games because they don't want to miss out the party. And of course, many visitors from around the world have been here, sort of replacing the usual tourists coming to Paris during the summer. So all in all, it's not a massive increase of people coming, but it's different tourists spending more as well on these Olympics. But obviously the mood is great in France right now. It's been a few months of very difficult political issues that are now sort of on pause during the Games.
Yeah, the mood, and everyone I know who's been there has said that the mood is fantastic on the streets and around the venues as well. Benoit, what do we know about the impact on business then, business in Paris, business in France, and the global sponsorship element of that? What do we know about the economic impacts of this?
Yeah, so of course it's a bit early as the games are wrapping up on Sunday, but it's been known for every game that during the event, of course, there is some business that are doing very well because they are clearly benefiting from the games. Other ones are sort of blocked from their business as usual. But the data we have, for example, from Visa, who is a partner of the game, they saw 26% of increase of sales for the small businesses in Paris. And there are many sponsors who are hoping to benefit from the games. For example, LVMH, probably the biggest of them, spent 150 million euros on the games, and they certainly wanted to make the most of this sponsorship, were showcased in the opening ceremony quite heavily, are spending a lot of ads, etc. So these types of companies certainly want to see a longer impact of the game. Now, there are others like Airbnb, who just saw mixed results globally. So it's sort of an investment for these companies. They are hoping that more people will come to Paris in the following months and years. Same for example, Disneyland in Paris. Disneyland has said that the games sort of disrupted the normal interest in their parks, but it's sort of a longer term impact that could be expected.
Yes, you certainly, the closer you looked, the more you saw LVMH, for example, in different parts of the games, like the medal ceremonies, for example, and I just see orange shoes everywhere. I mean, this is also one of the marketing pushes, perhaps, at this games from those makers. Let me ask you about the legacy of the games, then, Benoit. Let's get to that, because I mean, back in 2012 in London, this was a big conversation, even satirized in comedy shows. The legacy of the games, what would it deliver? What is the thinking in Paris about how long-lasting positive impact will be?
So the Paris tried to do lower-cost games, right, with all these venues that are temporary, that were in the heart of the city. Few stadiums have been built. Only one small stadium and a swimming pool. So it's mainly two areas that have been built for the Olympic Village and some other installations. That's going to be a new housing in these sort of newly developed areas of Paris. And then there were many improvements in the transport system, for example, that have just been ready for the games and that people are going to enjoy afterwards. The biking lanes, etc., are also post-COVID new features of Paris. And then there is the Seine River. Paris invested a lot in improving the quality of the Seine. It's just been ready for the games. In the end, they were able to swim in the Seine, but that's going to be a benefit for the city for the years to come as well, people hope.
Okay, yes, they were able to swim in the Seine, not always on the days they had planned, but anyway, it happened. Benoit, thank you very much. Benoit Berthelot in Paris for us. Let's turn to, in fact, I should tell you that coming up next hour, we'll be speaking to the Amazon Web Services EMEA Managing Director about that company's involvement in the Olympics. So keeping with that Olympic theme, that's at 9:40 a.m. London time. Let's get to then, Tom, some of the movers that we have on markets this morning. Yep. It's not a day for many individual standout stories, but we certainly have some M&A in the markets, and Hargreaves Lansdown is one of those. We see CVC and Adia agreeing to buy Hargreaves Lansdown in a £5.4 billion deal. The stock is up by 2.2%, we see, as a result. That's the move that we're seeing in this private equity suitors coming after this UK investment platform.
Yeah, and in the semiconductor space as well. So tech getting a bit of a lift in Europe today, and you can link that back to TSMC because the contract manufacturer of semiconductors came out with sales numbers earlier in the day. Those numbers in the month of July growing 45%, and the company saying that was largely down to continued strong demand for those AI chips. So companies linked to TSMC, like ASML, getting a bit of a lift this morning, quite modest, but up 0.6%. Of course, that company provides much of the hardware that TSMC needs to churn out those chips. And ASM International, ASMI, also in the Netherlands, gaining as well in the session, 1.8%. So the tech and the chip makers here in Europe getting a bit of a lift on the back of those numbers coming through from TSMC.
Yeah, so that's tech. The read across from the NASDAQ and the TSMC story, as you say. Let's talk about Generali in the insurance space. A second quarter profit drop, 24% from a year earlier. Claims from storms and flooding in Europe are the negatives. Those are the things that weighed on the numbers. So as a result, you see the stock is down by 1.7%. The CEO says that he's focusing on insurance segments with high margins as he's seeking to follow through on a pledge to achieve annual earnings per share growth of 6 to 8% in 21 to 24.
From insurers then to groceries, takeaways, Just Eat is up, as you can see, 4.4%. One of the top gainers, in fact, of the session after an upgrade from Morgan Stanley, raising their view on Just Eat to overweight, raising their recommendation to overweight. They set a price target of 129, so it looks like an increase of about 24% from the last price. And investors welcoming that upgrade coming through from Morgan Stanley on Just Eat takeaway. Coming up, Donald Trump and Kamala Harris. Well, they finally agreed to debate. It's taken a bit of wrangling as the Republican, of course, is looking to shift the race for the White House after arguably Kamala Harris has hogged the limelight over the last week or so, and Trump has tried to reset that, and they're agreeing on this debate as well. The details on all of that next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
Okay, you can read more of our Big Take story on swing states online at Bloomberg.com or, of course, on your Bloomberg terminal. Now, Republican presidential nominee Donald Trump has agreed to debate Democratic rival Kamala Harris in September. Speaking with reporters at Mar-a-Lago, Trump criticized Harris for avoiding media interviews since securing that nomination.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
Okay, and that was Kamala Harris speaking on the question of that debate and saying she would agree to it. Still waiting, of course, for the final details as to where that lands, but we are reporting that the Democrats and the team around Kamala Harris have refused, at least ruled out, that debate taking place on Fox. Let's get more on this story and how the politics has evolved, as it does rapidly in the US right now, with our senior writer at Bloomberg, Stephanie Baker, who keeps, of course, a firm and close eye on all things US politics. So Harris and Walz pulling in these huge crowds, and our team on the ground who have been attending them saying that they do compare to the kind of rallies that you see and the kind of enthusiasms you see from Trump rallies. Certainly a long way from what Biden was pulling in terms of the attendance, the enthusiasm. You have celebrities on stage as well in the warm-up acts. Is this sustainable, do you think?
Yeah, it's really interesting because people are now comparing the kind of crowds that she's pulling in to the enthusiasm behind Obama in 2008, that we haven't actually seen this kind of energy in the Democratic Party for over a decade, almost 2 decades even. So I think that it's a question, can she keep this up? Obviously, you win elections not just by enthusiasm and energy on the campaign trail, but at the ballot box. So, you know, the crowd size, you know, doesn't matter that much at the end of the day. So I think it's important to still keep an eye on the polls.
Yeah, it reminds me of when you go to party conferences in the UK and people say, well, it went down really well in the room. And you think, well, of course, it goes down really well in the room, but it's how it goes down in other places that maybe matters more. Critics then complain that Harris has avoided interviews. We just saw her taking a few questions on the tarmac there. Is this a valid concern? Is she not answering questions that people have as frequently as you would expect somebody to in this position?
Yeah, well, the Harris camp response to that is that she's only been the nominee for 2 weeks, and she's had a very busy schedule. She had to pick a VP. She had to, you know, plan for the convention and plan to introduce, you know, Walz to the nation, and that she will be giving interviews in due time. So we'll wait to expect that, you know, in the coming weeks, perhaps after the debate. I'm not sure, you know, maybe before. I think the real question is, you know, how does she perform when under pressure on the big policy issues? Can she keep up that kind of momentum that she has on the stump? She gives great speeches at these rallies. She's really able to kind of, you know, rile up the crowd behind her. Can she withstand the pressure under scrutiny?
And we'll get a better sense, I would assume, of that question when they do this debate, and it's been agreed. So September the 10th is the debate time, and we've obviously been reminded this year of just how crucial those debates can be. What is your thinking around that and how that could evolve, how consequential that could be?
Well, you know, the political roller coaster that we've been on for the past month has just taken everyone by surprise with twists and turns that no one could have predicted. The debate is obviously very consequential, could be as consequential as the debate between Biden and Trump that upended the race. I think Harris feels confident and has been demanding Trump agree to this debate. Trump finally did, in fact, agree to it. Is he able to stick to the script, or does he go off into meanderings like we saw at the press conference last night and attack her in a nasty way that backfires on him? That's the thing to watch.
Yes, and talking of that press conference yesterday, what did you take away from that? From the market's perspective, a lot of focus on things he said about the Fed and how he should have, other presidents, but also just him, how he should have more of a say on what interest rate policy looks like in the US. But away from, I mean, is that what you took away, Stephanie, or were there other things to watch?
It was so meandering, and he lied so many times, everything from, boasting. He seemed obsessed with his crowd size, and I think that the crowds that Harris has been able to pull out seems to have really rattled him.
And that goes right back to when he was first inaugurated, doesn't he? That was a big debate.
Exactly.
The size of the crowd that attended that.
And the most incredible thing is when he compared his January 6th crowd size to Martin Luther King's I Have a Dream speech, which people thought was really, beyond the pale. I think some critics are saying that the sign that he called this press conference is, the best signifier that he is really rattled by the Harris campaign and wants to try to regain the limelight and feels comfortable giving these sort of meandering press conferences as a way of, regaining attention.
Stephanie,
at 4 a.m. Eastern Time, we get our Italian HICP final year-on-year number. Forecast of 1.7% on the prior 1.7%.
A little bit, given the volatility we've seen in markets over the past week, not driven by US politics. Maybe we leave that for the run-up to November. Plenty of time for that, of course. With thinking about that volatility in markets, the Monday mayhem, the Tuesday turnaround, Wednesday's whipsaw, what was Thursday? I've forgotten what Thursday was. Turnaround Thursday, takeoff Thursday.
Takeoff Thursday.
I think that was it, yes. And maybe a flat Friday is appropriate. Certainly looks like it for this hour of the day, although it is very early in the States. But US futures are pretty flat. We're through some of the big data points of the week, so we will keep an eye on those though as we get closer to the US session. Bloomberg's Connor Cooper joins us on set with thoughts on the week that was, and what a week it has been. Connor, nice to see you.
Nice to see you.
Market volatility then, Monday we had lots of it, and the VIX took off to levels that seemed kind of crazy compared to other periods of risk in the last 20, 30 years for US markets. What did you make of the volatility story?
Yeah, it's sort of a whole month's worth of action crammed into one day. I don't think we'll see many days like Monday again. What I do think we will see, though, is... sorry.
That's okay. Go ahead.
What we are going to see is that move's going to be sort of spread out. The direction of the move is probably going to continue again. We saw, because the reason the move happened, the three reasons... Sorry, I'm feeling a bit unwell.
Okay.
So
we can maybe cut it short.
Take a breather. Yeah, it has been a big week. But
it's been a big week.
It's been really challenging, and you've gone through, of course, this week, Anna, for us in terms of just how things have adjusted on the equities front and fixed income as well, and the turnaround, and now the adjustments in terms of the views around the Federal Reserve. And we'll get a better steer of that, of course, next week when we get that inflation data out of the US. It's going to be really consequential. The retail sales number as well out of the US in terms of what the consumer is doing stateside and how much strength they still have. And here in the UK as well, inflation out of the UK. So it's not going to be a quiet week next week either. Unlikely to replicate the kind of moves we've seen this week in terms of those spikes around volatility. But again, consequential in terms of getting more clarity, we hope, in terms of where these central banks go from here and how markets adjust.
Yes, absolutely. In terms of what we're looking at next week, you've been through some of these topics. We've got the inflation prints on both sides of the Atlantic, as you say. CPI in the United States will no doubt be in focus. We had that labour market data that shook confidence on Friday. And then yesterday we rediscovered some confidence thanks to a week of jobless claims.
So we're seeing here, according to the Energy Ministry, Azerbaijan exported 14.1 million tons of oil in January to July,
Head fake. We overdid concerns about the US economy,
with Azerbaijan exporting 7.5 trillion.
What led us into this whipsawing that we've seen. But then it's not only in the US we'll get the data. The UK will have inflation data here as well, and the wage story. The inflation data will be interesting because it will tick up. That is the expectation, and a lot of that is due to fuel prices, and it's a sort of base effect of fuel prices, but it's services inflation that really matters more. So yeah, we'll be looking for clues for the BOE there.
And the tension has been there at the MPC, hasn't it, between the Hawks and the
And so that is Azerbaijan exported 7.5 trillion BCM of natural gas to Europe in January to July.
Will stronger inflation data out of the UK lead to a question mark as to how aggressively the BOE can go from here? You were talking about the head fake line from our UBS guest. We were hearing from our Goldman Sachs guest as well in terms of the historical perspective when it comes to the start of these rate cut cycles from the Federal Reserve and what that means for small caps. And he was quoting a number. Historically, you see gains, I think, over a 12-month period when the cuts start for small caps of between 14 and 15%. UBS and their CIO of Wealth saying that if you look historically, you see gains for the S&P of about 17% historically after the start of cuts. And that's why at UBS they remain constructive on these markets.
Yes, they were saying 3 months, 6 months, 12 months. It all looks favourable for stocks when you see these bouts of volatility. So we've had a lot of debate then about the US economy and whether those cracks really are taking us to a hard landing or whether a soft landing is still in store. Let us recap what we've heard from some of our guests talking about the possibility of a recession in the US.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit...
And so it's less than 5 minutes away now until we get our Italian HICP final year-on-year number, forecast of 1.7% on the prior 1.7%.
Giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along and we probably won't see a recession.
Some of our guests there talking about the possibility of US recession. Interesting then, Tom, that we had comments there from European corporates like Siemens saying emphasis on the resilience. I should also point out for viewers who are wondering about Connor, he's okay. He's gone back to his desk. So Connor Cooper, who we brought on briefly, is okay. But that's the story then out of the US economy from the European corporates right now. They put the emphasis on resilience.
Yeah, and the sense is, again, look, don't write off this US economy. And again, from Goldman Sachs Asset Management, our guest earlier saying, look, even if you move lower in terms of growth for this year from 1.5% to 1%, you're still getting decent growth. The jobless claims yesterday, of course, led to the market rally that we saw with the S&P notching gains that we haven't seen the biggest pop since November 2022 because the jobless claims were slightly lower than the estimates. So again, the labour market, yes, it's seen a few cracks, but a number of our guests have said there is still that resilience there. You're not close to that recession, even if, of course, JP Morgan, Goldman Sachs have increased their odds, their chances of a US recession. It's still not the base case.
Okay, so that's not the base case. In terms of the movers then today, we've got some upside in Hargreaves Lansdown, private equity coming in for that business. Of course, we've seen that have an impact up by 2%. The tech sector in focus as well, Tom?
TSMC coming out, of course, over in Taiwan, but there's the tie to the European players, the providers of equipment, of course, to that contract chip manufacturer. They came out with some really decent sales numbers suggesting that demand for generative AI is still there. So the likes of ASML and ASMI over in the Netherlands are getting a lift on the back of that story.
Okay, those are the movers then this morning, this Friday. US futures flat, yes, but a little bit more positive than they were. So we'll keep an eye on those as we bring this incredibly busy week to a close. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European Trading Day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
From the beating heart of global finance, economics, and
Just less than
politics,
moments away now.
and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg
10 seconds.
covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
One spot 6%, 1.6% lower than the forecast of 1.7%.
Independence Donald Trump says presidents should have some say over interest rates and monetary policy, while he and Kamala Harris agreed to debate in September. European stocks are higher after encouraging data on the U.S. labor market. That's after the S&P actually notched its biggest rally since November 2022. Plus, the billionaire owner of e-commerce giant Temu becomes China's richest person. So good morning, everyone. Happy Friday. We've just about made it through the week. It was a pretty tumultuous week. So let's take a look at what the European markets are doing. Overall, we're seeing a little bit of gains across the board. Again, it's been up and down since that big Monday sell-off. For the moment, the CAC 40 gaining some 0.6%. The DAX gaining 0.4%. Again, if you look at U.S. equity futures, they've actually erased earlier gains. The S&P notched its best daily advance since November 22 yesterday. This is a picture overall. We look at yen 147.28. I have to say, if you look at the global stocks rally, it does seem to be losing a little bit of momentum. The yen resuming its rise earlier on, stoking, of course, renewed worries about the unwind of the carry trade after this nascent recovery that we saw over the last couple of days has also been driven by signs of resilience in the U.S. labor market. We also look at Brent 79.14. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. The Republican presidential nominee Donald Trump says the president should have some say over U.S. interest rates and
Thank you very
monetary
much.
policy.
Appreciate
Now, such a move would go against the long-standing practice of keeping the Fed independent from political actors. Now, Trump has repeatedly complained about the issue and criticized Chair Jay Powell for being both too early and too late on moving interest rates.
I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Let's bring in Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, thank you so much for joining us. I remember, all of these memories about, Donald Trump calling the most valuable player, improved player, and Jay Powell, you appointed him, but then are we going to see that again if he's president? And are we actually talking about the central bank possibly losing independence?
Well, this was reported a little while ago as well, that Fed independence could be challenged in a Trump administration. And then markets got nervous, but then it then moved on to the other kind of drivers. So I think there is a risk of that as we think about kind of scenarios that could play out. And I also think that plays to kind of what investors ought to demand for holding government bonds in portfolios, because if we're talking about this being in question, then term premium needs to increase, and term premium anyway needs to increase to reflect the steeper fiscal trajectory that is going to kind of be the reality that we're looking at, no matter who gets in the White House. So all of that goes to show that we need to think about portfolio construction around treasuries more carefully going forward.
And I mean, what's also crazy when you think about it is actually the debt is not part of this conversation. And I know last time we had in the UK the Liz Truss government going after central bank independence, and then there was that disastrous budget. Could we have a perfect storm where actually an auction goes badly in the US?
Well, nothing is kind of ruled out completely, I would say. And if we look at, yes, you talked about auctions, the 10-year auction this week, the 30-year auction, both saw a bit of a tepid demand, and we saw yields kind of higher than what was expected as logged in the auction. I would say, though, there are so many other factors at play. We need to think of it as a whole portfolio. So whilst the demand for long end of the curve may not be as strong because of the considerations that we just talked about, the demand for income is still firmly in place. And we have seen one of the biggest inflow weeks into fixed income products, especially in the middle of all this volatility. So income is back, and there is a place for front end of the curve, value of the curve. And look at credit. Credit has held up incredibly well in the middle of all this summer volatility and summer market correction. So I think we need to kind of think about fixed income in a differentiated way. Term premium for long end treasury needs to go higher, but it doesn't mean that it has to be a perfect storm for fixed income.
So what's your take? I mean, what a week we've had, right? We started Monday, and it was a confluence of things, and we thought we'd be stabilizing a little bit. Then we've gone off the day's highs, I think, yesterday. Are we going to see these bouts of volatility being built in more into the system?
Well, I think if you ask me, or if you tell me on Monday that we're going to see U.S. equities closing the week almost flat, I would have thought, well, how is that going to happen? And here we are. So I think summer anyway generally is accompanied by lighter liquidity, and this together with worries around recession, labor market, worries around Bank of Japan losing the plot with their policy normalization really exacerbated the technical side of things. But I think especially at times like this, it's important to look at is the fundamental picture really changing. You look at earnings. Earnings are actually coming in really strong. Q2 earning U.S. equity market were tracking 14% year-on-year growth versus 9% expected at the beginning of the quarter, at the beginning of the reporting season. And even for the non-tech part of the U.S. equity market, expectation was for them to grow 2% year-on-year, and now we're tracking 5%. For tech, expectation was for them to grow 18%. We're tracking 20%. So earnings are coming in quite strong, but it's easy to forget that when we're talking about market volatilities like what we have seen so far this week.
I mean, partly, of course, it's the carry trade. Partly is expectations about a recession in the U.S. Have you changed your expectations at all?
No, not around kind of a recession. I think growth is slowing down. That is required to cool down inflation. So that is always in our kind of economic forecast. But we're not forecasting a recession, and we're certainly not forecasting a recession because of the sign rule, because of the rise in unemployment rate, because the unemployment rise can be explained this time by really labor force, labor supply increasing. Since 1970s, the sign rule hasn't been triggered without employment falling within 1 month of the rule being triggered. This is not what we're expecting. This is not the environment that we're in right now. If you look at what triggered the recession fear last week, is the manufacturing print, is the NFP print. But since then, that has given way to a more benign reading of the SLOOS, the Senior Loan Officer Opinion Survey, service strength, as well as the jobless claim yesterday that came in better than expected. So I think it's easy to get quite nervous in the middle of summer in this air pocket, but the fundamental picture hasn't gotten worse, and that's why we reiterated our overweight in U.S. equities in the middle of this market volatility.
So have you changed any of the weightings when you're building portfolios?
Not right now. Not right now. We continue to like tech. We're looking at NVIDIA reporting on the 28th of August. We're also continuing to be positive on U.S. equities. Japanese equities on a currency hedged basis. We have the conviction. I would note that currency, well, actually on a currency unhedged basis, we continue to have the conviction. I would say that currency play, currency overlay has helped our Japan core in the middle of this yen-driven equity correction. Even in the middle of Monday's volatility, MSCI dollar currency unhedged Japan equity was just down 8% from the peak, right? So there is a bit of an auto hedging component, and we see domestic earnings recovery story continuing as well, which is why we reiterated our conviction.
Wei, thank you so much. Wei Li from BlackRock, of course, stays with us. We'll talk a little bit also about China and some of the other things that we could see in portfolio building in Europe. Now, coming up, Chinese stocks rise after inflation increased more than expected. So we take a look at the world's second biggest economy next. And this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Welcome back, everyone. Now, investors still concerned about sluggish demand in China, despite inflation in the world's second largest economy increasing more than expected last month. Now, Wei Li from BlackRock is still with us. Also joining us, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So, Wei, thank you so much for staying with us. Gina, welcome to the Pulse. I mean, there's been so much going on in terms of U.S. equities. What have you been hearing from people on the ground? Is now a good buying time, or are we buying the dip, Gina?
Yeah, there's a lot of nervousness still around the US recession and what the Fed may do about it. And I think that this is a particularly complicated time for US equity investors because a lot of what's happening in US equity markets is actually being driven by policy and not necessarily just US policy, but Bank of Japan policy in particular. If you go back to the middle of July when US stocks peaked and when the broader global equity markets peak, that peak was clearly manifest through a shift in direction from the yen and then exacerbated when the Bank of Japan started tightening for the first time in 2 decades just last week. So the Fed is really playing a big role here and not necessarily a very traditional role with respect to U.S. conditions, because as the Fed tries to potentially fight off recession in the U.S., they may have unintended consequences of exacerbating the Japan carry trade that's been unwinding and creating a lot of distortions in U.S. equity markets as well as global equities. So that's really what people are very concerned about, is how much of the recent weakness is really related to U.S. weakness versus just weakness with respect to this carry trade unwind, and how is the Fed going to approach the markets going forward?
Wei, how difficult is it actually to see how much of the carry trade has already been unwound? I think I saw we're 65% there, we're 70% there. Could it be more?
It's very hard to size the quantum of carry given the OTC nature of some of those hedging instruments. But I have also seen reports of, we're halfway through, we're 3/4 through. I think the expectation shouldn't be that we're going to go all the way to everything getting unwound. We're still talking about rate differentials between US and Japan. An interesting chart I was paying attention to was to look at the real rate differentials between US 10-year and Japan JGB 10-year and how dollar yen has been tracking. There was a disconnect that opened up 1 month ago, and now that is largely kind of closed. So looking at all of that, I think it's fair to say that maybe the worst of the carry unwind is behind us rather than in front of us, especially in the context of Bank of Japan actually walking back from their more hawkish than expected policy normalization stance. Last week, for them to introduce currency as a consideration in their policy making is highly unusual, which is why they saw what happened to global markets through carry dynamics this week. They then came out to say that, well, if there are worries in financial and capital markets, they are not going to hike rates. So that's I think that's as close as we can get from them in terms of admitting maybe last week was a bit of a mistake. They are walking back from that, which is why markets are cooling down a little bit right now.
And Gina, I wanted to ask you about, and Wei afterwards, China's consumer inflation is picking up. There's longer-term demands, or longer-term concerns about, of course, demand. But given we're in a U.S. election cycle, I mean, do you have two scenarios depending on who gets into the White House, Gina, and what happens to U.S. equities?
Yeah, I think that the most important thing is to consider the mix, not just the White House, but also what's going to happen in Congress, because that will be very, very meaningful to determine what happens with the policies toward tax as well as trade. Tax and trade really are the two major levers by which policymakers in Washington, outside of the Fed, can impact equities. And on both counts, both the Republican candidate as well as the Democratic candidate are likely to be somewhat tough on China. I mean, it has not changed materially over the course of the last 4 years. There has still been one big trade impacting the equity markets, and that is the China versus U.S. tech trade. What's happening with that trade has been very persistently underlying a lot of kind of global equity volatility in the semiconductors as well as broader tech space. I don't think that's likely to change. The thing that could change is really trade policy at large. Will we move back into more of a Trump regime that is more tariff related with respect to trades? We noticed in 2018 clearly an elevated degree of volatility in export and import oriented industries related to the trade policies of the Trump administration. So that's something to watch for, certainly. But an even bigger impactor of stocks, frankly, is really what happens with tax. And on this, I think there's a lot of really interesting, compelling opportunities. Both the Trump administration and the Harris administration are likely to pursue policies that are quite different on tax, but they will require commitment from Congress and collaboration with Congress in order to pass some sort of tax policy, and that's really going to be key. So I think that we do want to watch this pretty carefully. Very difficult to price any of this in until the election itself, when we get a sense of not only who's in the White House, but who's in U.S. Congress as well.
And Wei, what's your take, away from this, but also linked to this, on China's economy seems to be battling deflationary pressures. We know about intense price wars. So what does it mean for, again, investment strategy into China?
We have seen today the inflation print coming in a little bit better than expected, but we're still talking about deflationary PPI, right? And that has been plaguing the economy for a while. We have seen the plenum, the State Council, the Politburo came and went. There were some efforts to support the economy. We have seen surprise rate cuts from PBOC, but this is not the bazooka. So structural kind of concern weighing on Chinese longer-term growth, such as aging population, such as the need for reform, they still very much apply. So maybe in response to kind of the near-term effort to support the economy, we see a bit of a tactical bounce, but the longer-term concerns still very much hold, which is why we're neutral China right now.
Wait, are you into the Olympics? I mean, you won 2 Olympic medals at the Olympics in mathematics, right?
In the wrong events. In the not so cool events.
I'm a little bit obsessed with the Olympics. I mean, whoever knew that actually France could play basketball? That was my big takeaway. Oh. Gina, Wei, thank you both for joining us. Wei Li from BlackRock and Gina Martin-Adams from Bloomberg Intelligence. Coming up, Kamala Harris and Donald Trump agree a date for their first presidential debate as the 2 election heavyweights look to land the first blow. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
Now you can read more of our big take story on swing states online at Bloomberg.com or on your Bloomberg terminal. Now staying with the U.S. election, and Donald Trump and Kamala Harris have agreed to hold their first presidential debate on the 10th of September. Now the two rival candidates will have their first face-to-face clash on ABC News, with Trump confident that he'll hold the upper hand.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
Kamala Harris also spoke with reporters about the debates.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it, and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
Well, Stephanie Baker now joins us, who's Bloomberg senior investigations reporter. Also, I would add, with the new book out, so we're counting down the days to that. But so much has happened, I mean, I would say in the last week, actually, since she picked her vice president. How do we assess how it's doing in every state, and how their strategies will change, both on the Democratic but also Republican side?
Yeah, the past month has been just a political roller coaster ride filled with twists and turns that no one could have predicted. So I think the next month could, equally have changes that, we're not seeing right now. I think for political junkies, they look at something called the Cook Political Report, which put states like Arizona, Georgia, and Nevada, which were previously leaning towards Trump, into play, saying that they're up for grabs now, which I think shows the kind of momentum that the Harris campaign has managed to get in just 2 weeks. I think there's a lot of energy and enthusiasm with the kind of crowds that Harris is pulling. She's in Arizona today for another rally with Walz, introducing him to another crucial swing state. And I think we'll see how the campaign unfolds, and I think the debate is obviously going to be a huge turning point.
I mean, does the Trump camp do things differently? Are they still on the attack, or will they have to regroup and find a better strategy?
Well, the interesting thing is that Trump had very little planned over the next couple weeks. He's at a rally in Montana, not exactly a swing state. So I think it looks like he's concerned enough about Harris's momentum that he needs to go on the offensive, which is part of the reason why he did finally agree to this debate on September 10th and gave this press conference yesterday. He, is going to be attacking her. He's, threw out these insults, questioning her intelligence and her competence. And I think, he's going to try to land these attacks on her running mate, Walz, as, a liberal lefty, which I think is going to be a hard thing to do, given the way he presents himself as the sort of high school teacher, football coach, all-American Midwesterner.
Stephanie, thank you so much. Stephanie Baker, there, our senior investigations reporter. Up next, more on politics.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities
could face bigger challenges. Listens next.
It was going to keep bringing World Cup.
This is a 3 as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to debate September 10th. European stocks higher after encouraging data on U.S. labor markets. Well, that's after the S&P actually notched its biggest rally since November 2022. Plus, the billionaire owner of e-commerce giant Temu becomes China's richest person. So JP Morgan now sees a 35% chance of the U.S. economy tipping into recession by the end of the year, up 10 percentage points. Meanwhile, the Goldman Sachs chief executive, David Solomon, predicts that the U.S. will avoid a recession, and Bank of America's chief economist has said the market is overblowing the risks. Now, let's discuss all of this with Michael Spence, Nobel laureate and, of course, senior advisor at General Atlantic, amongst other titles. Michael, thank you so much for joining us. We had quite a stark awakening this week because of the carry trade. It's nice to have you because of what we're seeing with possibility of a U.S. recession. How would you describe the health of the U.S. economy right now?
I tend to agree with the people, Francine, that fundamentally the American economy is both absolutely and relative to other places really quite healthy. There's some signs of weakness, but basically it's proving to be remarkably resilient, and some of the shocks that are being delivered elsewhere, we're really not very vulnerable, energy and that kind of thing. So I'm fundamentally cautiously optimistic that we'll continue to grow. Now, there are negative factors affecting not just the U.S. economy that, mean that our growth is slower. Productivity growth is not yet rebounded, and that kind of thing. But that doesn't tip you into recession. That just constrains the growth going forward.
Do you worry about the labor market, Michael? I mean, this is one of the biggest concerns. On Friday, we saw a bit of disappointment. This comes on the back of, again, stronger productivity, much stronger U.S. economy. And if the labor market gives, whilst, is that on the back of a significant tightening in a short amount of space, or is it a cycle?
No, I don't think it's a cycle. I mean, I think, this is a kind of high wire act that the central banks are trying to, navigate, right? So there's no question that by raising interest rates and trying to bring them down at a measured pace, they're trying to engineer a kind of controlled reduction in aggregate demand sufficient to take away some of the initial or inflationary pressures that resulted from excess demand. And so far, I think they're, doing a pretty good job in a pretty complex environment. If somehow, that high wire act gets out of balance, then you could see a drop in aggregate demand and some weakness in the labor market. But so far, the movements that we've seen, including, a lower, aggregate new employment figure last week, or I think it was at the end of last week. I don't think this is a sign that they've kind of missed the mark. The market volatility, I tend to discount. These are not signs that there's some fundamental problem lurking in the near future.
I mean, you did some wonderful research on markets and the labor markets that they gave you a Nobel Prize for it. Are you comfortable that actually the way the market is working or the market function is doing okay right now? Or are there spots in the markets that we should be worried about?
Well, on a slightly longer term time horizon, Francine, there's if it's true, and I'm one of the people who believe it's true, that we're in a period of very rapid structural change, driven by technology and shifts in the way the global economy works. That means there's a lot of moving around, job change, different skills, and so on, and those things are lurking in the background, and so it's easy to see that we'll get places where there are labor shortages, places where the skills aren't, the ones that are consistent with what business and the demand side wants, and so on. So I don't discount that at all. I mean, this is going to be a pretty turbulent period for the rest of the decade. But on the kind of short run, fundamentals that the central banks deal with, I haven't seen anything yet that's particularly worrying.
I know you've written extensively about the AI economic revolution and how that changes productivity and how that changes also some of our models. Are we underestimating or overestimating how quickly that AI revolution comes?
I would say we're overestimating how quickly it comes. It's a sort of natural tendency that we've seen before. So, that once people realize what the potential is, then there's enormous enthusiasm. It's reflected in investment levels that are just enormous right now, in asset prices and valuations and so on. But history sort of teaches us, I mean, this may occur a little faster than, previous episodes of digital adoption, for example. But the fundamentals are, it takes very big changes in business models, individual behavior, skills, learning, experimentation and all that kind of thing that, so I don't expect AI to produce noticeable shifts in the productivity trajectory of the U.S. economy for a few years yet. I mean, data tends to lag, but I would say end of the decade, if we're not seeing it, then I think the predictions that people like me have made that it has the potential to produce a productivity surge will start to get questioned. Because that's long enough to engineer these changes that are needed.
But Michael, at the same time, we're seeing more and more crises, and it seems that the rate of developing these crises and them lasting is exponentially higher than it was 10, 15 years ago. You actually wrote a book about this with Mohamed El-Erian and Gordon Brown called Permacrisis, a plan to fix a fractured world. Are we dealing with too many crises at the same time?
Well, it would be nice if we didn't have them, but yes, we are. And as a result of that, the global economy is being reconstructed architecturally in a really quite different way. I mean, you can, you at almost every level, business, supply chains, etc., you can see this pattern of diversification. I mean, I just recently learned that the Chinese entrepreneurs are busy diversifying their operations because they're good at what they do in the manufacturing sector into a whole range of other, developing countries where they're hopeful that they can not only achieve, high productivity, high growth, but to some extent, evade the sanctions that and other, fragmentary blockages that are a feature of the global economy now. So it's just it's a different world. It is driving quite a lot of structural change. It's a more complicated world, and it's a riskier one than what we were used to before. But what Gordon and Mohammed and I feel is it's pretty much inevitable. It's hard to see that climate shocks, wars, potential pandemics, and other things are simply just going to vanish in the next little while. So I think what investors and business people are busy adjusting to what amounts to a new reality, for instance.
But is this exacerbated, or is this because of divisive politics? We have the U.S. election coming up, probably the most important in the world. Who's looking at, who's thinking about the right way of fixing the economy?
Well, it's very hard to think of a way to kind of fix the global economy in terms of levels of cooperation where it really matters. If the political underpinnings are at the domestic level, in wherever, in Europe, in the United States, et cetera, in China, are heading off in a different direction. I mean, from an external, Americans are consumed by the upcoming election, as they should be, but so are the rest of us. I mean, I think it may, at the risk of stating something obvious, the outcome of that election has material consequences for Europe, for example, in terms of defense, support for NATO, the Ukraine war, and trade and investment flows. So, everybody's kind of holding their breath, I guess is the way I would say it. The bottom line is, I think an absolutely essential ingredient of achieving as best we can reasonable levels of global, cooperation and integration that makes sense, is reasonably stable and sensible domestic politics. So that's the hope for outcome. I'm not choosing sides here. I'm actually delighted that the American election is now in at least a full-blown competition, and that's a good thing for democracy.
Michael, thank you so much for joining us. Michael Spence, Nobel laureate and senior fellow at Stanford's Hoover Institution. We'll have plenty more, of course, with Michael throughout the next couple of weeks. Now, coming up, as the Paris Olympics comes to an end this weekend, the games are almost over, but some companies are using AI to keep the flame alive. We discuss all of this with Amazon Web Services Managing Director for EMEA. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
After 2 weeks of grit, determination, and sporting excellence, the Paris Olympics comes to an end this weekend. Now, as sport and fitness continues to play a bigger role in our daily lives, some companies are looking to use AI to advance it further. Now, one of those companies is Amazon Web Services. We're now joined by Tanuja Vranderi, the Managing Director and Vice President for EMEA. Tanuja, thank you so much for joining us. Everyone was kind of glued to the screens to try and understand it feels very wholesome, actually, to look at some of these Olympians trying to compete for gold. How do you think you've changed the way that sports is seen across the world?
Well, it's just wonderful to be joining you here, Francine. So thank you for having me. And isn't it just the most exciting time at the sort of grand dam of sports, let's say? But sports is a really interesting vehicle to showcase the power of data. Every sports person, whether you're a cyclist or a swimmer or a gymnast, there's just an enormous amount of data that they're generating. As an example, in the Bundesliga match, for example, 3.6 million data points gets generated every match. And what we do is we take that data, we collect and analyze it, and then we apply a number of AI machine learning insights to it. So the sports teams, whether you're a team, an athlete, a coach, are getting the most out of that data to be able to improve performance, to be able to worry about health and safety, and of course, very importantly for us, the fan engagement aspect as well. So I'll give you one example, because we're in the middle of the Olympics. The national swimming team of Australia, we've been working very closely with their coaches, taking their training footage, applying machine learning and insights to that, giving that back to the coaches, and they're able to really get their team combinations in a way that allows them to really go for gold. And in the Tokyo Olympics, they won 9 golds as a result, and here they're actually doing very well as well. So they're really getting their performance improvement out of the understanding of that data and the insights generated.
Tanuja, I imagine this is like at all levels, right? You have to, first of all, recruit a young kid that's going to perform extraordinary. Once you have that young kid, it's about making sure that you coach him or her in the right way. And then it's also looking at the opponents. If you break it down, where is this analysis more useful? Do you have data on that?
Yeah, it's actually I would say it's across the life cycle. Because, of course, you have to start with human performance at the end of the day. But what data is doing is allowing these coaches to really help those athletes understand where they're good, where they need to develop further by combining the historical data they've got with the real-time data and then feeding insights back. So, I'll give you another very good example in motorsports, for example. Every one of those F1 cars, as an example, has, 300 sensors during a match, right? During a race. During that race, you get 1.1 million data points coming off the pit and coming off the cars into the pits. The teams are looking at that data. They're feeding it back in terms of providing drivers a view of what they should do. So should you overtake? Should you pause? Should you go back into the pit? Should you change your tires? So you have action during the race, action before, and then afterwards, post-analysis on really looking at how you can further improve. So it's really the whole life cycle that the data and insight gets used.
There are a number of also gold medalists who actually did much better than the record currently. How much has that helped by data analysis and helping them and actually achieve better? Some of the things that we see on TV, you just can't believe that a human's doing that.
Yeah. Well, humans do perform incredibly, really, especially under that moment of stress. And, it is so much training that goes into making these athletes amazing. But, when the difference between silver and gold, milliseconds matter. And it's during that time that the data and insight is probably at its most powerful, right? So again, back to that swimming team example I was giving you earlier, what they're able to do is say, right, this combination of relay teams is going to be better than this combination of relay teams. They're able to track trajectories in terms of what the ending point will be for those swimmers in the race. They're able to look at competitive combinations. And then when they put that together, you get magic, right? So it really is a combination of, as you said, human performance and the data, but not data alone, because data alone is not very useful. It's the AI and machine learning applied to that data that gives you all of that knowledge and experience to draw insights.
I mean, is it also changing the way we look at and see and how Formula One is driven?
Well, I tell you, fan engagement is a very interesting angle, Francine, to talk about, because fans are really, really hungry for this data. They don't want to just be on the scene, as they say. They want to be behind the scenes. They want to understand what's the strategy that's being applied, right? How should I think about driver A versus driver B? By the way, we've been working very closely with F1 as well to really redesign the cars. You know, overtaking is a big thing, and so really redesigning the cars to help with the overtake patterns, for example, using high performance computing. But I'll give you a really good one. We developed this thing called F1 Insights with F1, using, by the way, 70 years of their historical data, combining that with our real-time data, and those F1 Insights are then fed back to fans. So one of the ones I really like is who's the fastest driver. And everyone has their own view on who's the fastest driver through history. And with the F1 Insights, we were able to show actually that it's always been Senna who's been the fastest driver. But when you ask people that question, they come back with just different answers. But that's one of those examples. It's all about, you know, speed, overtake. Are you too close to the edge? And it's very powerful for F1, for the teams, as well as actually the drivers themselves.
Yeah. Tanuja, I know it's been also good, like a tough week for tech stocks and AI in general. We're not going to get onto it now, but do you think we're underestimating how much AI is also transforming some of, you know, the entertainment, some of the things that we like on doing? Do you feel like it often gets a bad rep?
Well, you know, I tell you, I really feel, and we're very convicted about this, you know, this is a transformative technology. It's probably more transformative, Francine, than the cloud when it was introduced, and probably even the internet, I would say. And the reason it's transformative is it can actually augment or accelerate or automate pretty much any process in any sector. We've done some recent research, by the way. It's our Unlocking Ambitions report. We've seen an uptake in the increase of AI by European businesses by 30%. And when you look at that and convert that to what would that mean for the economy, you know, you're talking about the potential of 600 billion euros of economic value that could be unlocked as a result of AI. But as I heard your previous guest on the show, it isn't just about the AI. You know, what we need to do is make sure that there's choice and availability of models, for example. We do that through our Amazon Bedrock platform. We need to make sure it's secure. There's enterprise-grade security. People know where their data is. They know it's secure. And then we need to make sure we build confidence by having responsibility around the AI. And we're very committed to this, by the way, by introducing things like guardrails, where it actually removes harmful content up to 85%. You know, making sure that we're removing biases from the data that people are working on in these programs. So it's really, really important that those three things are there. But I think the other important thing is skills. You know, the lack of digital skills is probably the biggest issue and obstacle that we see, not the technology, not the infrastructure. And we're super committed to also making sure we train, you know, millions of people around the world. Actually, we've trained 31 million people for free around the world.
Tanuja, thank you so much. We'll have to get you back on to dig a little bit deeper into that. Tanuja Randeri, the Managing Director and Vice President for EMEA.
At 5 a.m. Eastern Time, we do get our Italian trade numbers. Italian trade balance EU on the price 0.524 billion, and the Italian international trade balance on the price 6.43 billion.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Colin Huang, the tech tycoon and founder of e-commerce giant Temu, has become China's richest person. Now, he replaces Zhang Shangshan, the country's bottled water king, who held the top spot since April 2021. Now, joining us now to discuss all of this is Bloomberg's Charlie Wells. Charlie, this is exciting. I mean, for him, but also for us, because we get to cover the story. Who's Colin Huang?
You know, he kind of represents a new generation of billionaire in China, and one who's, you know, quite different from Jack Ma, who I think is a very household name for people. He's younger, he's 44, but he really had that kind of global experience that a lot of older billionaires didn't have. He got a degree from the University of Wisconsin and then helped helped start Google in China.
Just less than 5 minutes away now to get our Italian trade numbers. The trade balance EU number with a prior of 0.524 billion, and the international trade balance figure with a prior of 6.43 billion.
Sort of cheaper Amazon.com. So, you know, owned by PDD, it really got its international blow up in 2022 and sort of has been the app of the moment because it sells cheaper products to people from the internet.
He's 44 years old. Do the good times continue for Temu and him?
It's difficult, right? Because there are these tensions between the West and China ramping up. It's going to be sort of a punching bag. And I think a lot of the questions that people in China and outside have been asking is, how is this stuff so cheap? And there could be legislative changes surrounding that.
Okay, but we've definitely asked for an interview. So
Good.
let's see.
It would be a good one.
It would be an amazing interview. Charlie, thank you so much. Charlie Wells there with the newest, of course, richest person in China. Up next, a Bloomberg Brief with Manus Karani in New York, and this is Bloomberg.
what about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart.
Just less than moments away now, I'll be leading with the Italian trade balance.
European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Ten seconds.
Good morning from our global headquarters in New York. I'm Manus Krenner. You're welcome to Bloomberg Brief. Let's set your agenda. Losing velocity, the global stock rally continues following the biggest single-day jump since 2022. Chinese inflation picks up. CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Lee, member of the Harris National Finance Committee. Good morning to you. You've just had one of the big turnarounds since November 2022 in the equity markets. We are up this morning, but there's a fundamental question you need to ask yourself as you wait for the CPI and the retail figures next week as to whether the carry trade is really completely unwound. And this is the perilous question you need to ask yourself when we're trading dollar yen at 147. I like what Carly Garner said to me.
-1.045 billion, -1.045 billion. Have the Italian international trade balance 5.065 billion, 5.065 billion.
17% upside. By the way, Bank of America say sell the
And so we do also see 3-month Euribor falling 2 basis points.
Who you actually follow. But wow, what a turnaround in these bonds. I mean, in the space of 6 days, this time last week, we were pretty much at this level. We dropped to 366. We've turned it around. And the auction yesterday was, as Nat Alliance say, another lousy auction. The 30-year auction tailed. So there's a little bit of indigestion in these bond markets. It's going to be a bumpy road, according to Dan Iverson, and a harder landing probability rising to 25 from 25 to 30%. But you need to ask yourself what happens with yen. Is BNY right? You're too bearish, still too bearish on the yen. We can get to 100, it's their fair value. And that, the carry trade, JP Morgan say 3/4 of the carry trade is done. Citi say we're out of the danger zone with the carry trade. Speaking to people on the IB this morning, they are also saying in the cash FX market, and this is important, in the cash FX market, probably 3/4 of that
is done. That's in conversation with various guests on the IB. Well, we also have had another piece of data this morning to China. The consumer prices rose more than expected in July, but concern about domestic demand remains writ large. Let's talk through these numbers. Tom McKenzie is with us. Tom, you spent a lot of time in China, so digging through this data should be a walk in the park for you. Top line versus the core. It's important that we draw this distinction and what the drivers were.
Yeah, that distinction is really important, Manus, because top line, the numbers came in for consumer prices, an increase of 0.5%, 0.5% in the month of July, as you said, above the estimates. But you lift up the hood and you realize that there are weather effects that pushed up the prices of things like vegetables. There was a very low base when it comes to that key input into the consumer price basket of China, which is pork prices, very low base last year. So you can strip that out as well. And what you see at a core level is that actually prices are very soft. Prices actually came down for the likes of autos, for likes of cars, smartphones and appliances as well. There's a massive price war going on in China and consumers are sitting out to see if prices continue to fall. The consumer and that demand picture remains very soft in China. On producer prices, you're almost at a 2-year stretch where producer prices are in deflationary territory in China, and that talks to a key concern. Exports are not kicking in. We saw that in the data out of July. Exports were soft, so they need the consumer to come to the fore if they're going to hit that 5% growth target, and that's why you have a number of economists saying there will need to be more measures from policymakers in Beijing, including a rate cut. They've outlined, senior leaders there, a 20-step plan to boost the consumer, but it was lacking in detail. That was the take from many, and it didn't come with additional fiscal support. Economists are saying more will need to be done to get that consumer back and to get those consumer prices up.
It's interesting, and we've got this angst over the policy response mechanism. You've got the yen unwinding. That could have a reverberation back on the yuan. You've got the Aussies talking about a pretty hawkish narrative in terms of what they're prepared to do with rates. Tom, this angst, we've seen some policy response mechanism from the PBOC this year. Some would say it's been incremental, too small, piecemeal, and not enough for the consumers. So where is the debate on the policy response in China?
It's really shifted from the need to stimulate at a central bank and monetary policy level, and as you say, they have done that, to the need to get cash into the pockets of consumers. And you've had, really interestingly, prominent economists, prominent voices in China putting their heads out above the parapet and saying it's time to get cash into the pockets of consumers. So far, though, senior leadership appears to be reluctant to do that. We do expect, the team at Bloomberg Economics expects another rate cut from the PBOC and maybe a move lower in terms of reserve ratios for the banks. We'll wait to see if they do anything more material on the consumer side.
Tom, thank you so much. Tom McKenzie there on the very latest data from China. Well, it's been a hugely volatile week for the bond markets and cross assets as the carry trade unwinds. Joining me now is Alex Stewart, Global Unconstrained Fixed Income Fund Manager over at Schroders. Good to have you with us. The debate is this, is to what extent this carry trade has been unwound. Alex, when we look at the responses, and some would say hysteria in the bond market, 366 on the downside is where we went on the 10-year government bond yields. We're back at 390. We're back almost at that 4% level. Give me your take in the level of volatility. Have we seen the worst? Is the worst passed from the carry trade? Do we move the narrative on now?
I'm not sure that that's exactly the case. I think things have got a little bit ahead of themselves in terms of fears of recession and I don't think that actually what has happened recently has changed an awful lot. Obviously, with the Bank of Japan raising rates, that has caused a bit of an unwind, but I don't think that we are actually heading for a recession and that the worst fears will be realized.
I mean, when you look at the flow in the bond market, as I say, we crashed to 366, talk of an inter-Fed cut, 50 basis point cut. Let's just listen to the Richmond Fed President, Tom Barkin. He spoke yesterday about the central bank's path forward.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I could use another balance beam analogy. Or is this one where you really do have to lean into it?
So that is the debate, how much time they have and what they do. If I look back at Bill Dudley just 10 days ago saying, look, he's pivoted from being from a hawk to a dove, listening to Barkin, we have time, but will the market afford them time? Do they need to do a precautionary 25 basis point cut in September to avoid a harder landing?
I mean, that is the question. To be honest, I don't think that the data is bad enough and that they really need to panic at this juncture. I mean, I think, I think we've got very used to the fact that the Fed put was there previously for, stock market wobbles. But I think that, they'll be going to be quite cautious about signaling that. And they'll be, doing as they've been saying and keeping an eye on the data. And it's probably quite, balanced as to whether they need to go just now. I think they will be a little bit cautious about trying to signal that they're panicking in any way.
And if you look at bonds, it's interesting, the conversations I've had this week has been, the 60-40 portfolio behaved pretty well. Bond markets pretty much took the lean as a hedge. And I just wonder at what level you say to yourself, look, there's been quite a significant rebound in 10-year government bond yields. I know Dan Everson over at PIMCO says it's going to be a bumpy road, but he would be prepared to add in 10s at 4%. They just look a little less attractive than they were. From a duration point of view, how does duration look to you?
I mean, I think we got a little bit overdone. If you look at where we got to on Monday, it was very much, emergency rate cuts were being priced in. It was very hard to see at that juncture, how much more they could be expected to do. I think there was a little bit of a panic. We are in summer markets. We can get the volatility can push things a little bit too far. I mean, we've retraced a little bit from there. And possibly could do a little bit more. I mean, I think longer term, obviously, we are about to be starting a rate cutting cycle. So, duration is not unattractive, but I just think we got to a point where there was just too much priced in.
Yeah, I mean, there was a certain hysteria to this market. Now, in the past 24 hours, politics is never far from the agenda on Bloomberg Brief, and the former President Trump spoke at a press conference yesterday, and whether a president should have a say in, you got it, monetary policy.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Now, to your average bond investor or bond manager, that possibly strikes fear. If there was ever an example of a toxic combination between politics and monetary policy, it was this week in Japan. Hiking rates, some would say, the Bank of Japan learned a salutary lesson from the politicians. When you hear that from Donald Trump, how do you think bond investors would react to that concept?
Yeah, I mean, it's a little bit concerning. I think, there has been a little bit of, maybe, we saw it in the UK not that long ago, that, that politicians quite often just assume the bond markets will be there to fund whatever. Actually, we have to see that inflation is going to be under control and that we are on a steady course. So, yeah, I think there would be some concerns about that.
Yep, it certainly would bring into question that unique position that U.S. Treasuries have in the world. Alex, thank you very much. Alex Stewart there over at Schroders. There are other stories trending on your Bloomberg terminal this Friday morning. If you're still with us, the UK is weighing steps to tighten rules for online platforms such as X. This comes after days of rioting in the UK. Prime Minister Keir Starmer called for a mature conversation with social media companies to limit malicious content. Donald Trump looked to recapture attention and momentum in his race against the VP. Kamala Harris dangling a series of debates and fielding reporter questions for over an hour at the Mar-a-Lago resort on Thursday. Their first debate is expected to take place on September the 10th on ABC. An earthquake near the coast of one of Japan's southern islands has prompted the government to issue its first ever warning of a megaquake. The country's prime minister called off a planned trip out of caution. Bullet trains ran at reduced speed and some chip-related factories temporarily halted their production. Coming up, Taiwan Semiconductors sees a 45% revenue spike in July. We'll take a look at what that says about the AI demand structure right here on Bloomberg. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
In global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Take a little bit deeper into these markets and equity markets specifically. It's been a wild week. Joining me now is Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist. I mean, Gina, if you just look at the VIX through the week, parabolic moves on the upside, a little bit of temperance. The S&P never quite made it into correction, but the NASDAQ took a much more aggressive dip. When you stand back 6 days later from the jobs report, how do you contextualize what we've just seen?
Yeah, it's been a wild ride for sure, but when we really think about what's happened in stocks, you can date it all the way back to the turning point at the middle of July, which was really sparked by a change in the yen, which led to the change in Bank of Japan policy, which is a generational shift. We're contending with the first hike in interest rates in Japan in 17 years. That sparked a bit of volatility that was then exacerbated by the bond market's anticipation of U.S. economic data or interpretation of U.S. economic data as imminently likely to create a major Fed easing cycle. That divergence in policy rates has created this carry trade unwind. And remember, that carry trade had been building up over nearly 2 decades in time. So we did have this vicious response in equities over the weekend. I do think that the Bank of Japan's statements that they're unlikely to continue hiking as long as volatility in financial markets is in play really created the stability. But that, along with some rationalization in the bond market regarding an interpretation of the economic data, through the course of this week, the economic data has come in pretty stable. So I do think we have that sort of right sizing of expectations going on, and that's definitely fed through to equities. You know, the most liquid stocks in the world, of course, being the biggest of the big cap stocks in the U.S., really have taken it on the chin, along with the Japanese equity market. So I think that that's a lot of what's going on and what's at play here in the coming weeks. We've got to watch the Fed and the Bank of Japan probably as our most key indicators.
I mean, I like what Mark Cudmore said on the M Live chat. It's the market, not the economy, that is structurally problematic. And that's true. But that plays back to your point, which is in these vortexes of where we deleverage and see risk off, you go to the most liquid assets, first of all, to divest those. Obviously, ground zero is Mag 7, large tech, big tech tech. But you look at the valuations after all of this angst, and you look at the sector overall, I know that, and on a PE basis, it's trading just below we were at the highs of the pandemic. But can you split that out for me for the group versus, let's say, Mag 7? Has there been a significant revaluation in the PE for Mag 7?
Yeah, unfortunately, no. This is still a group that's incredibly excessively overvalued. Now, stock by stock, I think it's important to look at the Mag 7 stock by stock too. But when you look at the group as a whole, we're looking at still near record level valuation spreads in particular compared to the S&P 500. And that I think is really important. It's the spread that is probably most indicative of the excess optimism in this space. It's also what's created the sort of impossible expectations that these stocks have faced throughout this earnings season. But that spread does suggest that while we've piled all of our hopes and dreams into the Mag 7, the rest of the S&P 500 has very, very low expectations implied in valuations, at least by comparison. And that does open an opportunity for investment as we start to see some clawback of earnings progress in the rest of the index, the 493 stocks that are not Mag 7 stocks. We should start to see capital flows improve for those companies. We should start to see some stabilization and maybe some right sizing of valuations in that group as well to catch up. Now, I think at the same time, you've got to consider how the Mag 7 can grow into their multiples. Historically, what's happened when multiple spreads have gotten so high is Mag 7 prices simply stop rising as fast as earnings. And we could see earnings produce a bit of catch up, allowing for those multiples to normalize. I think your natural proclivity is to worry that prices have to decline in order for multiples to normalize. I just want to put out there that multiples can normalize in more ways than one. You can see earnings catch up to price, and that may be a period of time that we're moving into now.
Gina, let's see whether we get a little bit more volatility. We've got CPI, we've got retail sales next week. So again, we're living day by day on this data in terms of the emotional response by these markets. Gina, thank you very much. Gina Martin-Adams of Bloomberg Intelligence, wrapping up a week of huge volatility in equity markets across assets. Coming up on the show, we'll take a look at the other headlines around the world on the papers and the sources that we check, including President Biden's efforts to break the deadlock on the ceasefire talks in Gaza. Context matters on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still, and forget AI. I need a basic technology adoption.
Nobody covers business like Bloomberg.
It's Friday edition of Bloomberg Brief. I'm Maniskrani in New York. Front pages, this is what we've got for you. Headlines from around the world. First up, the Journal leads with Biden's move to break the Gaza talks deadlock. The US, Egypt, Qatar are making a last-ditch proposal to reach a ceasefire agreement with Gaza. Leaders from both Israel and Hamas are urged to meet on August the 15th for negotiations. Of course, a lot of this is going to come down to the response that we see from Iran onto Israel. Still waiting, the world is still waiting for that response. What impact will that have on those discussions? Next up, New York Times, Ukraine's push into Russia. It's surprising turn in the war. The Ukrainian forces advancing several miles across the Russian border into the Kursk region. Now, the attack caught Moscow off guard and opened up a new front in the 30-month war. TSMC's revenue rose by 45% in July, accelerating its pace of growth. This provides optimism that the AI chip demand remains strong. Let's dig into those numbers. Peter Elstrom is with us to go through these numbers. So, Peter, look, 1 month, a nice set of numbers for TSMC. What's the first read on that, on the broader picture?
Well, it's a very good point. This is just 1 month of sales that we got from TSMC. Taiwanese companies report these monthly sales, which can be indicative of what's going on more broadly. I think after the big scare that we got in the market earlier this week with the Monday troubles in the stock market, everybody wants to see the next sign of where exactly this is all going. And TSMC is a very good indication of what's happening in the semiconductor industry. So this is an indication, the 45% bounce that they got in sales in July is an indication that maybe they're going to surpass the expectations for the third quarter. Those are about 37% right now. TSMC makes the chips for NVIDIA, for AMD, and also for Apple. So it begins to give you a sense that demand from those customers is pretty strong for TSMC right now. Now, is that enough to kind of prove that the AI trade is back on, that things are positive? It's only one data point at this point, but it is a positive data point, and I think that's giving some investors some reassurances that people are still buying these chips.
Look, they have a dominant position, there's no doubt about it, in this marketplace in terms of their ability to price and in terms of the flow of business. Do you think that out of what, I don't necessarily know that out of 1 month's data you can extrapolate overall AI demand. The issue is more about monetization of AI capex, but from the demand side, what do you think this can tell us?
Yeah, that's a very, very good point. These are the suppliers of the equipment to the big companies that are making these massive investments in AI services. So the customers for NVIDIA and for TSMC by extension are the Microsofts, Metas, Amazon, and Alphabet. They're the one making these multi-billion-dollar investments in AI services. And what we don't know yet is whether those services are going to pay off. Gotcha. We know that they're buying a lot of chips. They're buying a lot of chips from NVIDIA and TSMC, but where's the revenue on the other side?
Okay, Peter, thank you very much. Wrapping up the TSMC numbers. One swallow does not make a summer. Peter Elstrom there with the very latest. We'll take you through what's going on with the oil markets, and also we're going to catch up with Lindy Lee.
I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York, it is Bloomberg Brief. I'm Menace Cranny. Time to set your agenda. Losing velocity, the global stock rally stalls as markets question a renewed push of the carry trade unwind. Chinese inflation picks up, CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Lee, member of the Harris National Finance Committee. A very good morning to you. To what extent are these equity markets reflecting on the scale of the unwind and the carry trade? Either way, we managed to put on one of the best days performance since November 2022 on the back of one small piece of data. No serious injury from the jobless claims. Is that enough? We look forward to CPI and retail sales next week. We're up by 0.3%. TSMC's helping the tech and the chip side of the business. But UBS make the point, look, if you've got reasonably solid growth, i.e. a Goldilocks kind of scenario, and rate cuts, they actually see 17% upside in these equity markets. If anything, this vicious and pernicious volatility that you have had this week is indeed for them a contrarian signal. Then the other side of the trade is Bank of America say sell the first rate cut. You know, you can take your choice. The market has certainly repriced the capacity of rate cuts. We've whipped it around from 366 on the downside to call it 4% for cash on bonds at 395 at the moment. Yields dropped by 2 basis points this morning. Again, the narrative is this. You no longer need an inter-Fed cut, nor do you need 50 basis points. But do you need an insurance cut of 25 basis points? Also on the bond auction yesterday, it was another tough sell. Nat Alliance called it another lousy auction. And Dan Iverson says you're going to have a bumpy ride in these bond markets. But he would add duration at around the 4% level. It's just not as attractive as it was. You just need to debate whether the carry trade is really undone. Citi say the worst of it's done. JP Morgan say the worst of it is done. And I've just had an IB from Kit Duke saying he feels that 3/4 of this, if not more, of the unwind has been done. But, you know, fool me once and all that jazz. So that's the state of play on markets. Nvidia's up 2.25%. Still, it's had a pretty tortured tour from the very top to the bottom. The NASDAQ obviously making it through and into a reasonable level of correction. The S&P 500 never quite made it through the correction. Okay, we are less than 100 days away from the US election. Donald Trump has agreed to debate the Vice President, Kamala Harris. Meantime, Harris and her running mate, Tim Walz, continue their swing state blitz. Here's what they said on their tour.
We got some work to do. We need to move to the general election and win that. And to all the friends, listen, we also need to level set. We are the underdogs in this race. We want to recognize the right
freedom and liberty to make choices, especially those that are about heart and home, and not have their government telling them what to do.
Donald Trump's not fighting for you or your family. He never sat at that kitchen table like the one I grew up at, wondering how we were going to pay the bills. He sat at his country club in Mar-a-Lago, wondering how he can cut taxes for his rich friends.
I know exactly what we are up against.
Joining me now is Lindy Lee, member of the Harris National Finance Committee. Great to have you with us. Timely to have you here.
So nice to be here. Thank you so much.
Good to see you. I mean, some people are saying this is almost like Clinton Gore, this team up, the response in the halls, the kind of momentum that they have delivered. How strongly are they cutting through as a team, as a combo?
Oh my goodness, they've been a powerhouse together. The blue wall is back in play. Michigan, Wisconsin, and Pennsylvania, my own state. Harris is leading in all three. It's just been absolutely phenomenal. She raised $310 million in the month of July, and it wasn't even the month of July. It was the final 2 weeks of July. So this is just mind-boggling, and we are absolutely thrilled. I was lucky enough to be at the first rally in Philadelphia. She invited me to the VIP reception. It was just, and watching them both, Walz and Harris, they have incredible energy together, and he is very down to earth and makes people feel comfortable. He's exactly the kind of person we need on the ticket.
Well, they're certainly selling, you know, the folksy teacher, military side of him. Now, you say Pennsylvania is leaning towards Harris, but we've done our own polling here that shows Trump is up 4. Yes, she has cut into his lead, but it's not leaning to Harris. So what are you seeing? Where are you seeing that? What exactly are you seeing when you say it's leaning to Harris?
I'm seeing the young people who are finally galvanized, the young people who are sitting on the sidelines, the 30% who weren't happy about Biden being at the head of the ticket. Now it's overwhelmingly, Democrats are overwhelmingly thrilled to have Harris at the top of the ticket. I haven't seen this energy since 2008 when I was a kid supporting Senator Obama. She's completely upended the landscape. Georgia is back in play, for goodness sake. So she's completely upended the map. She has many paths towards 270, and this is the right thing for the party.
But can she get that path to 270 without Pennsylvania? Because Shapiro's off the ticket. So I suppose the question is, without him on the ticket, can she win Pennsylvania?
I think people need to remember that he doesn't need to be on the ticket to be an effective surrogate. He's going to be out there. He's committed. On Tuesday, he even said himself, he's going to be out there every single day making the case, prosecuting the case, litigating the case against this convicted felon who faced 88 criminal charges, 4 indictments, 2 impeachments. You all know that, 26.
Yeah, we've got the laundry list of you know, felonies, etc. I suppose what we want to know from our perspective is, what's her policy that's going to work in Pennsylvania? It's a huge energy state. She was against fracking. She sort of railed against that now. When's she going to come out and make a very clear statement on energy and fracking? Because she hasn't done any interviews yet.
Well, she kind of did one on the tarmac today. I know she's going to do a more extensive one later in the month. She already spoke with her staff, and she committed to doing one. And they're also going to debate on September 10th. One thing I do want to mention is she did say she's no longer in favor of the fracking ban. So she's making concessions, and she's also going to make sure that people know she's the rule of law candidate. Do you want stability in the markets? Do you want to prevent a free fall in the stock market? Do you want rule of law? Do you want to revere the Constitution? Then Kamala Harris is your candidate, not the convicted felon. How do businesses prosper when there's a tumultuous environment?
Well, I think I understand all those statements, and both sides make the same kind of thing. You know, do you want a strong stock market? Do you want a stock market that crashes? I think what people want is fiscal responsibility in the first instance, rather than hyperbole about whether you want a higher stock market. I mean, the jobs market is strong at the moment. Unemployment has risen ever so slightly. Growth is solid in the United States of America. There's no talk about a parabolic drop in the equity market if Trump came to power. Let's talk about the money. The campaign's doing well. You've said that, the scale of the money that has been raised. I'm just wondering, is Walz Is he carrying through? Is he hitting through in terms of raising his own money? Any numbers there that you can give us?
So I'm one of Harris's biggest donors. I sit on her National Finance Committee. I raised 1.1 for Biden over a course of a year. I raised $2 million over a course of 5 days a week, essentially. So the comparison is just mind-boggling. And with Biden, I had to do a lot of sweet talk, a lot of like finagling kind of thing. But with Harris, people are just like forking it over. They're so eager to get on board.
Who's the biggest donor so far? Who's the biggest ticket that you raised for since
well, I don't want to.
Oh, break news. Feel free.
Well, I don't want to divulge confidences, but you will find out eventually on the FEC report. But this is someone who's able to write 920. What was that?
So it's one ticket. It's one check for how much?
One check for the maximum $929 and $600. I think is the limit, because they have a joint fundraising agreement with all the states. That's what that allows them to donate more than the $3,300 stipulated by the FEC.
So the one thing that we saw with Harris on the money side, which was invigorating people who've never donated before, perhaps who haven't been politically active before. 66% of the money that she raised was from new donors. What can you tell us about the flow of money, these new numbers that you're talking about in terms of new donors?
I'm seeing it myself. I'm actually leading a fundraiser called Christians for Harris. I'm a Christian, and that's on Monday. We have small dollar donations just pouring in, and these are like $50, $20 even, $100. These are not big ticket donations, but accumulation of many of these small contributions, it's an avalanche. It's just phenomenal. I've never seen anything like this before.
Which social media platform is doing the best for you in terms of raising the money?
Twitter's one, and then TikTok, because she's winning the meme game. I don't know if you've been noticing.
Yeah, no, we've got that.
Exactly.
Yeah, Kamala is bad. What sort of ads are you going to buy with the money?
3 words: Pennsylvania, Pennsylvania, Pennsylvania. As you mentioned just a few moments ago, Pennsylvania is the ball game. If we win Pennsylvania, she has the White House. So both campaigns, actually, both Trump and Harris have committed to spend hundreds of millions of dollars in the state. I'm actually a commissioner in this Commonwealth, so I have my finger on the pulse of the situation. And I have never seen young people, and women in particular, so excited about this ticket. Because Trump is the candidate who overturned, he's the one who appointed the 3 justices who overturned Roe v. Wade, and that's something that we will never let him forget.
So by the very nature of what you just said is Pennsylvania, 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 Pennsylvania is, if you don't win Pennsylvania, there's no road to the White House.
There's no road. It's going to be very difficult. We need Pennsylvania. We need Pennsylvania. We need Georgia. If she has both, we win.
Okay. We wish you well on the campaign trail and with raising more funds. Well done on the efforts so far. That is my guest this morning, which is Lindy Lee of the Harris National Finance Committee. Coming up in the show, we'll dig into the crude markets and check in on the developments on what Bob McNally thinks about the Middle East.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto, sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this, but then they are. They are. And the evidence is there. It's overwhelming.
It's Bloomberg Brief. I'm Manus Cranny in New York. So oil is poised for a weekly gain after a string of losses as traders continue to watch developments in the Middle East. Rapid Energy founder Bob McNally says this of the market: oil fundamentals are broadly neutral. Crude prices are struggling against a macroeconomic pessimism, punctuated by sporadic and brief geopolitical mini spikes. While we expect Iran will pull its punches to avoid a regional war, the market remains too complacent. Bob joins me now. Bob, you have joined me on several occasions when we have been in anxious periods of waiting to see what the Iran response mechanism is to Israel, and obviously their moves on Hamas and Hezbollah. We don't know what that response mechanism is at the moment. The calibration, your assessment of what calibrated response might be.
Good morning, Manus. So our base case is that Iran must thread the needle and will respond to the recent eliminations in Tehran and Beirut by Israel with a retaliation that is sort of strong enough to sort of try to dissuade Israel from continuing those attacks, but not so strong that it triggers a regional war. And they'll do it unlike April, which was just an Iranian attack on Israel. This time it's probably going to involve, even feature its allies, Hezbollah in Lebanon and Syria and Iraq, and maybe the Houthis as well. So more of a broader front. But it's a Goldilocks type of revenge they're looking for. Not too hot, not too cold. And then, Manus, there is the chance that there will be a breakthrough on the peace front. In other words, Biden administration right now is scrambling to say, look, call off the retaliation. Let's get a deal in Gaza. So those efforts are underway. But we think base case is Iran and its allies will retaliate here.
Would a multi-pronged retaliation, as you say, via the proxies not be something more significant than the three, in April time it was 300 projectiles, 170 drones, 120 ballistic missiles. What you're framing to me sounds more substantive than that, or just clarify.
It depends. So Hezbollah in Lebanon, with its inventory of missiles, actually poses a bigger threat to Israelis than Iran. So it depends on what Hezbollah does. Manus, I think the most important metric to watch, God forbid, is whether there are Israeli fatalities. In April, no one died.
Yeah.
Look what happened when the Houthis killed one Israeli in Tel Aviv with a drone. The Israelis lit up the port of Hodeidah and killed several people. So Israel is in sort of a three eyes for one eye, not eye for eye, three for one. So it all depends on whether Hezbollah and Iran cause fatalities in Israel. That'll determine whether we leg up in terms of geopolitical risk and crude, I believe.
Which then takes us to the response mechanism. We're just showing the price of crude at the moment up 3.74% on the week. But I look back on the chart here. Obviously, it's been really brutally taken down by the macroeconomic de-risking concerns. Here we are. We're back to reassessing war and geopolitical risk. When you look at the demand side of the equation and the war side of the equation, are we at sort of a cap here in terms of the market, because the demand side will ultimately pull us back?
You know, I think both on the demand and the supply side and the fundamentals, oil is sort of trading sideways. I mean, across different products and across regions, you can find pockets of strength. U.S. gasoline, even total oil demand in May, blockbuster strong. India, soaring. China, weak. Jet fuel is white hot globally. Gasoline, firm. Distillate, the economic fuel, weak everywhere, especially in Asia. And if you look at differentials and spreads and physical trades in Europe, Brent is starting to show some life. So as we look across the complex and we analyze the data, you can be a bull, you can be a bear. It's sort of neutral here. It's signs of stock draws.
Okay.
But the market, as you said, is not trading off of this. The market is trading off of macro, Bank of Japan, Federal Reserve, and geopolitical risk occasionally.
Let's take the optimistic side that Iran threads the needle, no massive escalation or injury. I mean, these are all very, very, very optimistic scenario plans. But let's say the response mechanism, and that there is a geopolitical de-risk, a coalescing of the minds on August the 15th. My question to you would be then, progress on a ceasefire, put that to one side. With, as you say, macro worries and China's lethargic demand, can OPEC Plus actually continue to add the barrels back on the program that they've outlined?
Not without accepting lower prices. I think as we sit here today, OPEC Plus leadership still intends to launch the tapering. It's scheduled in October. But that's, 180,000 barrels a day per month. It's not too much. We don't expect much in terms of these compensation cuts. If you believe Iraq is going to comply with its compensation cuts, OPEC Plus supply is going down later this year, not up. But it's unlikely Iraq will comply. More likely, they will launch it, Manus, but it's going to be a week-to-week, month-to-month sort of monitoring of the conditions. I believe Saudi Arabia, UAE, Russia, they are able and willing to pause that tapering if they see fundamentals weakening. But right now, they're sort of looking through this macro noise and this short-term volatility in crude prices, and they believe fundamentals are starting to move their way.
Tell me this, Bob, you've advised at the White House in various administrations gone by. Here we are. Politics is never far from the oil market or from the White House. Kamala Harris has done a volte-face from wanting to ban fracking. Obviously, it's very important in Pennsylvania, to something different. We need clarity on exactly what that is. How do you see U.S. oil policy under a Harris presidency?
Under a Harris presidency, really, no president can really do much to unleash production in terms of increasing crude production. The industry operates it all out. We don't have spare capacity. However, a president has the power, Manus, to hurt oil production and gasoline and refinery output. So with Kamala Harris, she says she no longer supports banning fracking. Were she to try to do that, she'd need Congress. Unlikely to happen. However, and we've talked about this in the past, the president has a pen and the authority to restrict or ban exports of crude. So if a president wanted to hurt U.S. production, they don't have to ban fracking. They can just restrict or ban exports of crude. Also, they can declare a climate emergency and use sort of defense powers to restrict production. So there is power there. I'm sure the industry hopes that she has turned a new leaf and is not supporting a sort of a gut punch to the industry. I guess we'll see if she wins, but she has enormous power, not to help, but to hurt the industry if she chooses.
And likewise, the other side of the coin is, of course, if Trump comes back in, he could indeed be injurious to Iran in terms of the largesse of their production at the moment. We didn't quite get there. Bob, thank you very much for joining us this morning, framing the geopolitical risk and the oil markets. Bob McNally there, President at Rapidin Energy. Let's revert back to tech. We've got a nice bid with Taiwan Semiconductors, up 3.33%. We saw the revenue for last month up 45%, bolstering the AI narrative. Peter Elstrom is with me, Bloomberg's executive editor for Asia Technology. It's a nice booster for July for TSMC, Peter, isn't it?
It is. Now, this is just 1 month of data that we're getting out of TSMC. Like many Taiwanese companies, they report monthly revenue figures. It gives us a little bit of a signal about what the third quarter is going to look like for TSMC. The average projections for revenue growth there are about 37%. So this is above this, suggests that maybe TSMC is going to do a little bit better than expectations. Now, why is that important? It's because they make the chips for such key players in the market, including NVIDIA, and AMD, as well as Apple. So investors may look at this and see this as a positive sign for demand, that NVIDIA is beginning to sell the chips, the new AI chips that they're bringing into the market. There's strong demand for those kinds of things. After the scare that we had earlier this week in the market, that may be somewhat reassuring, but again, it's just one data point, it's just 1 month, so there's some caution around that too.
Is there much of a read across on the broader implications of this? It's obviously something that helps the narrative. We've had quite a de-risking on big tech and in the Mag 7 and in the AI space. So what do you think the broader implications are?
I think the big question right now in the AI trade is not whether NVIDIA can sell chips or whether TSMC can make chips and then sell them into the market. The big question is whether the companies that are buying all those chips, the Microsofts, the Meta, Alphabet, Amazon, whether they're going to be able to generate revenue on the other side and show that these big multi-billion-dollar investments that they're making in AI services, AI chips, are actually going to pay off in the long run. And that's a question we just don't have an answer to at this point.
Peter, thank you so much. Peter Alstrom there with the very latest on TSMC. We'll run you through the schedule for the rest of the day in just a moment on Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Let's lay the landscape out for you for next week. On Monday, the former President Trump is interviewed by Elon Musk. Tuesday, we get real insight to some of the inflation data here in the US. We've got the PPI followed by the CPI on Wednesday and retail sales. So again, really understanding the health of the consumer. We'll also get retail sales earnings from Home Depot on Tuesday and Walmart. That real pressure on the value end. To ground zero of risk, it is about dollar-yen, but also the bond market. Such an explosion in volatility in equities and bonds over the week. Round trip, 366 on the low point. You're trading at 395 right now.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ.
Fed's Collins saying it's appropriate to begin easing soon if data as expected.
The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago.
The labour market deterioration, if it continues, well, then that could feed and create a downward spiral.
We think the Fed right now is pretty far behind. It's at a very restrictive level right now.
They are ridiculously behind the curve, irrespective of what the capital markets are doing.
The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you all to the weekend and fast. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. What a week. Monday, the worst day for stocks since 2022. Yesterday, the best day for stocks since 2022. We've all been whipsawed left and right, up and down, all around. It's been vicious. Check out the scores this morning. Equity futures on the S&P 500 a little firmer, up 1/3 of 1%. On the NASDAQ 100, up 0.4 of 1%. Last week, the data was bad. This week, the data was better. Next week, the calendar's stacked. Danny Berger, let's go through it. August 13th, PPI. August 14th, CPI. August 15th, retail sales. A week later, Jackson Hole.
If that's the kind of data we have next week and we move to such a huge degree on claims, it's kind of worrisome. The fact of the matter is that we are just down 0.5% on the S&P 500 for the week. And Neil Dutta lays this out. It shows you that the risk is asymmetric going into next week's data, that we've rallied back to this point. If the data disappoints, you could have that narrative flip on a dime yet again to, I don't know, hard landing or something else.
I thought what Neil said was perfect. Economists worry about levels. They talk about levels. Markets don't care about levels. Neil was talking about this. What matters is change. Are things getting worse or are they getting better? And I think it's a much, much harder task to tell people right now that things are getting better. So we're all waiting for Chairman Powell in a couple of weeks. Were you waiting for this? Fed Chair Donald Trump in a news conference yesterday. I have a better instinct than in many cases people that would be on the Federal Reserve or the chairman.
He said it's really a gut feeling, and given his past business experience, he knows where interest rates should be. What I found shocking about this is we have been asking former Trump officials on the record, behind the scenes, what happened to that Wall Street Journal report in April, this 10-page document allegedly the Trump campaign was looking at potentially how Trump would try to erode the independence of the Fed. Well, he kind of just said it right there. If he is going to be president, he would want to exert more power on the Federal Reserve. The issue, of course, is that the Federal Reserve gets their mandate from Congress.
Well, if he was able to do it, I was just thinking how incredibly helpful this would be for his aim to have a weak dollar, right? This is how you get it done. Because presumably you put in tariffs, you have tax cuts. That means that the Fed needs to hike, therefore you have a stronger dollar. The way that you can ensure you have a weak dollar is if you have control over Federal Reserve policy and can cut into that strength.
This is certainly a good way of getting people to run away from US assets, which would certainly hit the US dollar. I'm with Anne-Marie. The first thing I did was pull up the Wall Street Journal article from August, which read as follows: Trump allies draw up plans to blunt the Fed's independence. And what do we hear from Trump allies over the last few months? They poured freezing cold water over that report, backed away from it, pushed away from it, questioned the sourcing in the piece, and then we hear it basically from the former president yesterday.
And in the economics realm, what we heard from the White House yesterday, Jared Bernstein coming out and re-releasing the report that the White House did after that Wall Street Journal report, basically talking about how it is so important to the fundamental economics of the United States that there is an independent Fed. So now this once again comes back up to as an election issue.
This has been breathless all week, so deep breath. Let's go through the markets together. Equity futures on the S&P 500 up by about 0.2%. In the bond market, we've had a massive turnaround in Treasuries through the week so far. Yields this morning a little bit lower. We're down 3 basis points. Your 10-year 395.51. Coming up this hour on the program, we'll catch up with Steve Major of HSBC on the bullish case for US Treasuries. Jeanette Lowe of Strategas as Trump and Harris agreed to debate, and Drew Mattis of MetLife following the S&P 500's best day since November 22. We begin with our top story. Treasury yields dropping after a week of wild swings. Stephen Major of HSBC remaining bullish on bonds, writing, ever so quickly the higher for longer narrative has collapsed. Explanations range from the technical to the fundamental, even the political, but whatever. The bond market has moved to preempt the Fed. Steve joins us now for more. Steve, it's been too long, sir. It's good to catch up with you. I'm going through your year-end price targets. Let me begin with them. 350 year-end, 3% by the end of 2025. Steve, let's go through that. What is the big bullish case for you and the team for Treasury bonds?
Well, these forecasts were set some months ago, Jonathan. They haven't changed. I think the first wave of bullishness in the bond market that we've just seen, and by the way, the bond market hasn't given up that much of its gains over the last week. It's pretty impressive how it's just performed. But I think the first wave is taking out the bearish view. So only 1 month ago, we were talking about reflation trades and various scenarios around the election, and the consensus positioning was for a bearish steepening. And that was based on opinion polls and probabilities, scenarios, etc. And I look at it now and I wonder, where's all that gone? A couple of months ago, people were talking about the case for keeping rates higher for longer. I think that was a very flaky, fragile kind of forward guidance. Again, that's gone. So the next move in rates is unambiguously down. The question is how much. If we get anything near 50 at the next meeting, and market is priced for between 25 and 50, then the market will set a price target of lower yield. So, you know, it could be that we get as much as the market is pricing in by year end. We could get more. The thing is, the market tends to lead the Fed, and I think you're seeing validation of that now.
Certainly what's happening at the moment, Steve. I just wonder how you think about the destination, the path, this conversation about 25 versus 50 in September. We've discussed that all week. Where are you on the destination? What's the end point for this cutting cycle once it starts?
Well, the muscle memory of bond traders and investors is 300 to 400 lower than the policy rate. So that takes you down to at least a 2 handle. I don't think the equilibrium rate and the R-star has actually changed since before the pandemic. We've done work on that. Others seem to think it's higher. If you think the R-star is higher and you try and add term premium on, you end up double counting. That's another point in the report there, that I think that the positioning is double counting term premium. So for me, 10-year treasuries should yield between 3 and 4. Having a forecast of 3.5 seems logical. I cannot explain why other people do what they do, but my suggestion is there's some double counting going on.
Stephen, I wonder when you think about the speed and the depth of your rate cuts and how that informs your view for where the level should be on treasuries. What is your North Star? Because this is a market right now trading that every single piece of data is a North Star.
Well, the thing is it? Because that might be part of the problem, in that we are being whipped around on every single cyclical data release and not putting sufficient weight on the longer run secular trend. And by the way, Anne-Marie, if you look back at previous cycles, you'll see that it was impossible to call the turn based on the payrolls data or the CPI or the ISM, and that makes me wonder why people spend so much time talking about it. I mean, you can only use the unemployment data with hindsight. So it strikes me that everyone is trying to pass every bit of information they can to try and get an edge, a forward-looking edge. But the truth is, yields have been falling since October of last year. The front end of the curve failed 3 times to break above 5%. Look, we're actually entering a bull market for bonds here. We had a good year last year. We're having a good year this year. Bonds are not supposed to be generating double-figure returns. They're supposed to be the boring person at the party, a bit like me, really. The fun comes from all the other assets that you talk about. So if bonds can generate 5, 6, 7% a year, that should be just enough. And what they're doing right now is offering the perfect ballast in the portfolio, in a 60-40 portfolio or whatever. All that's come back, by the way. No one's talking about that.
Stephen, first of all, you're welcome at our parties anytime. I can assure you that. Are you telling me, though, you're looking at a trend here? Are you basically telling me that payrolls and CPI don't really matter?
Yeah, well, when you go down this route, you sound like a heretic, and I meet a lot of people who do give me a few funny looks sometimes. But I'm just saying, can we not put things in perspective and context? Because the cyclical data matters, but so does the longer-run structural and secular story. And it's the more secular outlook that gives you your anchor. Your anchor is your longer-run equilibrium rate. If you think it's 2.5, then the Fed's got a long way to go just to get to equilibrium. The terminal rate could even be below that. Other people think that the R-star, the equilibrium rate, is higher. I don't know where they get their information from, but they're basically just describing the forward rate. And in markets, you need to have a view that hopefully is better than the forward rate. Our view is that yields will be lower than what the forwards are saying. It seems to me that others think differently, but again, I can't talk for what other people are forecasting.
Stephen, earlier to Jonathan, you mentioned that the market was tracking some of the polling. I want to talk about politics and a Trump victory. Now the polling is much tighter. Yeah. So is the market pricing in a Kamala Harris victory?
Well, look, it's a great question, because only 3 or 4 weeks ago, you can see what the polls were. It was 65% in favor of the Republicans, and now it looks more like 50-50. I'm sure you've got more precise numbers, but you know what I mean. And so if you take the probability of a sweep for the Republicans down, then you presumably move the market pricing away from reflation trades, whatever they are. My guess is a reflation trade means curve steepening for bonds. It may be good for equities as well.
Fed's Collins saying the timing and pace of cuts is to be based on data.
Then that's quite a big change, isn't that? And I think that was the butterfly wing that started to flap before all the other stuff that came in terms of BOJ, Fed, ISM payrolls, leverage trades, unwinds, all of this stuff. It's a confluence of events in these last few weeks. But if you want to look back at what started the change, I think you hit the nail on the head there. It may have been those few weeks ago when the probabilities started to shift away from the reflation trade.
Steve, can we do a bit of scenario analysis? What would happen if it shifted back? Yeah. What would happen if Donald Trump won in November and he was much more assertive about pushing forward with the tax cuts that they had introduced back in 2017, 2018 and rolled them forward? What if we saw something aggressive on immigration? What if, like he suggested yesterday afternoon, he would be more assertive about Federal Reserve monetary policy as well? Would that challenge the secular story that you've described that's ultimately this massive tailwind for fixed income?
It wouldn't challenge the secular story, it might give us a bit of a cyclical bump. Now, in the previous month's asset allocation that we published, it couldn't be a more different context to today. And actually, a month ago, I wrote about this reflation trade and the probabilities and the scenarios. If you want to think what the world would look like in a sweep scenario for the Republicans, then I think you'd have to agree that the curve would be a bit steeper. Many of the policies might add to near-term inflation, and there'll be all kinds of risk premia that we'd have to think about around all the policies. So it's the uncertainty that would add to the steepening pressure in a bearish fashion. But as we just discussed, that probability has fallen, and that means that the weightings are shifting towards soft landing and/or hard landing, if it was as simple as that. And I think that kind of backdrop favors lower yields in the near term. In answer to your question about the secular story, we're talking 5 years ahead, 5 or 10 years ahead.
Yeah.
I don't think even that would be disrupted too much.
Steve, this was great. I've known you a long time. Been for beers with you. I can say on the record, you're not boring, Steve. We know that. Steve Major of HSBC. Steve, thank you, buddy. It's good to catch up as always. The 10-year yield down by about 3 basis points this morning, 396. Danny, Steve's looking for 350 year-end, 3% by year-end next year.
So one of the, I guess, devil's advocates calls against that would be someone like Goldman Sachs, who says that we expect more growth. We still expect a strong economy, and therefore yield should be at 4.25%. But I think the fascinating thing about Steve's call is that it's not necessarily about each individual data point that comes in. I mean, he went so far as to say we're kind of missing the forest for the trees, just concentrating on payrolls and CPI, that we have a neutral rate, and in order for the Fed to get there, there needs to be a lot of cuts, so the direction of bias is yields down.
I have to say, based on what I've heard from the Federal Reserve so far, do you hear that from Fed officials, that they're willing, ready, even remotely prepared to validate what's being priced into this market right now?
Not at all. It is night and day hearing commentators on Wall Street and hearing the Fed. They keep saying this refrain, we have more time. Things are strong. We have more time to figure this out, to let inflation play out. That is not a Fed that is saying we're behind the curve and need to cut 50 basis points.
Fed presidents daily, Barkin, Goldsby, Schmidt, all in the last few days, nowhere near where this market is at right now. Maybe that changes. Maybe they're waiting for Chairman Powell and Jackson Hole to be the North Star for them and change all of this. But right now, they're not validating market pricing at all. Equity futures right now on the S&P 500 positive by about 0.1%, just about holding on to gains, with some stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Microsoft said a group of hackers linked to the Iranian government tried to breach email accounts of presidential campaign staffers as part of a wider effort to gain intelligence ahead of the U.S. election. The company revealing attackers linked to the Islamic Revolutionary Guard Corps used a compromised email address from a former political advisor in a phishing attempt on a high-ranking campaign official. It follows a warning from U.S. intelligence officials last month that Russia, China, and Iran were recruiting people in the U.S. to spread propaganda. Iran has denied that allegation. China's consumer prices rose more than expected in July, climbing 0.5% from a year earlier. Bloomberg's survey expected a rise of 0.3%. The jump was largely due to seasonal factors such as weather, leaving intact concerns over weak domestic demand and boosting the case for more policy support. Meanwhile, core CPI rose 0.4%, the least since January, indicating lingering weakness in overall demand. And TSMC reporting revenue jumped 45% in July, accelerating its growth from the June quarter and bolstering hopes for sustained demand for AI chips. Taiwan Semiconductor is seen as a bellwether for AI demand, as it's the go-to chip maker for some of the biggest AI companies like NVIDIA. For the third quarter, analysts expect TSMC's revenue to grow 37%, but the July numbers suggest the company may surpass those estimates. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it.
So no more debates about the debate. We've got an agreement? Good. That conversation up next from New York City this morning. Good morning.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York, we're almost there. The weekend just around the corner. Equity futures on the S&P just about positive by 0.1%. Yields lower by 2 or 3 basis points. The 10-year 395.89. 20 minutes into the program, haven't even mentioned dollar yen. It's a good morning. Dollar yen 147.20 and just about unchanged. And there's your why. That's why we're not talking about it. And that's a good thing for many of you, I'm sure. Under surveillance this morning, setting the debate stage.
I just look forward to these debates. I think it's very important that we have them. I hope she agrees to them September 4th, September 10th, September 25th. And I think they'll be very revealing.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
So here's the latest. ABC News confirming Vice President Kamala Harris and former President Donald Trump have agreed to a presidential debate on September 10th. The two sides hitting the campaign trail in full force today. Harris holding a rally in Phoenix as Trump heads to Montana. Jeanette Lowe, strategist, joins us now for more. Jeanette, this has been agreed. September 10th is the date on ABC. I just wonder from your perspective, who is most at risk going into that?
I think that Trump is a little bit more worried about his positioning since Harris has gotten into the race and is now the Democratic nominee. So I think he is actually looking at this to try to have a similar debate as he had on June 27th against President Biden. So I think there's more risk there. What we're definitely seeing since Harris has gotten into the race is a lot more momentum on the Democratic side. You've seen the national polls, a 3.5 percentage point move from Trump, who had been up about 3 percentage points, to now Harris being up just as about a 0.5 percentage point. In the swing states that matter for this election, you've seen a move of more than 2.5 points in Harris's direction. So now we really do have a 50-50 race where it could be very close come November. And I think he really wants to use the debate to try to re-highlight and be able to attack Harris on some of the key issues that he thinks are lacking now.
Jeanette, he also, yesterday in his press conference, Donald Trump floated 2 other debates. Who is more at risk of having more debate time when it comes to not just on this ABC News one, but Trump was floating an NBC News debate as well as a Fox News debate?
You know, it's interesting. So obviously, I think the June 27th debate was probably a bit of a surprise to many people. Usually the incumbent president does lose their presidential debate, but that was just quite a different debate than I think anyone was expecting. Trump could be more disciplined in the debates, as we saw in the June 27th debate, but at the same time, there could be, different reactions, kind of like what we had in his press conference yesterday, where that could actually hurt him. Now, if Harris is also on the defensive and he's actually able to get a lot of blows, that can hurt her. So debates can actually be quite up in the air. I think that's why we also kind of want to see what happens at this first debate and if that means we want more than one. Usually, obviously, we do have 3, so I think Trump is now trying to go back to that traditional mode, but that's also a lot in a couple of weeks right before the election, so we'll see what happens.
We also heard from Kamala Harris yesterday, the vice president, talking about the fact that her team has scheduled, or she's asking her team to schedule a sit-down interview before the end of the month. Unclear if that means it's going to be scheduled for August or potentially September. But there was also reporting that they would maybe want to sit her down with her VP pick, Governor Walz. Do you get a sense that the campaign is trying to shield her from some of these more direct confrontations with journalists?
You know, I think it's unclear. I think one of the things that this has been a very fast campaign, so it's only been 3 weeks. I think to some extent she might be still trying to get her feet under her and make sure that she kind of knows what her policy positions are. So there could be some of that in part of the delay as to really being doing more of these interviews. But I think also she's kind of has the momentum at this point. Now, she is a better debater. She is better in front of the camera, I think, than she has been in the past. So I think that does have a benefit for her. But there could be other factors that I'm not quite sure exactly what they may be. But I think this is something that the Trump campaign is now trying to latch onto to try to make that saying that she won't show up in front of the press, she won't do interviews, and she won't take questions.
Jeanette, she's been vice president for about 4 years now. Is it a problem she doesn't yet know her policies?
Well, I think it's also just, you know, as a vice president, she's trying to toe the line of what the President Biden wanted. Right now, you know, we've seen that she is not taking necessarily the same positions that she took as a candidate in the 2020 cycle. So things like fracking, she's trying to like moderate her position on Israel a little bit. I think these are the things that she wants to really make sure she has really ironed out better, because obviously we know in this news cycle, people love to take anything that you say and then kind of spin it. So I think she also wants to make sure she does have her messaging down, but she does also have a risk there that if she's actually not showing up in front of the press, and she's not able to answer questions and talk about her policies, that can also be a risk for her campaign as well.
Jeanette, just before you go, quite clearly the Vice President is driving enthusiasm at the top of the ticket. How are Senate and House races evolving since Biden dropped out and she stepped up?
Yeah, so one of the biggest things that we've seen is that since Biden got off the ticket and Harris is now the new nominee, we've seen the odds of a Republican sweep drop quite a bit. They were at 55% on July 16th. They're now down to 32% this morning. And you also have 25% odds of a Democratic sweep and 25% odds of divided government in the scenario of a Democratic president, Democratic House, and a Republican Senate. I think what's interesting about this cycle is that you could have divided government under either scenario, whoever wins the presidency, just because the margins are so tight right now in the House and the Senate. So for instance, if Harris is getting a lot of momentum, the Democrats only need a net 4 seats to win the House. And those are seats that are also in states like Alabama, and there's 1 seat in Alabama. There's seats in California and New York and New Jersey. The Democrats do have an opportunity to flip this cycle. So if she has momentum, even if she doesn't win the presidency, there is still a possibility the Democrats could have control of the House. On the flip side, the Senate does look like it's going to move to the Republicans because you have Senator Manchin no longer running in West Virginia. I think that becomes a Republican pickup. And then also John Tester is currently down in the state of Montana. And so that could be another pickup. So there is this interesting dynamic where we could have divided government no matter what. So I think that that's something that we need to look forward to because it's obviously going to have big implications for what policies can be enacted next year, and particularly as we're talking about the debate, as about taxes and the debt ceiling debate.
Jeanette, got it. Just fantastic as always. Jeanette Lowe there as Strategas. Scene. The Vice President hasn't answered any questions. So she approaches you and says, what questions have you got? And you respond by saying, when are you going to answer questions? What were they doing yesterday?
You could have also just said, here's a question for you.
You know, like start asking some questions about policy. Honestly, from New York, this is Bloomberg.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
The top names in business are on Bloomberg.
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still, and forget AI. I need a basic technology adoption.
Nobody covers business like Bloomberg.
We are on course for a fourth week of losses on the S&P 500, potentially, and we could have raised them a little bit later on, but potentially the longest weekly losing streak of the year so far. Equity futures right now on the S&P positive by 0.2%, on the NASDAQ 100 up by 1/3%, on the Russell up by 0.4%, and I think we've firmly established, Danny, that good news is good news and bad news is bad news based on the incoming information and how this market's responded to it.
Well, to be clear, the good news was jobless claims that surprised to the downside in a good way by 7,000 people. We had the biggest rally since 2022 because 7,000 people in the entirety of the United States did not file for jobless claims. I think that says a lot about where this market is, that we're just grasping at things, trying to get a handle, and the market will chop both up and down until we do.
We've had some great guests this week. I think one of the best, Jim Karen, Morgan Stanley. Jim said the last few weeks you've learned more about the positioning than you have about the fundamentals. And to your point, jobless claims, great example of that.
Yeah, certainly. And I mean, you even look at what's going on with the yen. We all look at the yen today and we say, oh, great, it's being calm. Well, of course it is. Nothing is going on with the BOJ today. I think everyone is just looking at every move in the market with bated breath, that they feel like because you had this big volatility upset on Monday, that more could be in store. You have other people celebrating the fact that the volatility has calmed down, and maybe that's a fool's errand.
Just waiting for the next data point to get whipsawed all over again. Switch at the board and turn a page, and let's go to the bond market. And I've mentioned this a million times this week, but still, I think it's stunning, and we should talk about it again. The 2-year at the start of the week, the low on Monday was 365, just south of that. On a 2-year, we're just north of 4%, 4.03%. It's kind of remarkable to see where the 2-year was Monday morning, how the world felt, and where we are at the end of the week.
This is why when people say, look, bonds did their job. They protected you on a Monday when stocks were selling off. That basically papers over the fact that yields are indeed higher on the week, that you have a market that had this big convulsion, and bonds convulsed too. You had so much volatility in an asset class that's supposed to be the staid part of your portfolio. This is supposed to be the boring part that doesn't move a lot, and it didn't give you that this week, even if it did give you some protection.
How many bond people have been on this program in the last week who have looked actually quite excited? Quite excited that like their world was where the fireworks were for once.
Right.
Big time.
The revenge of the bond nerds. And it's this kind of, this idea of, look, bonds have been pricing in something worse for this economy for a while now. You equity guys have been living on a hope and a prayer that everything's going to be wonderful, and now you're coming around to our camp.
These Steve Majors of this world over at HSBC feeling very validated by the last few weeks. I want to turn to dollar yen. Danny mentioned it. Dollar yen's just about unchanged, so nothing's happening here whatsoever. 147.18. I think you've got to put two things together this week. The data calmed things down a little bit. It wasn't just jobless claims, it was ISM services as well. And the BOJ backing away from things just a little bit too, I think just took some pressure away from this story for now. Whether it comes back, I don't know. The fact of the matter is dollar yen is about to post a week of gains for the first time since June. That's how vicious things have been the other way in dollar-yen.
Well, I think the worry for this market has to be is we've seen ties in different parts of this market that we didn't necessarily think were there. For example, big tech sells off at the same time you have yen appreciating. Are they now so interconnected that, you know, we get NVIDIA earnings at the end of the month? If they're really bad, do you see a yen appreciate? I mean, that would be kind of crazy under any circumstance, but I think we need to ask those questions after a day like Monday.
It's a bonkers world, not just Monday, but over the last few weeks, that's for sure. Under surveillance this morning, if you are just joining us, just an update on where we are with the Fed speak. Kansas City Fed President Jeffrey Schmidt signaling he's not ready to support an interest rate cut, saying we're not quite there in calling inflation, and the labor market still appears healthy. This word healthy is something that's come up a few times. We've heard from Barkin, we've heard from Daly, we've heard from Gorsby, we've heard from him. And I have to say, they all seem to be on a similar page. Are we ready to cut interest rates? We're getting close. Looks like it's going to happen in September. Are we ready to validate market pricing? I mean, my word's not theirs. I'm just going to infer, based on what they've told us, they're nowhere near ready to validate market pricing.
It's not even the pricing, it's the conversation. Just to add more Fed speak to the mix, Fed President Susan Collins sat down with a paper in Boston, and she said that we are going to have rate cuts soon, so perhaps the most dovish speak of all of them. But her justification is that if CPI keeps falling, the Fed is still talking about inflation. The Fed is still talking about getting back down to 2% as the most important part of the dual mandate. The market's moved on from this, and you can see it in the reaction to the data. We care more about unemployment than we do CPI. But the Fed, again, in their conversations, still talking about inflation as the guiding star.
After I heard from Mr. Rosenberg yesterday, basically saying we might be in a recession. And he's saying that what everyone's discounting is the fact that look at what's happening with hiring, not firing. I was struck with what Thomas Barkin said yesterday. He says there's no hiring, there's no firing. That's what we're seeing in the data. And he says that's what he's hearing on the ground in his district, in his state. That's what business leaders are saying. So he pretty much sees this normalization, but basically saying it could go either way.
Danny's absolutely right. There's a dual mandate here, full employment, price stability. The market's gone from focusing on price stability to exclusively on the labour market side of the mandate, and the Fed's sort of balanced between the two right now. That's what it feels like. That's what it felt like with Chairman Powell in the news conference in the last few weeks. That's what it looks like based on what we've heard from Fed officials.
And the risk with that many people will say is you can say, look, we're not worried about these labor markets because sure, hiring is not great, but no one's getting fired. The risk is always that once layoffs start is that you're too late. You know, it's kind of like the beach ball being held underneath the water that when you let go, it just shoots higher. So by the time layoffs happen, if that's when Fed officials wake up to that reality, the argument goes that they are far too late.
This self-reinforcing process has started. That's the view of the bears right now. Danny mentioned inflation in America. I need to talk about CPI out of China, coming in higher than expected for the month of July. Seasonal factors like weather driving the rise, leaving intact concern over sluggish domestic demand and boosting the case for more support. It's interesting to hear from a couple of economists on the street, in fact, not just in the United States, but worldwide, the reluctance of Chinese officials to really loosen up fiscal, and they were reluctant to do so until maybe 2025 once they've worked out what it looks like politically here in the United States. And that's quite a take at the moment. I think that's consensus for many people watching that economy.
Well, because the state council came out with a plan to boost domestic demand. They were going to have to inject some fiscal stimulus into the economy. But Goldman Sachs said, hold on, we think China's actually holding back on the firepower because they might need that ammunition if there's going to be a Trump presidency and he puts up the walls, including 60% tariffs on all imports coming from China.
Not just if it's Trump or Harris. We still need to work out what Harris's position actually is. What is the vice president's position on China, tariffs and policy for trade worldwide?
We don't know. That's the point I think you made earlier, Jonathan, the fact that she goes over and talks to reporters and what they want to ask is, when are you going to sit down for us to ask these policy questions?
Blows my mind.
I imagine, though, she has been the vice president for under Biden, and it will be a similar trajectory. So they're going to keep some of those tariffs, but no one's talking about in the Harris camp about putting up a tariff ring, a wall around the United States.
I think we're all hoping for a quiet end to the week. Looking ahead to next week, though, things get very busy. PPI, CPI, retail sales all next week, and we're all looking for evidence of a soft landing. Drew Mattis of MetLife writing the following: while risks of a more significant downturn have risen, given that the equity market volatility may have prompted some additional concern from higher income workers, we continue to expect only a moderation in growth. Drew joins us now for more. Drew, great to catch up, sir. As always, let's get straight into it. Why are you only expecting a moderation in growth? Where does that more constructive view, Drew, come from?
Well, I wouldn't call it more constructive. What I'd say is that
I'd certainly say it's more constructive relative to what we've been pricing into this market over the last week, Drew, wouldn't you?
Well, one of your guests yesterday basically said, I was here and the market went here, and then it's coming back, and he's been unchanged, right? And that's where we are. Is there's going to be this moderation growth. What I think people are really missing with regard to the labor market story is hours are continuing to fall, right? There's a limit beyond which, when hours fall, you'll start firing people, right? Because you're paying people to do nothing, and we're seeing a lot of paying people to do nothing in the data. And it's only really a matter of time before companies have to kind of justify paying those people to do nothing. And so, calling the labor market healthy, is the housing market healthy because no one's transacting in it? I don't think so. It doesn't look healthy to me. So why would the labor market be healthy if no one's transacting in it?
So, Drew, build on that for me. When you look at Fed policy at the moment, how wide is the gap between where you think the Fed is and where it will be and where you think it should be?
I mean, they should have been cutting months ago, as people like Neil Dutta have been suggesting. And, the fact that they waited now doesn't mean they can play catch up. They tried this before with rate hikes, right? They missed the bus. And instead of trying to just kind of gradually move policy where they needed it to go, they decided to run after the bus on their skateboard, and they got hit and taken under the tires, right? So they don't want to do that again. At the same point, the weakness tends to actually gain momentum. And so I think, what we've seen with claims, for example, people are excited that claims went down last week. The average, if you just kind of get rid of all the volatility week to week in claims, is still towards weakening labor markets. It's still towards more people filing unemployment insurance claims, particularly when
So just seeing here the PBOC is to maintain reasonable growth in financing.
Not every worker can file for them. And when you look at it that way, it's pretty much a straight line higher. And that's something that should worry everyone, including the Fed, which should be thinking to themselves, what's the peak in unemployment that we want to accept? And when do we have to cut rates to get there? And I think they've already missed the boat if they were hoping for 4.5 to be the peak in unemployment. The question is, do they want the peak to be above 5 or below 5 at this point?
Drew, can you square something for me then? Because you sound quite concerned. The trend is getting weaker, as you described. But am I right in that you only expect 75 basis points of cuts this year? You sound like you would want to be more dovish than just 75 basis points of cuts, given everything you just said.
Well, a month ago, I was perceived to be more dovish, and people were, internally and externally were like, really, you believe 75 basis points of cuts this year? And so, rather than me adjusting myself, I think everyone else's view on what it takes to actually get to a better place has kind of gone off the deep end a little bit. And you've seen that reaction in the bond market. You've seen it with Fed funds expectations, where people are expecting 125 to 150 basis points of cuts by the end of January, which is the first meeting that the Fed has in 2025. And you see it in the 10-year, right, where, below 4% is not where the 10-year should be, given the state of the economy, the state of inflation, the state of the budget deficit, and, what you can expect maybe for productivity going forward once people begin to actually harvest the gains of artificial intelligence.
So Drew, in a world where the market is right, what does the economy need to look like in order to get 100 plus cuts this year?
I think you need the unemployment rate fast approaching 5, so the pace of the deterioration, the unemployment rate doesn't slow down. And I think you need to see inflation come down maybe more than it will. We're not worried about inflation, and we don't think the Fed should be worried about inflation. If the unemployment rate's going up, you can count on the inflation rate going down, and I think that's the trade they're going to make as they approach the end of the year. But we still think that they're going to be cautious there, right? The pace of the slowdown is still a relatively moderate pace of slowing, even though we are expecting unemployment will continue to move higher.
Drew, so you think the Fed should have already been cutting months ago. Yesterday, David Rosenberg said to us the Fed is, quote, ridiculously behind the curve. He also mentioned something in the data that you're talking about, which is the fact that hourly work from individuals is starting to fall off a cliff. But he thinks potentially we're in a recession. Do you share that view?
I don't think we're there quite yet, but I'm not sure if it's a coincidence that David, Neil, and I all worked together back in the day. We tend to look at the world for what it is, and what it is right now for an employee. Are you going to go to your boss and ask for more money next year?
Yes.
So seeing here, the PBOC says that prudent monetary policy should be flexible, moderate, precise, and effective, according to a statement.
Right? no one's going to put their hand up there. And that's the part of the equation that people are missing. Oh, well, no one's being fired. It still affects the dynamics of the labor market and still will affect the dynamics of consumption.
Drew, everybody should do that. Go away. Drew Mattis of MetLife. Thank you, sir. It's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. The U.S., Qatar, and Egypt are calling for a new round of ceasefire talks, the latest effort from the Biden administration to end the war in Gaza. Israel said it will send a delegation to the talks scheduled for next week, while Hamas did not respond. U.S. officials now say a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. Paramount Global saying it will cut about 15% of its workforce, amounting to about 2,000 jobs, as it prepares for its merger with Skydance Media. The parent company of Nickelodeon and MTV reporting earnings that beat Wall Street estimates after its streaming division, like Disney, swung to its first ever quarterly profit. But like Warner Brothers Discovery, Paramount took a second quarter impairment charge of $5.98 billion on its cable networks, marking another sign of weakness in traditional TV. And former President Donald Trump saying presidents should have more say over interest rates and monetary policy. The move would go against the long-standing tradition that the Federal Reserve is independent of political actors. Trump telling the media from Mar-a-Lago that the Fed has been a little too early and a little bit too late in moving rates, and that he may have better instincts than those at the Fed. Powell has pledged not to let politics influence his or the FOMC's decisions. That's your Bloomberg Brief. John?
Yahara, thank you. I want to pick up on that story. Based on those comments, do we go back to that Wall Street Journal story of April this year? The headline read, Trump allies draw up plans to blunt the Fed's independence. Is this about blunting the Fed's independence through some kind of formal channel, setting policy to do so? Or is the former president saying that if he comes back into the office, he'll be as loud as he was before about offering an opinion about where Fed policy should be? Which one is it?
It's hard to understand, but these are the most direct comments we've seen him talk about Fed independence. The word he used yesterday was gut. He said, you know, the Fed kind of gets it wrong. They're tending to be a little late on things. Maybe he gets a little bit too early. You know, there's very large a gut feeling, and I believe, you know, I have that gut feeling.
We'll try and get some more opinions on this for you throughout this morning. Up next on the program, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. I am definitely not one of those people that would say to you, it's different this time.
That conversation up next, live from New York. You're watching Bloomberg TV.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
don't want to jinx this, but this is what a calm summer's morning is meant to look like. Equity futures not doing much, up 0.1%, no data, not much Fed speak, very light on earnings. In the bond market, yields a little bit lower, down 3 basis points, 395 earlier this week. People freaking out about dollar yen. Dollar yen is almost totally unchanged on the session. This is how you want it going into the weekend. Let's hope it stays this way. Dollar yen 147.14. Under surveillance this morning, the turning point for a soft landing.
I still think that we're either in a recession or about to confront one. What's tried, tested, and true is the unemployment rate. And the unemployment rate is up 0.9 percentage point over the past 15 months. When you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. I am definitely not one of those people that would say to you, it's different this time.
Is it different this time? Here's the latest, the full slate of economic data ahead next week, headlined by Wednesday's CPI report and a double dose on Thursday with retail sales and another round of jobless claims. Paul Donovan of UBS taking a balanced view on the economy, writing the following. Equity markets have been meandering rather than moving with clear direction. The unwinding of more speculative trades should have concluded, allowing economic fundamentals to gradually reassert themselves. Paul is with us now for more. Paul, I'm happy to talk about fundamentals with you, so let's go there. Walk us through how much stress, Paul, there is in the US consumer and whether you can identify whether it's starting to migrate from low-income households to middle-income households and maybe even further.
Well, it is the middle-income household that is critical because that's the consumer that really is behind the growth. Now, the bottom 30% of income distribution, of course, they matter socially, they matter politically, but they don't have the spending firepower that the middle-income consumer has. And to be honest, if you are a middle-income consumer, as a household, life's pretty good. Very low fear of unemployment. You've got a job, you're not losing a job. You're seeing increased female participation. And what's critical here is women are taking jobs paying above average earnings. They're moving up the quality because flexible working is giving childcare providers a lot more ability to take high-quality jobs. That's enhancing household spending power. You're in a low inflation environment. If you're a middle-income household, remember the nonsense of CPI, despite Powell's absurd obsession with it. CPI overstates the cost of living for middle-income households. All of this is really beneficial. And I think it means that the middle-income consumer is going to continue to put in a pretty solid performance.
Paul, I love the phrase that you've said for a while now, not to short the hedonism of the American consumer. And so far that has played out correctly. I just wonder, in your view, what does it take for that to deteriorate?
So the thing which would really cause me concern, the one thing which is going to stop you guys going to the shopping mall or, spending money you don't have on things you don't need, the one thing that would cause that to come to an end, I think, is a significant fear of unemployment. But fear of unemployment is not driven by temporary job layoffs, which is all of what happened last week, pretty much. Fear of unemployment is when either you are seriously concerned that your permanent job will be taken away from you, or friends and family are experiencing that. And we're just not getting that at this stage. But fear of unemployment is what we've got to look at, and that is job losses for permanent workers and more widespread, not sort of geographically or sector concentrated.
I know Monday was only a blip, and you're talking about seeing friends and family lose their job and fear of that. But if the market were to have more days like Monday, where you just have, I don't know, it could be a data print that is not really representative of the overall economy, but you have more things like that, is that enough to have that feedback loop that you're talking about? Can the market do that job?
No, I don't think so. So here's the thing, which we sort of whisper about in my profession. Financial markets aren't as important as they think they are. In the real economy, it's not the large listed companies that dominate employment. It's the mom and pops, the Mittelstand in Europe. It's the small, medium-sized businesses that dominate employment, that dominate things like job security and so forth. So the market going up and down, yes, there's a bit of a wealth effect. You've got to remember, most Americans don't own a lot of equity, and the equity they do own is indirectly held through 401ks and similar. So the fluctuations of the market don't sort of immediately lead to correcting behavior on the part of the consumer. Now, house prices, they're a lot more significant in terms of affecting consumers' perception of their wealth. But otherwise, you know, the ups and downs of the market, the fairly wild swings that we were seeing earlier this week, very limited feedback loop at this stage.
I want to ask you about what's going on in China, because you talk about in your note this morning, we did have inflation tick up slightly, but this has to do with weather effects and food. The issue is demand. Do you think the Chinese economy needs a monetary policy approach to this, with the PBOC potentially cutting, or do they need to pump some fiscal stimulus into this economy?
Well, my view here is that it really needs more on the fiscal side. It's not really a credit-constrained economy. That's not what we're seeing. What we're seeing is an unwillingness to spend. Now, this may be fear of unemployment coming through. We've got to remember that, you know, particularly youth unemployment, even on the official numbers, is still quite high, and you know, the expectation is that it's probably higher than the official numbers portray. There's also concerns about, you know, the need to rebuild savings post-pandemic, you know, in the absence of a particularly robust welfare state. So in that situation, I think easing the cost of credit has a fairly limited impact. I'm not saying it's zero, but it's not going to be the main driver. Really, what you've got to try and do is boost consumer demand through consumer confidence, through giving people a greater sense of security about their economic futures.
Do you agree with some of your colleagues on the street, though, that potentially China is holding back and waiting till we get the results of the U.S. presidential election?
I'm not sure that that is necessarily the case. I mean, I think China is going to try and achieve its 5% growth target, because China always tries to achieve its growth target. And in that situation, I think, you know, we're getting this sort of drip of stimulus measures, a little bit here, a little bit there, easing in this provincial fiscal policy, bit of an easing on the credit condition side. And that's to try and maintain, on the official numbers again, around about a 5% growth rate. Now, the thing is, if President Trump does come in and wins re-election and puts in place a 60% tariff, and it's not just a sort of a bargaining tool, that would be very, very disruptive for the China economy. The universal tariff would probably also be very, very disruptive for the China economy, and that would then require additional measures. But that's such an extreme situation. U.S. would probably end up in recession as well. So you've got a really, you know, compounded problem that would require separate measures. There's no point waiting and umming and ahhing about, you know, does Trump win or does Harris win? You know, I think China is going to focus on its 5% domestic target for growth and achieve that, independent of what is going on in the exciting world of U.S. politics.
Paul, it will remain exciting, I'm sure, for the next several months and maybe even a long time. Much, much longer than that. Paul, thank you, sir. Paul Donovan there of UBS. I want to just get to Paul's comments on the labour market and the US economy. That fear of high unemployment, in Paul's mind, hasn't gripped this market, this economy, just yet.
When he says the market thinks it's more important than it actually is.
Isn't that always the case?
Yeah, it always is. But I also love his view of the American consumer. Like, you are spending money that you don't have. I feel like kind of
on
directly
things you don't need.
On things you don't need, and that's going to continue until, you know, you see your sister, brother, parents lose their job.
It's funny, that felt personal to me too. I think it felt personal to a lot of you. Coming up in the next hour of Bloomberg Surveillance, Anastasia Amoroso of iCapital, Congressman French Hill of Arkansas, Deborah Netshirt of Jennison Associates, and Megan Swiber of Bank of America. With futures just about positive by 1/10 of 1%. You're watching Bloomberg TV.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
From wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is.
There's a higher risk of recession than zero, but it's still not a base case for us yet.
I still think that we're either in a recession or about to confront one.
I don't think that we're at the point yet where things are tipping over the edge where the Fed's going to have to start cutting 50 basis points.
There are pockets of weakness, but overall, the U.S. economy remains in solid shape, and that's the story I like to tell.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I bring you better news. Things are quiet, snoozy even. Start going to the beach already? I don't know, but things are better. Equity futures on the S&P 500 going virtually nowhere. On the S&P, we're positive by about 0.2%. On the NASDAQ, up by 1/3%. Let's see if it sticks. But just to take the temperature of where things are this morning, nobody's talking about dollar yen. Dollar yen is basically unchanged on the session at 147, and we can put our hands together and hope it remains that way. 147.13 on dollar yen. Things get busier next week, so let's get to the calendar. CPI, PPI, retail sales. Jackson Hole a week later. Danny, the stage is set for a very interesting speech from Chairman Powell.
And it's interesting to think about what they'll care more about in between those individual data points. You have to assume for this market it is retail sales, because if we are worried about a downturn in the economy, if we are worried about the consumer, considering what we've heard from earnings, retail sales will be the most important for us. But the noise from the Fed is still inflation.
This week's very different to last week. Last week we had bad data, ISM manufacturing, jobless claims, payrolls, the unemployment ticking higher once again. We had the BOJ hiking interest rates and suggesting the bar was pretty low to go again. This week, like the reverse of that, data's a little bit better, jobless claims a little bit lower, that's good. We saw ISM services, that was better as well. In expansion is where we want it to be. And the BOJ backs away. That's the ingredients for things to settle down just for now.
But let's be honest, that data was tier 2 data. I mean, it was jobless claims. It was ISM. Not to say that they aren't important. I don't mean to be flippant about people applying for jobless claims, but it is usually not your North Star of data. If you listen to Stephen Major, none of it should be your North Star, that you just need to think that the neutral rate is lower, and we're going to head there, therefore you should be buying bonds.
And when it comes to data, I'm looking at what Mohamed El-Erian continues to say. What are the CEOs saying on the earnings call? So Expedia comes out. They have posted better than expected results, but they say they're seeing this softening demand. And the CEO said in July, we saw there's softening demand, concerns about the macro environment. So what they're saying about the future is that potentially less people are going to be getting on planes and booking hotels.
Airlines first out the gate. Delta, United, American, Ryanair on the other side of the Atlantic all said the same thing.
And I think it all shocked us because travel numbers are high. How many times did we sit here before a holiday weekend saying it's going to be records at the airport, it's going to be a mess, there are going to be so many people? So for the airlines to turn around and say, actually, we are struggling, I think was whiplash for a lot of people. It could be what Torsten Slok from Apollo is talking about. It's that business class, first class, they are still doing fine. So all airlines are reflecting is a bifurcated economy.
That consumer softness not exclusive, of course, to the airline business, the travel business. We're seeing that elsewhere as well. Just to check in on the scores for you, on the S&P 500, just about positive by 0.2%. A little bit of a lift in the equity market this week has included the biggest one-day loss since 2022 and the biggest one-day gain since 2022. Monday and Thursday, two very, very different sessions. In the bond market, yields lower by 3 basis points on a 10-year, 395.32. Coming up this hour, we'll catch up with Anastasia Amoroso of iCapital following the S&P 500's best day since 22. Congressman French Hill on whether the president should have an influence on Fed policy. And Megan Swiber of Bank of America now expecting a greater degree of curve steepening. We begin with our top story. Stocks posting their best day of gains since 2022 following the right kind of downside surprise on jobless claims. Anastasia Amoroso of iCapital writing this: markets may be getting sufficiently close to pricing in current recessionary odds, and pullbacks may be buying opportunities, especially if the recession is averted. Anastasia's with us around the table. Anastasia, good morning.
Good morning.
Let's talk about the evolution of your year so far. Coming into the year, I would say more bullish than most, a little bit more conservative, I would say, through the back end of the summer, coming into July. Where are we now? How has your thinking evolved?
Yeah, I think that's right. I would say in May, we wrote this piece where we talked about the reasons for optimism and the reasons why you wanted to buy the April pullback that we had. Then coming into July, we wrote this piece and said, look, we've had a stellar first half of the year, but here are the risks for the second half. And it's not like we were calling for those risks to materialize, but if you think about election uncertainty, that was on the list. If you think about slow consumer, that was on the list. And also this potential disappointment from AI and all the hype that we've had there. So we've sort of checked a lot of those risk factors. So now when I look at the markets, you talked about the dollar yen. The reason why the U.S. market does not seem to care is because for us, the biggest risk is the recession. And how do we price in a recession? And this is why that's something that I was thinking about. It. To what extent have the markets actually reflected the recessionary odds? Well, the Bloomberg consensus of economists forecast about a 30% probability of a recession. There's a range of estimates. So one of the Fed's models is looking as high as 50. The JP Morgan model might be looking something like 43%. But when you size that relative to the market pullback before the bounce back yesterday reflected also a 30% probability. And so we're kind of at this, 200-day or 100-day moving average to fully reflect, I think, some of the worst forecasts for the recession. I would say we need to pull back another 5%. So when I look at that setup, John, I say we're sort of within the strike zone of, getting close to pricing in the recession based on what we know today. But especially if we avert a recession, buying within the strike zone between a 100-day and a 200-day moving average, that seems reasonable.
So the price of the story is where you're focused. There'll be a lot of people obsessed with asymmetries. They always are. When you think about how this market is more sensitive, is it more sensitive now to better data or worse data? How do you think the setup will sort of play going into next week, which is a big week for economic data?
Well, I think we have reset this quite a bit. If you would have asked me this probably a week or two ago, I would have said, definitely, we're more sensitive to worse data, because that was, by the way, one of the things we worried about in the beginning of July, this disconnect between the elevated earnings expectations and the economy that was clearly slowing. But now that the economic surprise index has been negative for months, and now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises. And by the way, we might see that, maybe not from retail sales necessarily next week. They're expected to be pretty sluggish. We might see that from the payrolls data going forward. I mean, there are a lot of opinions out there, but if you look at the numbers, the 4.3% unemployment rate, a lot of that has to do with new entrants into the labor force, the immigration that has occurred. But specifically in July, it's the pop in temporary layoffs. I do think that some of that may actually reverse, and there are estimates out there that look at what payroll creation might have been had it not been for Hurricane Beryl that hit Texas. So I think we are likely geared for that positive surprise in the coming months.
It's a blessing and a curse just listening to you talk of all of the data we have. We literally are swimming in it right now, not to mention that it's also earnings season. Yeah. And sure, the talk from the companies, some of it with the consumer has been a bit dour, as we've been discussing. Earnings growth is really strong. It's something like 10% for the quarter so far for the S&P 500. Globally, the best quarter in 8. How do you square all of that together?
Yeah, I think earnings growth, especially for non-Mag 7 companies, is actually surprising to the upside and is expected to pick up in the back half of the year. So I think that's, again, maybe the underappreciated story by the market. And look, I'm not in a recessionary camp. I'm in a soft landing camp. And I do actually think that some of the companies that are sensitive to interest rate cuts, like financials, like regional banks, like real estate, they may be benefiting from that as we progress through the year. So I would see some upside to the non-Mag 7 earnings picture.
So when you have a day like Monday where Mag 7 sells off, do you not touch it, or are those dips you'd want to buy?
I mean, most people are probably sufficiently overweight, or at least market weight the Mag 7. So I actually don't think that's the first place you look. What most people are underweight is either the defensive trade or the rotation trade. And I'm going to come back to semiconductors here in a minute. But I do think in an environment where the economy is slowing, we're not recessionary, but we are slowing. You want to step into sectors like utilities, for example. You want to buy bonds, specifically municipal bonds, if you're a higher income consumer. You want to buy the rotation trades like real estate and regional banks, because I think people started that rotation. It was sort of short-circuited, but I think it's the right place to be if the Fed is cutting rates. And that brings me back to semiconductors. People are probably sufficiently overweight semiconductors, but if you look at the pullback in valuations, we're not quite, but we're getting close to the lows that we've seen in the last year. And the earnings expectations for AI semis in particular are still going up. So I think that's a great setup.
You mentioned utilities. Is it back to being a bearish play or defensive play? Because at one point it was an AI trade.
No, it's definitely a defensive trade at this point. And I mean, let's not forget there's absolutely still the potential for AI upside, and the fact that we need to almost double our electricity generation capacity in order to service the data center and the AI opportunity. But no, it is back to being the defensive trade. It's the fact that it does have a yield that is higher than the market. It's the fact that it does have economic resiliency. And when we look at how utilities in particular have performed, they've held up better than most sectors going into the first rate cut and coming out of it in the 3 to 6 months period after that. So I think a lot of people are paying attention to that. And look, this is a two-way market now. I think there's risk to the upside and the downside, and that's why I think a lot of investors are looking at this barbell approach of defensives plus some risk.
John and Danny earlier in the program are talking about how good news feels like good news and bad news feels like bad news. But you said earlier, if we get a good employment report, would that mean bad news for this market? Potentially, some people will say maybe that irks the Fed a little bit?
No, I don't think so, because that brings us to the second part of the mandate, which of course is inflation, and we're looking for the CPI number next week to come in at 3.2% on the core CPI inflation. So as long as that inflation trend is intact, which is still gradual progress towards 2%, if we get a somewhat stronger labor market, I don't think that negates it. Look, the Fed really realizes right now that the real interest rates are high. They're tight, and so with the economy that's generally speaking slowing, they do have a lot of room to cut interest rates, so why not start a little bit? Is it 50 basis points for several consecutive meetings? I don't think we can make that call right now, but I think the start of the rate cutting cycle, regardless of jobs, is here.
We're certainly getting closer, that's for sure. Anastasia, thank you. It's good to see you as always. Thank you. Anastasia Amoroso of iCapital. Equity futures doing okay this morning. No real drama on the S&P 500 up by 0.2%. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Japan has issued its first ever mega quake alert after a 7.1 magnitude earthquake occurred off its southern coast. Several injuries have been reported in addition to limited damage to buildings. Right now, the country's bullet trains are running at reduced speeds, and some semiconductor factories have halted production. And Prime Minister Kishida called off a planned trip to Central Asia as a precaution following the warning. The government is not urging evacuations, but is advising citizens to be prepared that major earthquakes could continue. Several towns in western Russia have been evacuated after an attack by Ukrainian drones on a military airfield sparked a fire. State media reported that 9 people were injured and public transport was halted in one city, home to nearly 500,000 residents. It's part of what's become a nearly week-long advance into western Russia by the Ukrainian army, with troops reported 22 miles deep into Russian territory. And Donald Trump and Kamala Harris appear to settle on at least one presidential debate, with both candidates agreeing to meet on September 10th in a debate hosted by ABC. Trump said he had also agreed to debates on Fox News, and NBC. According to an anonymous campaign official Bloomberg spoke to, Harris will not agree to the Fox News debate and will only agree to future debates if Trump shows up to the ABC one. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, Fed Chair Donald Trump.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Can you imagine? That conversation up next from New York City. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup.
This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, welcome to the program. A calmer tape for you this morning. Equity futures up by just 0.2%. Euro dollar totally unchanged. Similar price action on dollar yen. If you're interested, we're going basically nowhere. 147 negative on that currency pair by about 0.1%. Bit of firmness, richness coming back into the bond market. Yields lower by 4 basis points. The 10-year about 394.74. Under surveillance this morning, Fed Chair Donald Trump.
The Federal Reserve is a very interesting thing, and it's sort of gotten it wrong a lot. He's tending to be a little bit late on things. I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
So here's the latest. Donald Trump using a Mar-a-Lago news conference to express frustration at the Federal Reserve. The comments echoing a Wall Street Journal report back in April, saying that Trump's allies are drawing up plans to blunt the Fed's independence should he win a second term. A report that Trump's team has since pushed back on repeatedly. Joining us now to discuss is Republican Congressman French Hill of Arkansas. Congressman, I'm going to start with a really dangerous question. What is the former president talking about?
Well, Jonathan, great to be with you. I think every president in the modern era has certainly criticized the Fed and lashed out at trying to have more control over the Fed. But since World War II, having Fed independence is important. We want to try to have price stability. That's their mission. I wish they focused only on price stability, but nonetheless, that's their mission. And over my time in public life, I've seen presidents try to influence the Fed through moral suasion by calling them over to the Oval Office, like Jim Baker and Ronald Reagan with Alan Greenspan for the 1984 election year. But the bottom line is the Fed can have its chairman appointed by the president. The Senate confirms that position. The House and Senate conduct major oversight over the operation. The Fed. So there is political tension there.
Congressman, we heard from Jared Bernstein, of course, from the White House, the chair of the White House Council of Economic Advisors. He tweeted this yesterday saying, history could not be clearer regarding the lasting and damaging inflationary consequences of ignoring this lesson of reversing the hard-earned progress of the past half-century. So you agree with the White House that the Fed should remain completely independent?
Well, I agree with the record of history that the Fed should be independent. That's a central bank tenet, that the Fed should generally, the central bank of a country should be independent of the fiscal authority or the legislative branch to protect price stability. And as I say, since World War II, when we had actually Treasury representation on the Fed board, that's been done informally through the appointment process to make sure the president's pleased with whoever the chair is, and the Senate confirmation process. And there have been times during tension where there's been White House meetings with Fed chairs or White House influence. Richard Nixon famously trying to influence Arthur Burns during the 1972 election cycle, the Jim Baker and Ronald Reagan anecdote that I just mentioned. But structurally, it's maintained its independence, and I think that's important.
So let's talk about some of the Fed policy. When the former president was talking about this yesterday, that he would potentially have a better gut feeling on what interest rates should be, he said that he, Chair Powell, tends to be a little bit late on things. He gets things a little bit too early and a little too late. And he says he would have this feeling that potentially he'd be a better Fed chair because of that. Do you agree with where the Fed is right now? Or do you think they should be cutting? And if so, do you think it'll be political for them to take this cut in September?
Well, Chairman Powell says they're data dependent. I think that's good. But I think the way to avoid these kinds of fights without much assurance of what direction or the other is to have a rules-based monetary policy. The so-called John Taylor rule from Stanford University. John and I worked together on the White House staff in the 90s. The so-called Taylor rule would make a range of mathematical recommendations on the targeting of short rates by the Fed, as opposed to it being just a group of individuals on the Board of Governors deciding that, or as Jim Grant refers to it, the PhD standard. We would actually have a rules-based standard. Some others want to go back to a gold standard, but a rules-based standard would have a range of guidance to the Fed of when to cut and how much to cut. And that would take some of this instinct out of it.
So, Congressman, given that, and this is a criticism other people have said, that the Fed needs more of a framework. They don't have a reliable framework at this moment. Do you think that's something that should be mandated in for the Fed? Would you like to see something along those lines?
I would like to see a rules-based framework. And when Chairman Powell was before the committee a few weeks ago, I asked him the status of their reassessment of their very famous decision in August of 2020 in the middle of a pandemic to just let inflation run a little hotter than 2%, knowing that they could rein it in, which I think is a strong presumption that I don't know that's based in fact, as we've witnessed since 2021. So I think that is an opportunity for the Fed to reassess using a rules-based framework for their monetary policy.
Congressman, since we last spoke, this race has changed a lot, particularly in the last month. Can you talk to me about how you see things evolving right now? When it comes to the issues, I think the impression that a lot of people have that are coming on this program right now is that we're not really talking about those so much. It feels like we're talking about the enthusiasm, the vibes, and the improvement that we're seeing on the Democratic ticket since the sitting president dropped out of the race. When it comes to the issues, I know that you're very, very focused still, Congressman, on immigration. Can you walk us through the things that you're concerned about? And do you think the former president is doing a decent job of prosecuting the case?
Well, first, let's start there. I think to win this election, it's a great opportunity for President Trump to be reelected. I think his policies are much more in alignment of my views are on the economy and national security, and particularly border security. But we've got to stay focused on the issues and get off some of the personalities here. Let's focus on the issues, and I think if President Trump and his vice president nominee, J.D. Vance, focus on the issues of national security, the border, community policing, inflation, they win, and they win hands down. On the border, what I'm the most concerned about by the horrible Biden policy of an open border is not just the millions of people he's allowed in the country that we don't have a full instinct of what to do about or how to handle it, and swamping our border patrol system, but the number of terrorists, people on the terror watch lists that are in this country. And we've asked Chairman Turner of the Intelligence Committee, Chairman Green of the Homeland Security, and I have persistently for months asked for this administration and the FBI and Homeland Security to tell us where these people encountered on the terror watch list are in this country. What has happened to them? And when you think about millions of gotaways, how many more people are in the country that we don't know about, that we did not encounter? I find this very concerning in light of the Pakistani comments about the Trump assassination attempt, the continuing documented Iranian influence in the country on assassinations, and the recent Philadelphia discovery of a ISIS-K network that was operating in the country, having come across our open border.
Congressman, if you're so concerned about the border, why did the Republicans then ditch this idea of the legislation that was circulating, starting in the Senate with Lankford, when it came to border security?
Well, first, we passed H.R. 2, which is the preferred approach for House Republicans on both immigration reform and border security. We got it passed. We sent it to the Senate. There was no action on it. Senator Lankford did good work trying to find consensus in the Senate. But look, he was still facilitating thousands of people, undocumented people, coming in the border. He was not taking the concrete steps that we put in H.R. 2. So I think, Anne-Marie, that was the key difference for Speaker Johnson, for House Republicans. And that's why that bill did not proceed in the Senate.
Congressman, we have to do this more often, sir. It's good to catch up. And
Great
I promise,
to be with you.
I say this every single year. Razorbacks football, we're going to make it happen this winter, okay? Going to make it happen. All right? Thank you, sir. Congressman French Hill of Arkansas, on the latest in this race. The thoughts on the Federal Reserve there? I think we need to pick up on that. Could we see some real changes here?
Well, I think when you hear French Hill talking about this, he basically says, historically, we do know that the Fed has to remain independent. So basically, he agrees with the White House there, but he thinks the Fed should be more focused on inflation right now.
Yeah, and talking about this idea that there needs to be more of like a rules-based framework for them, I think a lot of people would agree. A lot of people have looked what Powell has done. You hear this criticism come up. He's not an economist. He's a lawyer. He doesn't have a clear direction where he wants to go. I think it'd be interesting if they mandated something like that, because I think a lot of people like the flexibility of the Fed. So having a clear framework versus mandating, that is two very different conversations.
It's hard to predict things at the moment, but I will predict this. Chairman Powell won't address any of this in Jackson Hole in that press conference, or rather that address that we get from him in a couple of weeks' time. That's my prediction. That's the only prediction that I can offer at the moment, given how quickly things have changed. Equity markets right now in the S&P 500 shaping up as follows. We're just about positive by 0.1%. Up next on the program, we'll dig deeper into the booming obesity drug market. We'll catch up with Deborah Netshirt of Jennison Associates on why the growth is only getting started. That conversation just around the corner. From New York, this is Bloomberg.
The top names in business are on Bloomberg.
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still, and forget AI. I need a basic technology adoption.
Nobody covers business like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
2 hours away from the opening bell, your scores look like this. The S&P totally unchanged. After some major volatility over the last few days, we're going nowhere. On the NASDAQ 100, we're positive by 0.04%. On the Russell, just a little bit of a lift, up by 0.25%. If you switch up the board, turn the page and push into the bond market, let's sit at the front end of the curve. The 2 years been all over the place, massive range, huge range, something like 40 basis points on the week so far from the lows of Monday to where we are at the moment. 4.03% is where the 2 year is. Yields going nowhere there. Coming in just a touch on a 10-year. We're down about 3 basis points, 395, just in and around 4% to end the week, with some encouraging data. Encouraging, Danny, relative to the doom and gloom of Friday coming into Monday.
I think it's important we look at what that encouraging data is and how much we can get from it. Just as a whole thing, jobless claims have very low statistical significance. I mean, this is a really noisy piece of data, and even just looking at this one, the expectation was for 240,000. We were less by 7,000 people. 7,000 people in the entirety of America did not file for jobless claims, and we decided that the recession was over.
Yeah, basically, and moved on very quickly, and we're going to do it all over again next week. So if you don't like it, I don't know what to say. Jobless claims next Thursday. We're going to do it again. We said it yesterday. It was amazing to see how much weight people were putting on weekly payrolls, on weekly jobless claims. And it was treated as if it was the new payrolls Friday, jobless claims Thursday. Do you think that's going to be the case next week if things calm down enough to say that's not the story next week?
Well, the thing I'm concerned about is whether this is, we're searching for a new paradigm. We don't know where we are yet. Basically, the tails keep fluctuating and how much we care about them. So in that sort of environment, you get a really volatile market on every data point. Or is this just the summer? Or is it just because it's August and not a lot of people here and liquidity is really bad and so we're swinging around a lot? I think it's hard to distinguish between the two at this very moment.
Neil Dutt's taken a big step back, and I think we've all had to do that repeatedly through this week. I've lost count of how many times I've said that. Let's take a big step back. But let's take a big step back. Are things getting worse or better? And Neil Dutt of Ranmax suggesting things are getting worse. He actually said this. He put this out in the note yesterday, and I thought this was important. The economy is more or less operating at the Fed's year-end 25 expectations over a year ahead of schedule. But the federal funds rate stands over a full percentage point higher at the moment relative to the SEP estimate. Now, we'll get an update to the SEP in September, and maybe we close that gap. But that's a suggestion from Neil, like a suggestion we had from Bill Dudley, the former New York Fed president, earlier this week on this show, that this Fed, if it's offside, it might be offside by anywhere up to 100 basis points plus, depending on whose opinion you trust.
And that's why you get the commentary that they should be cutting 50 basis points, because they are so behind and they can catch up if they are willing. That is the big point of this, that even though the market's ahead of them, the Fed feels so far away from this conversation. Susan Collins, again, talking about this morning, that she's still looking at inflation, that in order for them to cut, inflation needs to come down. The market has completely moved on from that conversation. It's moved on to employment, and the Fed continues to stay. We have more time, and there is no rush.
The dollar yen has moved on just a little bit as well. 147 on that currency pair, negative here by 0.1%, which means we can move move on from Dolly Yen, at least for this morning, for this hour, for the next 5 minutes. Under surveillance this morning, Donald Trump and Kamala Harris setting on at least one presidential debate. The candidates agreeing to a September 10 meeting on ABC, with Trump offering further debates on Fox News and NBC. Bloomberg reporting Harris will decline the Fox event and only agree to other debates if Trump actually shows up on September 10th. So are we still debating about the debate, or have we moved on?
Well, both. We're not debating about the September 10th ABC debate that Trump had backed away from because he said he agreed to it with Biden, and now the Democratic Party flipped up their ticket. So he's back on for that debate. But he's saying that we need more debates. He already debated Biden. He's now going to debate Harris. So he wants two more, one on Fox News, one on NBC. And what we're reporting is that Harris does not want to go into the Fox News territory, but potentially after September 10th, maybe they could, goad her into another one.
Brett Baer's a pretty down-the-middle anchor. What are they worried about?
Not quite sure. And she's going to be president of the United States. It's going to be much more challenging people on the other side of the table, like autocrats, like dictators, than Brett Baer.
If she's got the momentum right now, which I guess she means she thinks she can pick and choose. And Donald Trump in that campaign is trying to put pressure on the media, to put pressure on her to do more debates and more interviews. I found the language yesterday really quite vague. Have they agreed to an interview? Are they going to agree to an interview before the end of the month? Or are they just saying we'll schedule one before the end of the month, which could mean we get one after the end of the month?
I think they can, what she said is they're going to be there. She told her team she wants to schedule something, get in the books before the end of the month. Does that mean the scheduling is being done before the end of the month or the interview is being done before the end of the month? It was unclear to me. So clearly they are feeling some pressure, though, from the press corps, from the Republicans, like J.D. Vance going over to her press corps saying, why is she not answering any questions? As a journalist, obviously, I want more debates. I want more interviews. Sure. I want to understand policy. But you have to think, if you're a political strategist, why would you not just take every win you are getting if you are Kamala Harris, show up to the events where you know what you're going to say, the crowds are cheering for you, and you don't have to answer any policy questions?
Let's see how long it lasts. It's working right now, that's for sure. I'd like to bring you an update on the latest in the Middle East. The United States, Qatar and Egypt calling for a new round of ceasefire talks in Gaza. Israel saying it will send a delegation to the talks next week, while there was no response from Hamas. The US saying a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. And this is the problem for a lot of people like us from the outside looking in. It's like these two opposing thoughts simultaneously at any given one time. The prospect that this war could escalate, could spread across the region at the same time as the prospect of a ceasefire. Altogether, currently that's the focus.
Well, that's why potentially you see the White House putting a lot of urgency on this ceasefire agreement, because if they were to get this over the finish line, potentially it holds back Lebanese Hezbollah and Iran from retaliating against the assassination of the Hamas leader. That is potentially one reason why we can see this urgency. I got on a call with a U.S. official yesterday following this for some background, because it was kind of weird coming from Sisi, coming from Sheikh of Qatar, coming from Joe Biden saying they've agreed on this date, August 15th. But that date is just to sit at the table to talk about these gaps that remain. Doesn't mean that next Thursday we're getting a deal.
That's the latest on geopolitics. Let's just take a beat and take a moment to get you up to speed on some sector news, some individual name news. Paramount joining Warner Brothers in running down the value of its TV networks. Yet another sign of weakness in the traditional TV industry. The company seeing sales at its TV networks fall 17%, while the company's streaming business posted its first ever quarterly profit. And that's why the stock is up in a pre-market by something like 5.6%. As we turn to healthcare, Eli Lilly posting its best day in a year after edging ahead of rival Novo in the race to dominate the booming obesity drug market. Deborah Netshirt of Genesis expecting the growth to continue for Lilly, writing this: thanks to a significant ramp up in manufacturing capacity, uptake is going to increase dramatically in 2026 to 28. This will translate into significant sales and earnings acceleration. Deborah's joining us now to walk us through all of this and expand and give us detail, Deborah, in a way that I think we've been lacking over the last few weeks or so. Welcome to the program. I think for many people, and I'll speak for myself, when it comes to Novo versus Lilly, I don't know what the difference is, what the drugs are, and what the real distinction is between the two companies is, Deborah. Can you help us with that? What is the distinction between those two firms and the treatments and the drugs that they're putting out to market?
Sure. Well, thank you very much for having me. It really does feel like they are part of the same conversation lately and thought about as one company, doesn't it? So Lilly is, we'll start with Lilly. Lilly is a little bit more of a diverse company than Novo. They have a huge business in diabetes and obesity, as we've talked about, and as everyone knows, but they also have been incredibly successful in oncology and immunology, and are just launching a new drug for Alzheimer's. But because of the sheer size of the diabetes and obesity business, a lot of the rest of Lilly does not get talked about. The main drugs for Lilly are Zepbound and Mounjaro. Zepbound is marketed for obesity, whereas Mounjaro is marketed for diabetes. Novo is a little bit more of a diabetes pure play. They've had a long tenure in diabetes with a big insulin business turning to the GLPs. They have Ozempic for diabetes. They have Rybelsus, and then they also have Wegovy, which is their obesity drug.
Deborah, I want to understand the difference between those obesity drugs themselves. For example, one of the big criticisms of Novo was you have this drug that comes out and it allows people to lose weight, but you have a problem where people are losing muscle mass, that in a way they're almost becoming less healthy because of that. Who's at the forefront of addressing that issue?
Well, I think the jury is out whether or not the muscle mass is really an issue right now. We need longer term data on obesity, which we don't yet have. I think the one thing that you should think about is we at Jennison really focus on the long term. And if you look at the long term data from diabetes, we're not seeing any adverse events related to this difference between muscle and fat loss. So I think we just need a little bit more time and a little bit more data to see whether or not this is a long-term issue with these drugs.
And in the meantime, I mean, the adoption and even just the addressable market for these drugs, Deborah, is really big. Since the 1970s, the United States has had an uptrend in obesity rates. Are we about to witness a wholesale societal shift where for the first time really since the Great Depression that obesity rates are going to start to fall?
It would be really great if we could see that, because there is such a large downstream effect of obesity on other body systems. One of the most interesting things about the GLPs is just the number of different diseases that they are having an impact on. So we've seen a positive cardiovascular risk reduction in morbidity and mortality. We've seen an impact on liver disease called MASH. We've seen positive impacts on sleep apnea. We've seen positive impacts on kidney disease and other types of cardiovascular diseases. So hopefully as time goes on and these GLPs are adopted, we'll see this downstream effect take place. I think the thing to focus on is since the obesity meds have come out, we've really been supply constrained. And both Lilly and Novo have made really positive strides on supply and are going to be exiting 2024 with significantly more supply than they've ever had before.
There's been a ton of enthusiasm, but you say utilization isn't even close in terms of percentage of these drugs in the market. Where do you see this going in terms of percentage of, the next 5-10 years?
I mean, significantly higher than we are now. We're really still only in the single digits when you think about obesity. So we have a long way to go.
There's a lot of people, Deborah, as you know, trying to develop second derivative trades around this story. And I just wonder, for you and the team, what the process is that you go through to develop those kind of trades. I can tell you from our perspective on this program, we've had everyone from talking about the snack business all the way through to the airline business and talking about the savings on fuel costs of all things, Deborah, if the average passenger loses some weight. How are you thinking about those second derivative trades?
Well, when we think about the second derivative trades, we're really focused on looking at drugs that can actually move the puck forward, not really be similar to where we are now. The obesity market, we believe, is going to be incredibly different and segregated in lots of different ways in 10 to 15 years from now. And by that I mean there's going to be different types of drugs and different types of administration profiles and duration and timelines in which you take the drug for people that need to lose different amounts of weight. So there will be a lot more options if you need to lose 25% of your body weight or 10% of your body weight, there's going to be a drug for you. There's also going to be a lot of combination drugs for patients who have comorbid conditions. So we're really paying attention to companies that are going to be able to move the puck forward and find a differentiation. The thing that's really interesting is even Lilly, when they were on their second quarter call yesterday, talking about the amount of R&D that they are doing, that Novo's doing, they haven't stopped with these neither of these companies have stopped with developing drugs and R&D. They are still pedal to the metal to try to develop the next best thing. If you look at what's happened with supply and just the sheer number of clinical trials, a newcomer coming into this market is going to need to spend a significant amount of money on both R&D and manufacturing to really play. So it's not only about, can you develop a drug that has weight loss that is better? It's what else does this drug do? How is it different than what we have? Is it more tolerable? Is the administration profile more favorable? And then also, can you develop a really broad phase 3 program and afford to develop a really broad phase 3 program to demonstrate efficacy across as many diseases as both Lilly and Novo have and are continuing to? And then can you build manufacturing and scale it up and build supply to really be able to be a meaningful entrant in this market?
Yeah, that's not easy at all. Deborah, appreciate your time. I'm pleased we got to make this happen. I have no doubt we'll be talking again soon. Deborah Netschert there of Jennison Associates. BMI is an imperfect measure of things. It's just height relative to weight. We all know that. Standard definition of obesity is a BMI over 30. More than a third of Americans have a BMI over 30. I think we know the addressable market here is absolutely massive. What I heard there at the end is how difficult it will be for others to compete. And when we talk about winners, particularly in places like AI, we're talking about a handful of names potentially. It feels the same way in this sector as well.
That's literally exactly what I was thinking, that the innovation economy has gotten to which in the US that the things we're trying to address take huge amounts of spend, take huge amounts of research. And I think if you're an investor, for example, looking at this market saying, how do I play this? How do I play innovation? You keep going to the same names. And there's a reason behind that. And it's in order to keep spending, you have to have the cash to do it. And if you're just a pull yourself up by your bootstrap startup, you can't do that anymore.
It's why Novo quickly became the biggest company over in Europe. That's the latest on this front. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Microsoft said a group of hackers linked to the Iranian government tried to breach email accounts of presidential campaign staffers as part of a wider effort to gain intelligence ahead of the U.S. election. The company revealing attackers linked to the Islamic Revolutionary compromised email address from a former political advisor in a phishing attempt on a high-ranking campaign official. It follows a warning from U.S. intelligence officials last month that Russia, China, and Iran were recruiting people in the U.S. to spread propaganda. Iran has denied that allegation. China has a new richest man as its thriving e-commerce sector continues to gain ground around the world. Temu founder CEO Kellen Wang's net worth climbing to $48.6 billion, pulling ahead of bottled water mogul Zhang Shangshan. The 44-year-old staggering rise has been fueled by China's changing shopping habits and what's been referred to as a trade loophole, allowing Temu's small packages to enter the U.S. duty-free. And U.S. track star Noah Lyles took bronze in the 200-meter before announcing he tested positive for coronavirus, ending his Olympic run. Team USA also making a comeback against Serbia in men's basketball. Steph Curry helped push the team to the gold medal game against France. As for the medal count, the U.S. continues to lead in gold medals and total medals, followed by China and Australia. That's your Bloomberg Brief. John?
Massive game Saturday afternoon. Yahara, thanks for that. Up next on the programme, the bullish case for bonds.
The consensus positioning was for a bearish steepening. I look at it now and I wonder, where's all that gone? The next move in rates is unambiguously down. The question is how much?
We'll get into that question up next from New York. This is Bloomberg TV.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife.
You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
With 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Equity's just about okay, slightly negative, rolling over in the last 10 minutes or so, but no real drama here. We're down almost 1/10 of 1% on the S&P. The rally in bonds picks up again. We're down about 4 or 5 basis points on a 10-year, 394.17. Under surveillance this morning, the bullish case for bonds.
1 month ago, we were talking about reflation trades and various scenarios around the election, and the consensus positioning was for a bearish steepening. I look at it now and I wonder, where's all that gone? The next move in rates is unambiguously down. The question is how much. The market tends to lead the Fed, and I think you're seeing validation of that now.
So here's the latest. Treasury yields lower after a wild week of swings. Megan Swiber of Bank of America writing the following. We revised lower our 10-year rates forecast from 4.25 to 3.75 by the end of the year, and now expect a greater degree of curve steepening. Megan joins us now for more. So Megan, let's follow that. Welcome to the program. If you're looking for the 10-year yield to drop, say, 20 basis points from where we are currently, where does that curve steepening come from? How much of a move are you looking for at the front end of the curve?
So, John, when we look at how the curve evolves historically, when we get these much bigger steepening moves on the yield curve, it happens when we observe a notable uptick in the unemployment rate, when we're looking at scenarios around harder landing. So, indeed, we are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent.
When I hear a 10-year yield is coming lower, and then I also hear steepening, I'm thinking, well, it must be coming from a bull steepener, right? You must be looking for an aggressive move at the front end. And the next step of my thinking is, well, you must be looking for a big move from the Federal Reserve. Is that not right?
Not exactly, John. So our house case at B of A is that the Fed will deliver 2 25 basis point cuts this year. So that is pretty well below what we see a lot of economists on the sell side calling for. And at some points this week, less than half of what we saw the market pricing in terms of the degree of cuts. So we can be looking at seeing the curve steepening evolve. But what we're going to see a challenging environment for right now as well is thinking about the supply picture at the back end of the curve. Deficits are really only going one way. So a lot of the curve steepening that we're anticipating is not so much coming from the bull case for rates notably falling, but seeing more of the steepening pressure coming from the 10s, 30s part of the yield curve.
Interesting.
So, I mean, in that, you could say maybe this week was evidence for that. You get a 10-year and a 30-year auction, and both of them don't go well. Yes. Do you think that was behind it, or was it just, we kind of added a lot of bonds leading up to it? So I think it's kind of twofold. What we saw really from a number of different investors was everyone was very much so calibrated in the soft landing camp. And what's involved in that is looking at trading 10s within this range of 4.50. The data that we got last week, the payrolls data, generally the more sentiment data pointing to this picture of maybe there are some risks here around this soft landing, caused a pretty decent bid for duration. So people came into the market and said, well, maybe this 4% level is not the low that we can get on 10s. Perhaps we can see duration really outperform more so.
So we had a very strong flight to Treasuries, the global risk-free asset class, the end of this week and the end of last week and start of this week. And we saw a little bit of a lightening up, I think, in terms of that conviction and duration on some of the more positive data that we're seeing come in. A bit of a whiplash here for rates market.
Okay, so when does the supply picture come back in then? When do we start worrying, and when do we get more auctions like we did this week?
So this is the tricky dynamic here, right? When we have greater conviction in the harder landing outcome, there's no absence of demand for Treasury securities. As I mentioned, right, Treasuries play this incredibly important risk-off role in portfolio allocation. When we're thinking traditionally about what insulates us from large equity drawdowns, it's nominal Treasury rates, right? But if we now settle into more of this soft landing probability, that demand becomes a lot more conditional on the yield levels that we're thinking about. And the very important question there, too, is what rate level is the Fed going to cut to at the end of the day? We had the market pricing Fed getting to below 3% this week. That's well below what we're expecting from our house call at B of A.
Can we sit on supply just a little bit longer?
Please.
We have noticed this shift since last November to a lot of T-bills.
Yes, yes.
What's your expectation now for what issuance will look like, where they'll sit across the curve, where they'll push all that issuance out in the next 18 months or so at Treasury?
So we heard refunding that Treasury is now thinking about considering this higher bill share going forward. So TBAC, which is the group that advises Treasury on its issuance strategy, had previously been saying, Treasury, you want to target between 15 and 20% of bills. But what we've seen, and you talk to retail investors, you talk to a variety of different clients, everyone wants to still be in bills. Everyone has increased their bill holding share. We still see very strong inflows into money market mutual funds, and why wouldn't you? Because that's the point in the yield curve that is still yielding the highest. So Treasury right now has recalibrated this. TBAC has said, look, we can see this bill share remaining above 20%. So on a go-forward basis, Treasury is saying, well, bills are elevated right now versus what we've been looking at relative to longer-term history, but they have an appetite to keep that bill share higher. That doesn't mean that they're not going to grow coupon supply again at some time, right? We are absolutely seeing expectations for deficits come up through fiscal year 2026. Certainly election risks around deficits coming in even higher. But right now, Treasury is saying we're going to be tactical with our issuance strategy. We don't want to oversupply the duration component.
Just before you go, so I've got this number in mind for next time. Where do you see the 30-year yield in the next 12 months?
So we do see 30-year yields relatively range-bound to what we're looking for. So it really is, John, more of this story for greater potential and appetite for the rest of the yield curve to rally relative to the 30-year part of the curve. Generally because that's where we're going to see the greatest demand for duration coming from. To buy the 30-year part of the curve, you really are thinking about pensions, much longer-term investors. And we have this interesting thing in the rates market where when yields go down, the funded status of a lot of these pensions also go down, and they don't have that same appetite to buy longer-term duration.
Megan, this was awesome. So range bound at the longer end, everything else rallies a little bit, steeper curve.
Exactly.
Perfect. Megan Swiper at Bank of America. If only it was that easy, of course, but that's the expectation. Coming up, Binky Chara at Deutsche Bank, George Ferguson of Bloomberg Intelligence, David Miracle of Goldman Sachs, and Dirk Weiler of Citi. All of that still to come. The third hour of Bloomberg Surveillance up next.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant one bite at a time?
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you
Secured overnight financing rate 5.34% for August the 8th versus 5.33% for August the 7th.
Managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago.
The labour market deterioration, if it continues, well, then that could feed and create a downward spiral.
We think the Fed right now is pretty far behind. It's at a very restrictive level right now.
They are ridiculously behind the curve, irrespective of what the capital markets are doing.
The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The Bears have loved this, haven't they, over the last week? They've absolutely loved it. Let's see if they've got anything else to love over the next few months or so, but they're loving it at the moment, that's for sure. Equity futures on the S&P 500, totally unchanged. Let's get you to the weekend with futures going nowhere on the NASDAQ and likewise on the Russell. Looking ahead to the opening bell about 90 minutes away. We're already looking ahead to the month ahead. PPI next week, CPI after that, retail sales. Next week's absolutely packed, and then it's on to Jackson Hole with Chairman Powell addressing not just Jackson Hole, Wyoming, not just this country, but I think the world as well, Danny. Addressing global markets at a time when Fed officials, I have to say, do not look like they are scared, worried, do not sense urgency and need to move quickly. Never mind 50, they're still talking about whether to go 25.
Well, I'll tell you one crowd he's certainly addressing is the Bank of Japan, whether he means to or not. You know that Ueda, the deputy governor, all of them are going to be listening with bated breath to see what happens. But yeah, the Fed has a different conversation going on. They are still talking about this idea that they have more time, that the labor market, it's only that people are not hiring, it's not people being let go, and that gives them time. That gives them time to wait. The concern is if you're waiting, are you too late by the time that layoff starts?
The good news for the Fed is that they don't have to mark to market every day. If they did, this would be even more wilder, even more vicious, even more volatility than we've already had. If you take stock of the data, though, it's like a tale of two different weeks, two very different weeks. Manufacturing last week, some payrolls data data, really soft. Services this week, some jobless claims data, much firmer. How balanced are things right now?
Well, the issue is, though, when you look at the services data underneath the hood, if you look at what companies are actually saying, they're pretty much saying it's normal. It's not great, it's just leveling out. And they also talk about how there are some concerns when it comes to these companies about how some consumers are waiting on the sideline until after the U.S. election. And then you hear what the earnings calls are talking about. And you do hear corporations say that they are seeing consumers pull back a little bit or trade down. And I was struck this week with the Disney CFO said to us, well, they're not traveling right now, but we think they're going to come back to us.
Paul Donovan of UBS, I think, put it quite well, made it very, very simple. When it comes to unemployment, if you start to fear unemployment, you start to behave very differently. And there are a range of opinions out there about where we are in that process right now. Paul has taken a much more constructive view of things. Others think that process has already started. That fear is starting to set in. People will pull back. Companies are identifying that. Once companies identify that, they go to protect margins. When they do that, cut costs, and then you cut labor, so on and so forth. Have we started that process yet?
Well, margins, certainly, you feel the pressure from companies. And to your point, that's when you start looking at cutting, even if we're just in a scenario where people can't get a job at the moment. And that's the thing. That is something that does slowly grind at sentiment. If you're jobless right now and you can't find a new job, that of course will hit your sentiment. It's kind of the whole like frog in the boiling pot. Are we just starting to turn up the temperature? And it will start to boil at some point.
The heat going up just a little bit more in the last month or so, that's for sure. Equity futures on the S&P then pulling back by 0.1%. I said things were pretty stable out there. The bond market's running a touch. We're down 4 or 5 basis points on a 10-year at 394. On dollar yen at the moment, going nowhere. Goes somewhere, but basically nowhere. We're down 0.2% on dollar yen at 146.94. Coming up on the programme, we'll catch up with Binky Charter at Deutsche Bank as stocks rally on easing labour market concerns. David Miracle of Goldman Sachs on the odds of a US recession, and Dirk Weiler of Citi saying don't blame the carry trade. We'll get into that in a moment. We begin with our top story, the big issue, the S&P 500 leaving behind a week of volatility and looking to build on its best day since 22. Binky Charter of Deutsche Bank staying focused on the earnings and remaining positive. Growth for the median company has continued to pick up, indicating a broadening out across stocks. The gap in growth between mega cap growth and tech and the rest has shrunk. Binky joins us now for more. Binky, it's good to see you.
Yeah, good morning.
Walk me through what you expected from earnings season and whether things have played out more broadly as you expected.
Yeah, I'd say on the S&P 500, a little bit weaker than we expected, but you know, what we expected is not always the most important thing. If you look at it from quarter to quarter, we've gone basically from an 11.5% year-on-year growth rate in the first quarter to 11%. So, I mean, earnings, you know, are volatile. Things don't move in straight lines. So I would say overall, you know, growth momentum is basically hanging in. And, you know, one thing to keep in mind about that 11% is that it's actually, you know, it's average growth outside of recession. So it's neither high nor low is the way that I would put it. I would say much more important is basically what's been happening under the hood. Yep. So coming into earnings, you know, we have an equity market that is basically positioned very, very long, coming entirely from overweight positioning in mega cap growth in tech, and average or below average, which means underweight positioning in the rest of the S&P 500. Now, positioning tends to follow and tends to align basically with earnings. And if you look at positioning for the mega cap growth in tech stocks, you know, market was essentially positioned for rip-roaring earnings growth to continue. So keep in mind that the fourth quarter of last year, we had 40% growth. First quarter, we had 39% growth. So the market was really positioned for that to continue, if not accelerate. And we and the bottom-up consensus has been basically looking for a slowing in growth. And you know, so far, I mean, NVIDIA hasn't reported yet, but we have slowed from 38% to around 28-29%. So that's a pretty significant slowdown. While earnings growth for the S&P 500 has sort of hung in at 11%, despite this big slowing in growth coming from mega cap growth in tech. And if you look at the rest, earnings growth has picked up, but the pickup is modest. So the gap is shrinking, but most of the shrinking is happening from one side. our disappointment. What we were expecting was a slightly bigger acceleration in the rest. If you take the rest and you divide them into two, there's energy and materials, which is one of the reasons for why earnings growth has hung in, because we've just gone from minus 25% in the first quarter to minus 3 or 4%. We were looking for plus 5%. And for everybody else, you know, it's just kind of normal variation hanging in rather than any big pickup.
As you know, the last few months have been absolutely ridiculous. I think you only have to go back a few months when it was good news was bad news, because we were talking about the prospect of another interest rate hike from the Federal Reserve. That was a story of bad news is good news, and now that's switched on its head. We're in this more sort of like intuitive world where good news is good news and bad news is bad news. And I have to say, even over the last 6 weeks or so, Binky, let's go through it together. We've had a rotation at the expense of tech. We had a broadening out that included tech. Then we had this risk aversion driven by bad economic data. We had this other bout of risk aversion driven by the unwind of the carry trade.
Yeah.
What regime are we in right now? What is this?
I think, you know, the one thing to keep your eye on is all of this started basically with an equity market that was positioned very, very overweight, as I said, pretty lopsided. And you fast forward the tape at the end of this week, as of yesterday's close, positioning has gone basically from the tippy top of the Z-score band, close to +1, 96th, 97th percentile. Positioning has been cut to below average. The market is now underweight equities. And that, of course, you know, is very, very constructive for the market going forward. It does depend on the catalysts and the like. And again, going under the hood, it is positioning in mega cap growth and tech that has been cut. It's still on the high side, but it is aligned with the kind of 28, 29% earnings growth that we just got in Q1. So I would argue, you know, the fundamental reason basically for the pullback, which is positioning was too high relative to kind of earnings growth and, you know, the rotation that needed to happen, that driver looks like it's pretty much done. So now it does depend on what happens on all the other fronts that you mentioned, and I'm not going to list it.
Please don't. No one needs
it's
that.
only in 4 days, yeah.
Well, I mean, the thing people are talking about, like, oh, it's healthier now, right? Like, it's healthy that positioning on mega cap tech has come back. It's healthier that we finally have had some sort of drop in this equity market, that it's normal to have 5% drawdowns. But how healthy and normal is it to have the biggest company in the S&P 500, NVIDIA, one day lose $130 billion in market cap, and then the next day gain $150 in market cap? Is this a healthy market by that measure?
So you're going to have this issue whenever there's a new technology or, you know, something big is happening. So, I mean, if you just think about growth rates for companies, you know, the question is really how long is that cycle basically going to last? So yes, the earnings growth is slowing from 500%, but it's slowing to 400% and 300%. Those are, you know, unbelievable growth rates after they've slowed. So the market, you know, yes, I mean, we will have the volatility there because it changes the entire outlook depending on how you think about the cycle, basically.
We've been talking about all the data that's coming up next week in the road to Jackson Hole to hear from Jay Powell, but you mentioned NVIDIA. Is that actually the more important data point we should all be focused on, their earnings at the end of August?
So at the end of the day, you know, my view is the anchor for equities is earnings. We can deviate from time to time, but so earnings are absolutely, you know, very important, but we've gotten most of the earnings, so I don't really expect the broad picture to change very much
Binky,
as a result.
favorite sector right now, what is it? What do you like?
I like the financials and the consumer cyclicals. I would say financials, you know, still have to price in the new higher rates regime that, you know, we don't know what the probability is of going into recession, but I would put my money on the other side that we are not going there. Both of those are very supportive. We are at a point in the cycle, so this is a very, very, very unusual cycle, but you know, if you have a scorecard of the things that have happened and the things that need to happen still in a typical cycle. Now, loan growth hasn't picked up yet. It typically lags basically economic activity for a while, and I would say 2022, which was a while ago, you know, is still sort of playing a role. So we have basically loan growth yet to come.
Hang on a minute, just pause. Can I jump in?
Sure.
Just quickly. You think in this cycle, we're still due another pickup in loan growth?
Absolutely. It tends to follow economic activity, tends to overlay with the ISMs. Where are the ISMs? They're sub 50. It's one of the data points you mentioned. I would argue, it's totally in disconnect from 2.8% GDP growth in the last quarter. The Atlanta Fed, last time I looked yesterday, was at 2.9% for this quarter. Yeah, loan growth will come back. It is one of the aspects of the cycle that is still missing. Number two, I would say we just had 1 quarter of a pickup in CapEx, but typically in a cycle, you have a pickup in CapEx. I can go on. There is a long list of things that I would argue.
What I hear from you, Binky, is you think this cycle can continue.
Absolutely.
Much longer than people think.
Absolutely.
So what we've priced in...
Despite Monday's price action.
Well, let's talk about Monday. So we're pricing in aggressive action from the Federal Reserve. You want to fade that?
Yeah, I would fade that. And in my outlook for equities, it does not figure prominently, what the Fed does, one way or the other.
What's the price target now in the S&P for you, year-end?
We had a range coming into the year. We picked the top of the range is 5,500. We are still there. I think it's very possible that the S&P goes higher, basically. Year-end is a point in time. I would say we are still, in the midst, basically, of a pullback. If you think about the calendar, we have the presidential election coming up. The market tends to focus a month before, so that would be the first week of October relative to a typical first week of November election. We have, though, an important, and the equity market pulls back by 4 to 5% typically. Now, things have changed. We have early voting starting in a month, so does that change basically the issue? And of course, we have severe geopolitical risks in the Middle East, I would say, that we need to be watchful about. But both the election and geopolitical risks, the question is, are they going to alter the business cycle? And it only altering the business cycle would alter basically the path of equity. If you look historically, neither has done that most of the time.
A bullish take for you going into the weekend. Binky, it's good to see you. Thank you, sir.
Thank you.
Thank you. Binky Chanda there of Deutsche Bank. Futures just a little softer here. We're down 0.2%. The opening bow just around a corner. Let's take the opportunity. Let's take a beat and get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump and Kamala Harris appear to settle on at least one presidential debate, with both candidates agreeing to meet on September 10th in a debate hosted by ABC. Trump said he had also agreed to debates on Fox News and NBC, and according to an anonymous campaign official Bloomberg spoke to, Harris will not agree to the Fox News debate and will only agree to future debates if Trump shows up to the ABC one. Paramount Global saying it will cut about 15% of its workforce, amounting to about 2,000 jobs, as it prepares for its merger with Skydance Media, the parent company of Nickelodeon and MTV, reporting earnings that beat Wall Street estimates yesterday after the bell, after its streaming division, like Disney, swung to its first ever quarterly profit. But like Warner Brothers Discovery, Paramount took a second quarter impairment charge of $5.98 billion on its cable networks, marking another sign yet of weakness in traditional TV. And a large majority of economists see only a quarter-point decrease in interest rates coming in September. That's according to a Bloomberg survey. The finding is at odds with calls from some of Wall Street's biggest banks for a jumbo cut at the next Fed meeting. Nearly 4/5 of respondents predict the central bank will trim rates to a range of 5% to 5.25% at its September 18th decision, with most of the rest predicting a larger reduction. Fed officials have pushed back on the need for aggressive actions. That's your Bloomberg brief. John?
Yahara, thank you. We'll hear from Yahara one more time again in about 30 minutes' time. Next on the programme, we'll get you some morning calls as we count you down to the opening bell, about 1 hour and 14 minutes away. And we'll catch up with Bloomberg's George Ferguson as the new CEO of Boeing walks the production floor.
So seeing here Biden's senior advisor Hochstein speaking on CNBC, saying we will continue to replenish strategic oil reserve.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
As we get closer to the opening bell, we're pulling back just a little bit on the S&P 500, down a little more than 0.1%. In the bond market, yields continue to fall this morning, down by about 4 basis points, 394.55. If you want a dollar-yen check, not doing much. We're down about 0.2%. A slightly stronger Japanese yen, 146.94. That currency pair moving basically in line with the move we're seeing in risk elsewhere, particularly in equities. That correlation still sticks, but we're just not seeing a big move so far this morning. Let's get you some morning calls. BMO raising its price target on Eli Lilly up to 1,101, pointing to its exceptional leadership and recent expansion in manufacturing. That stock is up another 1.2%. Next up, Wolf Research upgrading Truist Financial to peer perform, saying the company is well positioned to benefit from changes in the macro environment. That stock is down by about 0.6%. And your third and final call from Morgan Stanley, upgrading General Dynamics to overweight, highlighting its impressive balance sheet and strengthening demand for defensive products. As we stick with
In 10 minutes time now, at the bottom of the hour, see the release of the Canadian employment change for the month of July. Forecast 25k on the prior minus 1.4k, with a range of 57.4 to 20k expected. The unemployment rate forecast 6.5% on the prior 6.4%, range of 6.6 to 6.4% expected. Canadian average hourly earnings year over year forecast 4.8%, prior 5.6%, and the participation rate forecast 65.33% on the prior 65.3%.
Thrusters. And I think there's a debate right now between Boeing and between NASA whether or not it's safe enough to bring the astronauts back from orbit. As you probably know, if you don't get the orbital re-entry right, I mean, it can be catastrophic. And so I'm sure NASA is being very, very conservative, as they should be, with spaceflight. And they're talking about potentially bringing the astronauts back with a SpaceX capsule in February. So, and Boeing's had problems with this capsule before. They had problems on the initial docking, even without astronauts on it a while back. And so it's been a bit of a burr in their saddle. It's not big to their financial results, but it's definitely been a burr in their saddle. And I think just indicative of the challenges of the company in sort of engineering and quality.
Yeah, George, it feels like we've been treating it as two different things. The things that you're saying are linked together. Could this get to a place, if we're not talking about until 2025 when the astronauts are coming home, that it's more reputational damage for Boeing? It's more damage that maybe the White House needs to look into and the Congress people on Capitol Hill?
It is. I think the country wants a strong Boeing, right? They're part of the defense, establishment. They're part of our space programs. You don't want single vendors, right? In this case, they've selected Boeing and SpaceX to be the vendors for capsules going to the space station and other work in space. When you have one breakdown, you lose your redundancy. So I think it's definitely something. And the FAA is already looking into their quality challenges in their factories.
So Boeing is dealing with defense issues, the space unit issue, as well as what's going on with commercial jets. George, if this new CEO walking the factory floors, what is he going to be most focused on the next 6 months?
I think it has to be, again, quality coming through those through the factories, right? If some of the reports we heard out of like Spirit Aerosystems for the second quarter was Spirit built, they said a rate of 31 a month, so they built maybe 93 737 fuselages. The number that got delivered to Renton, Washington to be manufactured into airplanes was 27. that rate is horrible, right? And so that's Spirit Aerosystems, but that's going to become part and parcel of Boeing, and that's part of the problem they've been having. It's really about improving quality in their factories. I think that's number one, so that they can start to up throughput, improve cash flow, improve their perception of quality with their customers. And I think it's getting back to a strong engineering culture, which I think is indicative of what you have here with the capsule.
Absolutely massive challenge ahead of them, that's for sure. The stock is just about positive in early trading. George, appreciate your time this morning, sir. George Ferguson there of Bloomberg Intelligence, the latest on Boeing. The opening bell about 1 hour and 7 minutes away. Just a reset here for you. Equity futures on the S&P coming in just a little bit by a couple of tenths of 1%. Lots of takes on Wall Street over the last week or so. This came in from Michael Hartnett of Bank of America this morning. Wall Street, painfully, he says, has now stopped BOJ hikes. Wall Street's next goal appears to be bossing the Fed into big interest rate cuts. Real rates for small businesses are too high. Big cuts are needed to avert a hard landing. Buy the assets, Danny, strangled by 5% yields that breathe more easily, with yields at 3 to 4%. The call from B of A.
But he continues to go on to talk about this idea that like maybe we're not fully done with this thing yet, that maybe there is more pain to come. And talking about the market bullying the Fed, again, I come back to this interlink between US stocks and the Bank of Japan, and even what we're seeing today. And I can't help but wonder if we have this kind of backwards, this idea that it was the yen appreciation that essentially set off US stocks. The carry trade, by some degree, is just a low volatility trade. So what if we are in this new environment where every time you see volatility in the stock market, it scares people out of the carry trade. So we could be, every time you see the VIX spike up, you see some problem with the yen, and it's kind of a new weird reality we might have to contend with.
JP Morgan also coming out with a note saying that stocks remain more at risk for severe declines because the Fed is just not showing that urgency. And they say this, I think we all know this, stocks don't just go up. But they say equities are no longer a one-way upside trade, instead increasingly a two-sided debate on growth and downside risk. And that's really been the point of this week.
We've definitely seen some two-way risk, that's for sure, over the last couple of weeks. Up next on the programme, we'll catch up with David Miracle of Goldman Sachs. We'll speak to Dirk Willer of Citi. Goldman coming out over the weekend and really pouring freezing cold water over the prospect of a 50 basis point interest rate cut in September. So we'll get into the reasons why. For Dirk over at Citi, you'll like this, Danny. We do not think that the carry trade unwind was a major reason for the US equity market swoon. He points to other reasons.
Yeah, I'm so looking forward to this. He says, look, it's about the economy. It's about the U.S. economy, and that's the issue that we've seen that equity markets play out. But I mean, did we just, again, get ourselves tied up in psychology that we think they're linked, so they will be linked?
Yeah, and that's kind of how the week's played out, particularly around the Japanese yen. We'll pick up on that story in just a moment. The view on the economy from Goldman Sachs, the view on the
market. Just less than 5 minutes time now at the bottom of the hour. See the release of the Canadian employment change for the month of July. Forecast 25k on the prior -1 spot 4k, with a range of 57 spot 4 to 20k expected. We also see the release of the Canadian unemployment rate, forecast at 6.5% on the prior 6.4%. The range is 6.6% to 6.4%. Average hourly earnings year over year, forecast 4.8% on the prior 5.6%. And participation rate, forecast at 65.33% on the prior 65.3%.
Top names in business are on Bloomberg.
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still, and forget AI. I need a basic technology adoption.
Nobody covers business like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
1 minute remaining. I'll lead with the Canadian employment change.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
10 seconds.
Equities on the S&P, negative here by, let's call it 0.25% on the S&P 500. On the NASDAQ 100, down by 0.4%.
Minus 2.8k, minus 2.8k, lower than forecast 25k, with the unemployment rate at 6.4%, 6.4%, lower than forecast 6.5%. Average hourly earnings year over year at 5.2%, 5.2%, which is higher than forecast at 4.8%. The participation rate at 65%, 65%, which is lower than forecast 65.33%.
Better than expected. If you think about the BOJ, they've backed away from the prospect of hiking interest rates anytime soon. Earnings, some weakness, consumer weakness here and there. Saw it in Disney, but nothing new. I wouldn't say we've got new information this week at all.
No, we haven't, and that has allowed the market to basically come back right to where it started. Equities on the week after these insane swings are just down as of the close yesterday, 0.5%. I mean, did Monday even happen? It kind of feels like it hasn't. It feels like we're back to square one. And again, this is where you get people concerned. And Neil Dutta talks about this, that we are offsides now for a week next week that is heavy in data, and we could flip right back to being nervous about the economy.
I'll tell you this, Danny, for a lot of people in this market on the wrong side of some of these moves,
I have posted out the Canadian Labour Force July 2024 reports on the feed for anybody interested.
Let's turn to the bond market. Monday definitely happened. The 2-year dropped to 365, which is just ridiculous. We're about 40 basis points higher now, 4.02% on a 2-year. We're down about a basis point. On a 10-year, 394.17. We're down about 4 or 5 basis points so far. We'll give you a check on dollar yen. It's been an important feature of this market over the week or so. Last week or so, 146.81 is where dollar yen is at the moment, down about 0.25%, just a touch more yen strength, in line with this pullback we're seeing in risk in the equity market. As I say, though, correlation still sticks, Danny, just not a big move this morning like we saw earlier this week.
Only a little reaction from the Canadian dollar here as it remains lower after the employment and wage report.
Because he says that it's not the yen that's moving equities around, it's about the economy. But these two have become so closely related, and we've heard so many people say people are using the yen to fund trades in tech, but we kind of can't tell how big it is or who is doing it or how long they're going to continue doing this. You kind of get people throwing stuff out there saying, we're kind of halfway done with the unwind. We're 3/4 of the way the unwind. You get the feeling?
Who knows?
Nobody.
So much of this, we've said it's like the weather. It's like, where are we now? Which way's the wind blowing? That's what it feels like. Under surveillance this morning, former President Donald Trump saying presidents should have more say over interest rates and monetary policy. Trump telling the media from Mar-a-Lago he may have a better instinct. Powell has pledged not to let politics influence his or the FOMC's decision. Question is, if Donald Trump comes back into power, does he have a different plan?
Well, there was a report in the Wall Street Journal in April that they were looking at plans to potentially try to blunt some of the Fed's powers. And then every single someone related to the current Trump campaign or former official would come on this program or behind the scenes. We would ask them, where did this report come from? Everyone threw cold water on it. But now the president is coming out and saying, actually, I think I should have influence because I have a better sense of the economy and I have a good gut feeling. Paul Donovan this morning We heard from him earlier with UBS. We heard from him earlier, not about this, but he said this in his note. He's like, these retro policy proposals, he's obviously talking about what happened with Richard Nixon. He says they're not serious. He said, but if they were, if this was the market taking this seriously, actually, you'd potentially see the movements in this in the market. So right now, everyone's just viewing this as potentially just rhetoric.
This would damage, without a doubt, the US dollar. If that's the objective, I think that would work. You'd have a real problem on your hands. If people started to believe, and it would take a lot, you'd have to really change things for people to start to believe this. But if people start to believe that we were going to have the politicization of central bank decisions all over again, if we were going back to that world, you'd start to see some big moves in foreign exchange.
But the thing is like, I don't understand why people aren't taking this at least a little bit seriously, because everything Trump has said, from saying he wants a weak dollar to yesterday, I mean, all you have to do is look back to his first term. When he appointed Powell, he said he did it because he expressly wanted a Republican at charge of the Fed. And so maybe that didn't play out exactly as he wanted. Maybe he thought Powell would listen to him more, but this isn't a new idea from him.
No, and we're going to hear more of it potentially in the months to come when people actually ask.
So seeing the Canadian dollar pairing decline after jobs data, down 0.1% on the day at 1.374 per US dollar.
You ask questions about asking questions.
Yeah, she walks over to the press corps, rips off her sunglasses. What you got for me?
What you got?
Will you answer questions?
Oh my goodness, that's actually what happened yesterday afternoon.
That is what happens. But there was a lot of pressure growing on the Republican side, on the press corps. Obviously, every journalist is asking her for a sit-down interview, but they're not going to yet. She wants to introduce herself. I don't think you probably see her sit down until after the DNC.
Why don't the press pack understand this? That you build on each other's work, so that when you have the opportunity to ask questions, the person next to you follows up and asks questions and you stay on topic. Why does that never happen in Washington? Why do we never see that
it does happen
at all?
It does happen with some press corps. It does happen with Secretary Blinken.
Foreign policy. With foreign policy. Like, this sounds so critical. The rest of them, I never see it. If you have the vice president come over to you and there's a group of you and she comes up to you and says, what have you got? And the first thing you say is, when can we ask questions? Like, when can we do an interview? That's ridiculous.
No, they could have went down the line with a few policy questions we're all asking for. I did speak to someone in the Trump world yesterday, and I sent them the quote from Trump about his feeling of the gut and what the Fed thinks. And they said, well, what does Kamala Harris think about the Fed? And I was like, I don't know yet.
Hopefully someone asks, and we'll find out. Let's turn to mortgage rates, plunging in the United States, hitting their lowest levels since May of last year. Freddie Mac saying the average for a 30-year fixed home loan is hovering around 6.47%. Rates topped 7% earlier this year. That's the latest on mortgage rates. For the consumer, very much in focus in the next week or so. Investors looking ahead to PPI, CPI, retail sales and earnings from Home Depot and Walmart. David Mericle and the team over at Goldman Sachs raising the odds of a recession, but adding the Fed has room to react. Quote, we have increased our 12-month recession odds by 10 points to 25%. We continue to see recession risk as limited not only because the data look fine overall, but also because Chairman Powell emphasized the Fed has room to cut. David joins us now for more. David, good to see you, sir, and welcome to the program. You guys poured freezing cold water over the prospect of a 50 basis point cut in September. It certainly feels like the economy and the data we've had so far this week has moved your way. How dependent do you think the September decision is on the data between now and September 18th?
I think the August employment report will be very important. Our expectation is that the July employment report will turn out to be a bit of an outlier, that the weak job growth number, the 0.2 increase in the unemployment rate, that we won't see the August report look as weak, that maybe job growth will be closer to 150,000, and that if that turns out to be right, that the FOMC will decide that the right calibration is 25 basis points, but we think 25 basis points at consecutive meetings to start, which is a little bit faster than what they were planning before. They were previously planning quarterly. So that would be one step up.
Seeing here, Canadian swaps market sees about 28 basis points of easing in September, little changed after jobs data.
Worse data than we've seen so far. Historically, the Fed has only done more drastic things like intermediate cuts or 50 or 75 basis point cuts when there was either some sort of crisis going on or when jobless claims were much, much higher than they were today. So that in both cases, you felt like you needed to act aggressively right now in order to stop things from getting worse rapidly. I just don't think we're there right now.
David, that's the path. How have your thoughts evolved about the destination? What do you think the end point is for interest rates?
We haven't changed that. We continue to think 3.25% to 3.5%. Now, that would be 100 basis points above where the hiking cycle stopped last cycle. So that's very different. But this has been one of our core house views at Goldman Sachs going back a decade plus, that neutral is not and never was quite as low as the conventional wisdom held last cycle, that we were dealing with the aftermath of a financial crisis. And as in every country in history that has dealt with that, there are long-lasting headwinds that are separate from monetary policy that hold the economy back. But things like private sector deleveraging and disruptions to financial intermediation and fiscal austerity, those were not literally permanent. They lasted for years, but they were not permanent features of our economy. And I think now we're learning that it's not been as devastating to have these higher interest rates as many people thought coming into this hiking cycle. And so I think gradually over the course of its framework review, the FOMC will discuss these issues, and my guess is they'll wind up being content with stopping higher than they stopped last time.
So David, what changed for you after the Friday jobs report? We certainly see the outcome of it, that not a huge recession risk, but still you upped it to 25. So what change happened?
The main thing that I took from the employment report is now the labor market report is now the unemployment rate is up enough that it didn't feel right to say that the 12-month recession odds are just the historical unconditional average of 15%. That's where we had been for about the last year. Last fall, in 2023, we went down to 15% because we felt like the inflation scare is behind us, the regional bank scare is behind us. Of course, there are always things that can go wrong, but I didn't really see any risk that looked particularly elevated. Now we thought it's not quite fair to go that far, so we bumped them up a little bit. But we are very much still on the optimistic end of this debate. Our 25% odds are lower than consensus, lower than I would perceive investor sentiment to be, and our growth forecast for the year at 2.3% Q4 and Q4 is still very much above consensus.
The Fed is still optimistic at this point too, David. All you need to do is look at Barkin yesterday saying we have more time and layoffs aren't happening. Instead, it's just a slowdown in hiring. Is he right? Do they have still a lot more time?
I think it's very difficult at the moment to disentangle labor demand and labor supply. I think what we know is we had a huge immigration surge that peaked in the back half of 2023. So at some level, job growth should have gone up and it should be coming down. We simply don't have enough workers entering the labor force every month to create the 250,000 jobs a month we created in 2023. So I think that is a lot of it, but in fairness, it is difficult to know in real time what is too weak of demand, what is just kind of the natural decline in supply, especially given all of the uncertainty about the level of immigration. So I would agree, right now, things don't look so problematic to me that I think they need to be aggressive. But what I would say is they ought to be, and I think they will, erring on the side of caution if we do get additional negative data. I'm not really concerned at all about inflation staying too high. And so if there is a concern about the labor market, if we do get a weaker August employment report than I anticipate, then I think they probably should and probably would be more aggressive.
David, good to catch up with you. Appreciate it. David Miracle there of Goldman Sachs on the latest, their view on monetary policy from the Federal Reserve, looking for 25 basis points, 25 basis point cut from the Federal Reserve in September. Here's a take for you. We do not think that the carry trade unwind was a major reason for the US equity market swoon. The words of Dirk Willer, the global head of macro asset allocation over at Citi, and Dirk joins us now for more. Dirk, wonderful to get into this with you. If it wasn't that, what was it?
Yeah, no, very good question. But I think often, you're supposed to go with sort of Occam's razor theory, right? You look for the most simple explanation. And I think the most simple explanation is everyone was in the soft landing camp until Friday. On Friday, the NFP hit. People were questioning that belief, thinking, well, maybe it is a hard landing after all. Well, if that happens, you do two things, right? You sell equities, or at least you reduce equity risk to some extent. And at the same time, because US rates are falling, dollar yen goes straight down. I mean, that's the strongest correlation we have in markets for a long, long time. The dollar yen is mostly driven by US rates. So you quickly get to both of these effects as two big consensus trades, right? The carry trade and the equity trade, both being consensus trades, being undermined by a point of US data. And that's in the end caused both of these things. So I think that is the most simple explanation, the most likely explanation. Now, what I would say is the yen move certainly had something to do with the sell-off in Japanese stocks. I mean, that is, I think, quite clear, because the main reason for Japanese stocks outperformance is really a higher dollar yen. So if you question that assumption, you also question Japanese outperformance, and that had an impact. But on the S&P, I think it's an old-fashioned case of worries about hard landing going up.
So if the dog is the growth scare and the tail is dollar yen, I've got to ask you whether the tail starts wagging the dog a little bit here, Dirk, and whether enough people now just believe dollar yen is that important for risk appetite in America. Is that the current regime?
And certainly there were lots and lots of questions about the yen, about the carry trade from equity investors. If you talk to FX investors, they think it's really unlikely that FX is wagging the sort of global equity markets, while equity guys are very open to the idea. So it's certainly the case that the focus on dollar yen has increased a lot. But I think in the end, right, what's going to happen is that we will not be able to quite figure out whether it's a soft or hard landing for a while. We need more data. Citi is actually in the more bearish camp, and our economist is looking for a hard landing. But in any case, I think even the soft landing proponents think basically that the way to get to the soft landing is early and more aggressive Fed cuts. So that means US rates will not make it back to where they were before Friday, and even in a soft landing. And that also means that dollar yen will not make it back to where it was before. And so I think we just have to get used to the fact that, yes, we have a very different handle now for dollar yen, and the yen could stabilize around here, but will not move higher again in dollar yen terms. And that's how it is. And I think markets will move on from the focus on dollar yen over time.
Dirk, I really feel like you should have gotten over to Japan and talked to the BOJ, because I think they could have had this talking to, because I think they thought it was squarely in their hands. Hence, you have the deputy governor come out and say, we're not going to move when markets are volatile. I know it's a whiles away, but does that mean when we get to September 20th, the BOJ has a decision, we shouldn't be worried of this happening all over again if they hike rates?
I do think historically dollar yen depends more on US rates than on Japanese rates, and the reason is that US rates are a lot more volatile. And so if you think dollar yen is driven by the difference between Japanese and US rates, it's usually US rates that are in the driver's seat. Now, if you get these BOJ hikes, then clearly they take precedent for a few days. And clearly the BOJ hike mattered a lot for dollar yen, and it mattered a lot for Japanese equities. So that is true. I mean, I would think that the hurdle for Japan to go again has really increased very considerably, and that's for two reasons. One, the issue is that we get more Fed cuts than we were thinking, at least in Citi's view, and earlier Fed cuts. And that means dollar rates will remain very well behaved, and that means dollar yen will not be a problem for the BOJ anymore. And dollar yen is extremely important for inflation in Japan. It really is one of the major contributors. And if that is not a worry anymore, just fundamentally the BOJ will be not under that much pressure to move. Don't forget, they also move partly because of political pressure, where the weak yen became an issue for the government. So that is all gone. And that is important. The second issue is, of course, that there is some blame that will be passed around, and that if your equity market in Japan crashes, sort of the moment you hike rates, you'll think twice before you do it again. So and we had these comments, as you mentioned, that were along those lines. So I think the BOJ will be very, very careful going forward. Historically, they were never able to hike again when the Fed was in an easing cycle. And so I do think, obviously, we still debate whether it's a US hard landing or US soft landing. In a US hard landing, the BOJ will probably not get another hike in. In a soft landing, it's more debatable, but they will be very, very careful going forward.
Citi does, though, think that there's one trade that potentially could be squeezed by the unwind in global carry, and that's the yuan. Where are we with that unwinding?
That's a very good question, because if we look at our flow data to try and understand how much of the carry trade has been unbound, which is, of course, a key question, certainly for FX investors, then what you find is the high yielders, which are the long side of the carry trade, meaning your Mexicos and your Brazils and so forth, they have been cleaned up tremendously already. And that started to happen in June, right after the Mexican election. So that is not a concern anymore at this stage. Now, on the funding side of the carry trade, meaning mostly Asian currencies, the cleanup has been much less far advanced. On the contrary, people really added to that trade even after the Mexican election. So interestingly enough, I don't think FX investors were very much positioned for a higher dollar yen. I think that was already pared back very significantly after the interventions and after US rates started to change direction. However, to be long dollar CNH has been probably the most popular trade in FX. On the long dollar side, and the reasons, of course, that it was a combination of carry plus a Trump trade, and both of these things have become, of course, somewhat more shaky. The carry unwind after the yen move, and on top of that, Trump's probabilities having come down as well, and there we still see very meaningful positions. We still think that going into the election, once the election trade comes back, which it sort of disappeared from investor conversations almost for a little while, given what was going on. But once the election trade comes back, people will again be very happy having long dollar CNH positions, and CNH should weaken into the US election. But positioning remains an overhang and might have to clean up further first.
Hey, Dirk, enjoyed this. Let's do it again soon. Dirk Willer there of Citi. So is it the dog or the tail? Where are we at? Did we agree on all this?
I feel like it's not even an animal. It's just this messy ball of things rolling around, impacting himself.
An identified object.
An unidentified object. Yeah. The moves from the BOJ didn't cause the market moves, but the market moves are impacting the BOJ.
Got it.
And so if that's where we are,
I think.
Okay, well, basically, because the market moved, the BOJ can't act, right? And we were saying, okay, the BOJ has a really small window. They can't move when the Fed is easing. From what I'm hearing from there, that window never existed. The BOJ could never go, because as long as we think there's a chance of a recession, sorry, BOJ, you can't hike because this is what happens.
And can the Federal Reserve cut? Because if the Federal Reserve cuts, then we just exacerbate the pain in dollar yen.
You exacerbate the pain in dollar yen, and then equities sell off, and then it's more restrictive.
I don't get it.
See, it's a mess. It's not an animal. It's a crazy, weird... Yeah, it's an amoeba. Perfect.
An unidentified mess. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. The U.S., Qatar, and Egypt are calling for a new round of ceasefire talks, the latest effort from the Biden administration to end the war in Gaza. Israel said it will send a delegation to the talks scheduled for next week, while Hamas did not respond. U.S. officials now say a deal is closer than ever, even as the region braces for an expected Iranian attack on Israel. The Federal Reserve could soon begin easing interest rates if inflation continues on its downward path, according to Boston Fed President Susan Collins. In an interview with the Providence Journal, she added that the U.S. labor market remains strong, even though the latest jobs report came in softer than expected. Collins expects interest rates to be lower in the next few years, though of course she stopped short of providing a precise outlook for the timing and pace of easing. And Michael Hartnett of Bank of America says volatility in global financial markets has yet to reach the levels that would signal worries about a hard landing. He wrote in a note that while investor feedback is frazzled, expectations of Fed rate cuts mean that a preference for stocks over bonds hasn't been ended by the market rout. Hartnett has taken a more neutral tone on stocks this year after remaining bearish through a rally in 2023. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning and have a great weekend. Up next on the programme, setting you up for today and a sneak peek of next week from New York. You're watching Bloomberg TV.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
The opening bell 36 minutes away. Equity futures going into it slightly negative. Near session lows, actually. We're down by about 1/3 of 1% on the S&P 500. The rally continues in the bond market, resumes, picks up, however you want to describe it. Yields are lower by 5 basis points, 393.41 on a 10-year. We've talked a lot about dollar yen. Is it important? Is it not? It's important to a lot of you, so we're all looking at it. Dollar yen 146.70. We're negative on that currency pair by 1/3 of 1%. Just a little bit of yen strength going into the weekend. Here's the trading diary going into the weekend for today and a look ahead to the calendar for next week as well. Today, Vice President Kamala Harris on the campaign trail in Arizona. Donald Trump heading to Montana before an interview with Elon Musk on Monday. Tuesday, US PPI data followed by Atlanta Fed President Raphael Bostic. Wednesday, the latest CPI print. Thursday, retail sales, plus another round of jobless claims. And more Fed speak through the week from a select host of Federal Reserve officials before Jackson Hole the following week. Danny, I've got to say, next week, all about the data.
Kind of scary. And like the best thing you could have done for this week was get jobs on Friday last week and literally shut everything down. Shut everything down, go away, go to the beach, because we ended up right back where we are. How volatile are we going to be next week? Is it going to be the same thing where it's a pendulum swings from data point to data point and we end up exactly back where we are? And that is, I don't know, and things are uncertain.
And with inflation coming down as potentially the trend, this was supposed to be a moment for politically this White House to really triumph. We finally are in a place where things are normalizing because this is one of the top issues. But how difficult is that when every day you have people coming in the program talking about growth scares and the R word, this potential recession?
3 pieces of good news for you. 1, things have settled down. 2, Lisa is back next week. 3, I'll be away from the desk for a week. So you have a wonderful weekend and I'll catch up with you soon. From New York City, up on Monday, Neela Richardson of ADP, Terry Haynes of Pangea Policy, Tony DeSpirito of BlackRock, and Jane Foley of Rubberbank. All of that still to come. From New York, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that
effective Fed funds rate 5.33% for August the 8th, unchanged from August the 7th.
Is very sound. So it's complicated, but it definitely is benefiting the business today.
All right, futures edging lower, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Carol Masser. Katie Greifeld and Shonali Bostic are off today. Bloomberg Open Interest starts right now.
Coming up, a turbulent week in market draws to a close with debates on what's next for stocks, bonds, and central banks. The week ahead brings a slew of economic data as investors search for more signs of resilience in the world's largest economy and riding the AI wave. Chip-making giants, TMC's sales, growth stages, a comeback. We'll discuss what that means for the broader sector. But first off, let's take a look at where markets are trading. As I said, edging lower right now. We have S&P futures down about 1/3% after closing the session in positive territory yesterday. NASDAQ 100 futures down a little more, about 0.6%, and the Russell unchanged. Carol?
All right, Matt. So a little bit lower in terms of the overall trade, but I'm going to take a look at some gainers in today's session because we've got another big media giant actually taking another big write-down. We're talking about Paramount, but we've actually seen this name go higher post-market and then also pre-market, up about 5%. They did have an earnings beat, but nonetheless, that write-down continues in media. We're going to talk a little bit about that as well. Expedia, another travel company, check this out, up almost 9% in today's session. Earnings beat. It did warn of a soft demand, joining a chorus of execs from Airbnb and Booking who have talked about slowing demand, but nonetheless, investors saying, I'm okay with it today. And then Matt mentioned chips. TSMC, world's leading contract chip maker, saw sales growth of 45% in the month of July on strong AI demand, Taiwan Semiconductor, you can see up about 2.25%. We will be watching the semi space today.
Let's take a look at the bond trade because we've seen yields come back to a level where they were last week. Stocks not quite there yet. The 2-year yield back over 4%. That we saw yesterday. In fact, yesterday we saw the 10-year yield over 4% briefly. Right now it's back down to 3.90, 3.94, and the 30-year at 4.22. Next week is busy, as I said, for economic data. We're going to get the New York Fed 1-year inflation expectations on Monday, followed by key inflation data on Tuesday and Wednesday as well. We'll talk about inflation and its effect on earnings with Cameron Dawson a little bit later. We get retail sales data on Thursday, and then University of Michigan consumer sentiment on Friday. We'll be looking at that closely. Joining us now to talk about how all this affects the bond market and the stock market is Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. And Ira, we care so much because it looks like the bond market has been leading the stock market in these huge volatile swings, but we're back at a level that we were before the non-farm payrolls. How does it look to you?
Yeah, so all of these markets are just very correlated, and in a more normal way, right? So for basically 15 years, we've had either a QE trade or a QT trade going on, right? Where all the markets were positively correlated. So now you're finally starting to get a little bit of a negative correlation where equity markets fall or some other risk assets fall, and then you get a rally in rates or rates rally, and then that kind of spooks the risk asset markets. But it's all very correlated almost together, as opposed to one market really leading the other. The bond market trade, though, it certainly is now looking like, hey, the Fed really is going to cut. We're not as worried about a reacceleration of inflation, and that's why 2-year notes, even though they're above 4%, remember they're down from 4 3/4 just a couple of weeks ago. So it's a really spectacular rally.
Ira, having said that, is it hard to kind of figure out where we top out when it comes to yields right now?
Well, we're looking at important technical levels. I think that's probably the best thing to do for anyone trading in their portfolio and trying to position. So 412 on 2-year note yields is a pretty important level. We do get a 2-year note auction at the end of the month. We had some pretty bad auctions actually the last 2 days in the 10-year and 30-year, but I suspect that a big part of that is because people are migrating toward the front end of the yield curve to get their risk, kind of fear of missing out, and just look, let's just make the 4% carry because yields might be well below 4% a year from now. So people are just trying to get in now. So this rotation toward the bull steepening trade is probably going to not continue forever, right? But there's going to be fits and starts. But I think that's one of the reasons why you've seen better demand in the front end than you have in the 10-year. Now that's reversing a little bit today, but I'm saying in general over the course of the week.
Ira, the 10-year we saw at 394 and the 30 at 422, the 20 at 431. Investors just aren't buying this, and yesterday we were talking about Steve Mnuchin saying it's time to kill it. Why is this duration such a difficult sell?
Well, I think there's a couple of things about it. So some is technical. So people, for whatever reason, don't. There's something called Treasury strips, which are basically zero coupon long-term bonds, but they're stripped from a different instrument, and nobody strips anything shorter than 30-year bonds. So that's one of the reasons why technically the 30-year, when you look at it, the amount outstanding on the Bloomberg terminal, and you do a DES, the number that you see there isn't really the free float because people have stripped it and people kind of put them away in their portfolios. So the 20-year, there's a fair amount of supply. It's not something that is a large part of the index, which I think is another big issue. And then its duration is not meaningfully different from a 10-year or a 30-year. So because of that, there's just people just don't naturally need to buy a 20-year bond because it doesn't fit their profile for the risk that they're trying to hedge.
Right.
Insurance companies don't buy it, for example. They buy 30 years.
Hey, Ira, just got about 20 seconds here. Next week is a big one in terms of economic data. 2 inflation prints, and we also get a read on retail sales. What do we need to know right now?
Yeah, so if the inflation print just surprises to the upside, then you can wind up having a big snapback in rates, and you can wind up seeing yields a bit higher. But the retail sales number, I think, is going to be key because retail sales tends to lead the inflation data. So I'm going to be focused on the retail sales data.
See what consumers are up to once again. All right, Ira Jersey, thank you so much. Ira, of course, of our Bloomberg Intelligence team. Well, joining us right now, we want to get the equity side of things and kind of the overall investment thesis on this Friday. Eric Friedman is Chief Investment Officer at U.S. Bank Asset Management. They've got some $480 billion in assets under management. Hey, Eric, good to have you here after quite a week. What's helpful? Here we sit on this Friday in remembering kind of a market environment that can turn on a dime or an economic report.
Yeah, Carol, great to be here. And your team's done an awesome job this week of covering all these cross currents. I think there's really 2 things that we'd separate for viewers and for listeners. Number one is that we think a lot of the chatter, and I should say the volatility earlier in the week, was a function of that Japanese carry trade. I know it's been carried, that's been covered ad nauseum, but that, the fact that you had the Japanese equity market decline by 20% in 3 days, like that's significant. So the aftermath is still being absorbed and digested. We don't think that fundamentals got worse by 20%. We don't think that there's a significant read-through per se, but we have to be respectful of the price action. So again, we would isolate, if you will, the Japanese carry trade issue from the issues that are in front of us in terms of just this, does this economy grind higher? We think it does. We think it's going to be a gradual slowdown. I loved your poll on Twitter, the artist from knows Twitter on, swipe left for soft landing, swipe right for recession. We're more in the soft landing side. So we still think that the bias for consumers will be a gradual easing. There'll be some more differentiation across consumer types, but we're still very bullish on the prospect for a diversified portfolio. So we really camp us in the optimistic camp, if you will, in terms of what portfolios will look like for the rest of this year.
I should point out, in my poll, swipe left for soft landing, 55%, swipe right for recession was 45%.
All right. So I don't know. I don't know how.
Don't ask me about the standard deviation on that.
Eric, you have a great roadmap for, the kind of blow up that we saw this last week. When talking to your clients, you told us you pointed out phase one was the triggering, and that was, the BOJ and the Fed on Wednesday, then the non-farm payrolls number on Friday. Phase two is price discovery, and that's where we have all this volatility, right? And I guess the positioning in terms of the carry trade is in there as well. I'm pretty sure we made a great full screen for this. So there we go.
See?
And then phase three is fundamental assessment. That's, I guess, what's coming next. You're concerned about overzealous, let's say, earnings estimates for 2025, right? Is that part of phase three?
Yeah, it really is. It's a very well characterized, phase transition, the way we're thinking about things. We think that in terms of position squaring, we're kind of not all the way through that, but we're mostly through that right now, Matt. I think the key thing for us is that if you're in our chair, you start to look pretty quickly at 2025 earnings. And based on, the great work that Bloomberg does, there's a 14.5% earnings growth baked into the S&P for next year. After a year, we actually had earnings grow likely 10%. That's a pretty high growth rate when we have elections and we still have Fed funds at 5.3%. We're seeing the slowdown in consumers. So what that says to us is, look, we still are optimistic. We still want to own stocks here, but we expect it to be a grind. And some of that differentiation across, again, quick serve restaurants, the things you're hearing about in theme parks and other segments of the market, those are real. Those are starting to really catch up with a broader earnings picture. So where we'd really favor our investment thesis, if you will, is still towards tech, still towards cyber. We think that as long as NDX holds above 17,500, that's a space you can accumulate on weakness. We also would be more aggressive on the equal-weighted S&P. That's a space where you're up in cap, so you're up in quality, but you're also getting more of that fanning out that we think is going to happen still in terms of earnings growth and trajectory. So that's the way we're thinking about it, is that, hey, it's a high bar to hit for next year. It's achievable, but probably comes from more than just tech. And so we want to broaden out some of our exposure as we get deeper into this calendar year.
I actually put together a chart on equal-weighted versus a cap-weighted S&P. It's 1286, #BTV 1286, if we can pull that up. The S&P has doubled the performance of the equal-weighted, which I guess you could play with the ETF RSP. What triggers a turnaround here, and how do you want to play it?
Yeah, I think a couple things. One, that's an outstanding chart to have. We often talk about this phenomenon visually of alligator jaws that widen and then close. And then you're obviously seeing a very wide jawline, if you will, from RSP versus S&P. We don't think that's going to necessarily converge completely. We would expect to see those jaws start to close. So I think the catalyst is really this. Number one, we are seeing from a sector participation standpoint more than just big tech working, and some of that is predicated upon credit being very stable. So.
We're losing the feed.
Yeah,
we're losing the feed. The Zoom is falling. Anyway, we appreciate it. Eric Friedman there, U.S. Bank Asset Management. Great to get your take. Hope we get to have you on again soon. Let's get another check on where futures are trading. We got 20 minutes to go until the open. We're still down 0.25% on the S&P. NASDAQ futures down a little bit more, which is interesting, Carol.
Why?
because tech stocks, you know, we had such a blowout number from TSMC, right?
Yeah, I'm going to watch the semiconductor space today to see whether or not we get any kind of lift. I also think this is going to be a day. What happens into the close? We've got low volume, probably low activity. It does feel like an August Friday in the summer here. So curious to see what happens.
Finally, a slow August Friday. Let's get a check at what's going on in the stocks right now. The individual names moving ahead of the opening bell. For that, we bring in Abigail Doolittle. Abby, what do you see?
Well, of course, we still have earnings movers to get through. Let's take a look at the shares of Unity Software. Well off of their pre-market lows, but still down about 2.1%. This, of course, is the video game tool maker. They cut their fiscal year forecast after putting up a small sales beat. Into today, it's really pretty extraordinary. The stock down about 65%. There is also a significant 11% bearish short interest on this stock. So bears all over this name right now, just a little bit. Turning to Trade Desk, these shares are higher, and this, of course, is the advertising technology company, up 2.8% in the pre-market. They put up a 12% adjusted earnings beat. They beat sales by 1%, and the guide was better. Now let's go beneath the surface for some of the big movers, the big tech movers, because these are, of course, the stocks that will move the market. On the one hand, we have Alphabet and Apple, both lower. Alphabet down 1.7%, maybe some concerns around search and AI. Apple down 0.9%, I would say, on the possibility of technical selling. This stock still looks like it's going to go sub 200 if the bears get back into motion. On the other hand, we have very small gains for Microsoft, and then, of course, the dividing one, Carol, the decisive one, I should say, NVIDIA up slightly. But if this one were to join Apple and Alphabet, it could really turn into a little bit of a bearish Friday. Right now, just small losses, though, heading into the open.
Yeah, with investors so skittish, it doesn't take much. All right, Abigail Doolittle, thank you so much. Coming up, everybody, a key bellwether for AI demand. Speaking of tech and the semiconductor space overall, kicking into high gear in July, we are talking Taiwan semiconductor. Sales are soaring, and we wonder, could that kind of help the turnaround in the group that recently tipped into a bear market right now? Taiwan Semi, 2.4% higher in the pre-market. This is Open Interest on this Friday, and this is Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's get now to high interest to look at what's making headlines around the world. An earthquake near the coast of one of Japan's southern islands prompted the government to issue its first ever warning of a mega quake. The country's prime minister called off a planned trip out of caution. Bullet trains ran at reduced speeds and some chip-related factories temporarily halted production. Ukraine said it carried out a drone strike on a military airfield in Russia's Lipetsk region. The strike marks a fourth consecutive day of Ukraine's expanding incursion into Russian territory. And you know who likes Palm Beach? Larry Ellison. He's buying a luxury hotel for an undisclosed amount in the same Palm Beach enclave where he dropped $173 million on a residential compound 2 years ago. The property has long been a retreat for prominent families, including the Fords and the Rockefellers.
All right, Matt, now he has a couple of places to stay when he goes to Florida. Hey, folks, let's get back to the markets, talk about what's going on in the semiconductor space. The SOX, the Philadelphia Semiconductor Index, dropped 25% from July 10th to earlier this week. They've bounced back more than 2% this week. And overnight, one of the key bellwethers for the chip space and AI demand, Taiwan semiconductor manufacturer, reported revenue rose 45% in July on strong AI chip demand. So you see that one moving up about 2.6% in the pre-market. So let's get to it with Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh. Mandeep, good to be checking in with you. So what jumps out for you about the TSMC release?
I mean, it's a nice sequential acceleration from their second quarter earnings. So remember, they give us monthly data and, 45% growth when they guided to low to mid 20% growth for the full year. It just goes to show that, the lead times probably are increasing, and that's good for someone like TSMC because they are the only ones when it comes to leading node chip manufacturing. And I think all the talks about NVIDIA chip delays probably are not getting reflected here. So clearly they are seeing a ton of demand when it comes to chip
manufacturing. How much, Mandeep, I think a lot of people outside the industry don't understand how much production TSMC does for other companies, right? So like NVIDIA doesn't make its own chips. It sends them orders to TSMC and they do it. How much do they do in terms of, the outsourcing of chip manufacturing?
Yeah, so the best way to think about it is all the leading node GPUs, whether it's 5 nanometer, 7 nanometer, most of the production right now is being done by TSMC. For the trailing node chips, you've got other foundries. Now, we know Intel isn't doing well as a foundry, so clearly they're losing business. And typically, TSMC was skewed more towards Apple smartphone business. I mean, that was the biggest portion of their revenue. But right now, it's definitely shifting towards NVIDIA and, the server chips. And it's hard to kind of have a firm read-through on what this print means for Apple, because right now the demand on the server GPU side is just insatiable, and that's what's driving a lot of the ASP growth for TSMC.
You answered my question. I was going to ask you about the Apple exposures, but you went right there. So what about in terms of the broader semi space, which we have seen, some would say the group had gone into a bear market if you look about how much it's pulled back since kind of early July. What does it tell you about where we are in the semi cycle?
I mean, when I see accelerating growth, and given they give us monthly data points and it's trending in the, the higher direction, to me, we're nowhere close to any sort of moderation when it comes to leading node chips. And look, we'll find out from NVIDIA a couple of weeks from now that clearly I think they will kind of beat and raise. The question is how much visibility they have when it comes to the customer orders. And look, this is for building inventory. Whatever TSMC is manufacturing is for building the inventory. At some point, that inventory buildup will be more than sufficient. I don't think we are there anytime close, at least this year, but it will probably be a 2025 event.
All right, going to leave it on that note. Hey, Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. NVIDIA, by the way, reports at the end of this month, August 28th. All right, let's get a look at the stocks moving ahead of the opening bell. Let's head back to Abigail Doolittle. Abby, all yours.
Well, we have more earnings movers to take a look at, Carol. Let's take a look at the shares of Akamai, up nearly 6%. They put up a really good quarter. They beat by 2% relative to adjusted earnings. They raised the forecast, very importantly, and some analysts are saying it was a clean print and that the momentum is going to continue. Taking a look at the shares of Take-Two, these shares are also higher and by about the same amount, 6% or so, just a little bit more. And Zynga momentum is apparently continuing. They put up a massive, an EBITDA beat that was very impressive. Investors liking those results overall. And then e.l.f. Beauty, this is really interesting because this is the company that put up a massive beat, yet you can see that the stock stock down 8%. They beat adjusted earnings by 32%, sales by 7.2%. Very impressive. But the outlook a little bit light. There is a 4% bearish short interest, and I think, Matt, with the stock up more than 30%, despite all of the e.l.f. Beauty products and some that I know who also buy, we're just not doing our part. We're going to have to get out there and buy more to make sure that they can keep that outlook a little bit stronger and help out the stock.
I will confess to not knowing what e.l.f. Beauty product sells.
They have the best peel ever, and their moisturizers are excellent too.
You have no idea?
No, I don't know.
You're surrounded by women. You're married to a woman.
Well, I've heard, well, that is true. And I have two women, daughters. I've heard that if you buy lipstick, what, you're shifting down from buying like a designer dress or something?
It used to be called the lipstick index, and it still is called the lipstick index, but in signs of recession, when you don't have a lot of money to spend, you look for those kind of small purchases that give you some joy. And it used to be lipstick, although people are saying that there's a column on the Bloomberg that we've stocked up so much that maybe that's not the case.
You just got so much lipstick lying around.
Yeah, exactly.
I believe it. All right, well, if you do want to save money, you might want to go to one of the big box stores like Costco. It's going to be more difficult if you're borrowing your card from a friend or family member. We'll tell you why in Social Climbers next. This is Bloomberg.
Cracking down.
Morning from our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
All right, everybody, time now for Social Climbers. That's the companies that are making waves on this Friday morning. First up, Expedia posting an earnings beat in the second quarter, but warning that it is seeing softening travel demand now. The sentiment echoing throughout the travel industry as evidenced by Airbnb's disappointing results earlier. Next up, 23andMe is getting out of DNA testing and into the red-hot weight loss market. The struggling firm planning to launch a telehealth membership program by the end of the month. Users will be able to get a brand name or compounded forms of Novo Nordisk's blockbuster GLP-1 drug. Finally, Costco cracking down on membership moochers. The big box retailer will now require shoppers to scan their membership cards to enter stores. Guests will still be allowed, but they must be accompanied by a card holder. The news comes on the heels of a $5 membership fee hike that is set to start on September 1st. Now you can follow all the latest company buzz. Just check out Trend, T-R-E-N-Go on your Bloomberg terminal. Matt.
All right, coming up, we're going to speak with Shana Sissel, founder, president, and CEO. All of those titles at Van Ryan Capital Management on why this is a particularly good time for stock pickers. This is Bloomberg.
on fast fashion. It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think it's also how I grew up, making your own clothes and making something that's very special and very unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something very special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing. Everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable.
1 minute remaining till we get the US cash equity open and the market on open imbalance for the last time this week.
Designer, it's really important to really make it happen. Every collection, I'm thinking about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have futures that are lower after a positive finish yesterday.
So we're looking now to the market on open imbalance. The S&P 500, 25 million to the sell side. NASDAQ 100, 5 million to the sell side. Dow 30 stocks, 20 million to the sell side. And Mag 7 stocks flat at 0 million.
After 1 year, you have City Girls Golf celebrating its anniversary, getting women of color, kids of color into the sport of golf, especially in urban areas. Really cool stuff. Quick check on what the averages are doing just a few seconds into the trade. It's going to look a lot like futures did. S&P cash trade down about 0.1%. NASDAQ 100 down about 0.3%, but we're going to see a lot of volatility. Obviously, we have for the last week and change, and that could continue today. One of the stocks that you want to watch closely is Paramount. Following Warner Brothers with a $6 billion write-down on its cable networks, another sign of weakness in the linear TV business, Carol.
All right, yeah, it's interesting to see kind of the mellow, broader market trade this morning. Matt mentioning Paramount, so we're keeping a watch on that one. Also, keeping an eye on Expedia, posted better than expected second quarter results, while once again, a travel company warning of softening demand. So we'll see, but nonetheless, investors liking it up about 10.5% here at the open. Also, we've been talking a lot about chips. We talked with our Mandeep Singh. You've got TSMC's revenue up 45%, big beat in the month of July, boosting demand for AI chips. Just a little bit higher right now, so just up about 0.7%. We'll see if those gains hold. All right, let's take a closer look at the trade and all of it with Bloomberg's Abigail Doolittle.
Well, those Taiwan semiconductor results, Carol, one reason why we're seeing a little bit of a relief rally here for this stocks, although on the day down about 0.4%, but over the last 5 days, we're looking at an up week, the first up week in 4. Coming into this week for the stocks had lost more than 20%, a bear market in a very short period of time. Of course, this has a lot to do with NVIDIA. Let's take a look at those movers. Concerns not so much around results, but more to do with the massive move that we saw for some of these movers. Take a look at AMD down 24%, NVIDIA down 19%, Broadcom, Taiwan Semiconductor, despite these positive results. So lots of weakness in this space. And again, I would argue that a lot of it has to do with the idea that these stocks went so far, so fast on the AI craze, and then a little bit of reality hitting the space. When we put this together with NVIDIA, of course, we've been tracking this chart quite a bit. Let's take a look at the NVIDIA chart that we looked at, I think probably last week or earlier this week. You can see a nice uptrend until we hit this, what's called a broadening formation, an ugly one, really, one that's expanding. That really speaks to the level of uncertainty between the bulls and the bears, more so the bulls. The bears are pretty confident that they're going to take it down. Right now, we had a breach earlier on Monday of the bottom of this range. You know, the big question here, Matt, is are we looking at what's called a V bottom, or are we looking at a bear pennant? The bear pennant would be a pause before more bearish action. The V bottom is a quick springboard higher. We haven't had that quick springboard higher, and you take a look at the RSI, not really doing all that much. I still think that this chart is suggesting to us that we're likely to go down toward that 200-day moving average around 82 once the sellers get back into action.
All right, great to get that technical analysis. Abigail, thanks very much. Abigail Doolittle, they're looking at NVIDIA. Let's talk right now with Shana Sissel. She is the CEO of Ban Ryan Capital Management. And Shana, you make a point in your notes to us that Eric Friedman and others have been making as well, which is that as the cap-weighted S&P outperforms the equal-weighted S&P by so much, and you know, over the last year it's doubled in terms of the performance, it's a great time for active stock pickers. Why is that?
Yeah, so there's this theory of dispersion of returns. And when return dispersions are really broad, which is what happens when you have these big differences between market cap, it's a better market for stock pickers. That's what the academic research shows, that's what history shows, and that's what we're seeing is a very broad dispersion of returns, and for that reason, stock pickers can really win.
Isn't it always kind of a stock picker's market, right, if you look at the fundamentals, you know, in general, or do you feel like everybody's just been buying the market? Because I feel like the market's been a little bit more selective as of late.
Okay, as of late, yes, but I think if you look back the last few years, that has not been the case. Stock pickers have not done well. If you didn't own the Mag 7, then it didn't matter, you know, how well the stocks you picked did, because not owning those hurt you more than owning other things that did well. So we've seen more recently as those names have gotten beat up a little bit, more of an opportunity for stock pickers to do well. But historically, there's these trends that happen where active versus passive, which is a good benchmark, if you will, for stock pickers versus the market, has done differently. The trend changes. So we've gone through a very long period of time where passive outperformed active. Right. And it tends to be 10 to 15 year periods where these things happen. So as fundamentals start to drive stock returns more, and that's what we're starting to see.
It's been 15 years.
That will be better
for 15 years, nobody can beat the IVV, right? Or the Qs.
That's the other thing. And Shana, the thing I was going to think about, anybody who's investing in a 401k, they end up buying the market, the index. And I always feel like even some of these big tech names, as everybody starts to say, maybe we need to kind of pull back, that ultimately money continues to be channeled into them. Doesn't that provide kind of a floor support, essentially, for all of these names?
It does, actually. And the reason why is, you know, whether or not something is good fundamentally, if there's money going into it, it's going to go up. And that's even more true as market cap goes down. But we have seen recently, especially in the last year or so, as we've seen small caps kind of struggle, that stock picking in small caps has been a huge winner for at least the last 12 to 18 months. And so that's a perfect example of what I mean. When fundamentals start to drive stock returns, then you can actually add alpha through stock selection. But in the large caps, it's much harder to do that. And that's always been the case.
Well, I mean, I'm going to say Vertiv is a small cap here, even though it's a $26 billion stock. Because, you know, when you talk about the mega cap tech stocks, we're talking about trillion-dollar stocks. You like Vertiv. I want to get into some of your individual picks, Shana. You like Vertiv, which is an AI play. It's a data center. I wonder if they also get, you know, support from the infrastructure bill in the U.S. because it really is infrastructure build out. But isn't that trade already really crowded?
It's up 50% this year.
Yeah.
I don't think it's really crowded, and it's funny to me that we're going to call Vertiv a small cap. I remember the days when small cap was defined as under $1 billion in market cap. So And I don't feel like that was that long ago. But to your point, I actually don't think that a lot of people have been paying attention to this stock. It's not one that I hear mentioned very often, but it is a second derivative beneficiary of the AI play, as it does cooling systems for these large data centers. Whereas you need more and more computing power for machine learning, you need to have, cooling for your servers because they get hot. And the more computing power, the hotter they get. So this is a stock that will benefit as we continue to build out the infrastructure to support AI. But I don't think that it's overdone at all. As a matter of fact, you said it's up 50%. Now look at that compared to NVIDIA over the same period of time, and I would argue that it's really not been bid up nearly as much as it could have been.
Hey, let's go to Apple, which is another name that you like, and it's down about 9% from the mid-July point. So we've seen somewhat of a pullback. What's the play? And that's, again, one of those big mega cap tech companies.
So Apple had some weakness even prior to the sell-off that we've been seeing in the big tech names, largely because there was some uncertainty on whether or not they were going to be able to compete with, Microsoft and others in the AI space. And they came out and they made it clear that they will be able to, but then there was some questions about iPhone sales and a number of other things. And so the stock has been weak for a while. Comparatively speaking, the stock may be down 9%, I think you said, but NVIDIA's down like 20. So it's actually held up better than some of the other mega cap names. And I actually like the stock, and I have liked the stock since we've seen the weakness in it. I think long term, Apple has like a great moat. Anybody who has an iPhone knows, like, you can't leave the ecosystem and you don't ever want to be the green bubble. So, I think that alone gives Apple an edge, and the stock is trading at a pretty reasonable valuation. So for me, it's an easy thing to say buy this big mega cap technology company, but this is a name that I think hasn't participated as much as some of its peers on the upside, and it's not as beaten up. It's a stock that I would add to at this point.
I will lock people out of a chat if they have a green bubble. I want to ask about Novartis. All we talk about is, Novo Nordisk, Eli Lilly, GLP-1s. To my knowledge, they don't really have one there. Why do you like the stock?
So, full disclosure, I am here today because of Novartis. They have some game-changing oncology drugs. So one of their biggest blockbuster drugs, which is absolutely changing the game, is their Kisqali drug for women with advanced breast cancer. And they have a number of really blockbuster oncology drugs. So, we can, look at the sexy drugs that are out there related to diabetes and weight loss and things of that nature. But at the end of the day, it's these game-changing oncology drugs by Novartis that I think have the longer-term trends in them, because, we're starting to see how things like Ozempic are affecting people in a negative way with long-term use, whereas these oncology drugs, long-term use is keeping people alive, and I think that's a beneficiary. That's a benefit and a tailwind to a stock like Novartis.
Beating cancer is something that we all want to get behind, and we're glad you're here, Shana. Thanks so much. Shana Sissel there at Ben Ryan Capital Management. Real quick, I just want to show a comp chart. She mentioned if you put up Vertiv against Novartis, and I put it up also against the Qs, it's really underperformed. So maybe it's not too.
Do you mean against NVIDIA?
Sorry, against NVIDIA. Yeah, NVIDIA is here in orange, and Vertiv is the white line there. The Qs are yellow. So it's definitely got some room to run if you think it's on the same path.
If it's comparable. And I always feel like when we talk about NVIDIA, it's kind of in its own class, and it's way ahead of the pack in terms of the AI play. But I guess time will tell, right, if everybody can catch up. All right, coming up another day, another big media company with another big write-down. Yet this time around, wait, what? It's rallying. So what gives? The media roundup when we come back right here on Open Interest. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
All right, everybody, just about 15 minutes into the trade on this Friday. This is Bloomberg Open Interest. Let's get a quick check on stocks. And as you can see, we've got the S&P 500, call it little change. Kind of interesting after the week that is or was almost, down about 0.1%. NASDAQ 100, watching the tech trade, also just a hair lower, down about 0.2%. To the small caps, kind of the same thing, very quiet, probably low volume. We expected that, kind of going into the trade, just down about 0.1%, Matt.
All right, let's get to top calls. Some of the analyst action in focus this morning. First up, Daiwa is upgrading PayPal to an outperform and increasing its price target as well. The firm says it expects the online payments platform to have another positive earnings report in the third quarter, thanks to new services and marketing initiatives. Next up, Craig Hallam Capital is raising its recommendation on Akamai Technologies to a buy and increasing its price target there too. The software company raised its full-year forecast for earnings and gave an upbeat full-year outlook for revenue. Morgan Stanley and RBC Capital Markets are also raising their price targets on that company. And finally, Piper Sandler is downgrading Eventbrite. It's no longer a buy. The online event planning service lowering its revenue guidance for the full year and missing estimates for earnings as well. The results also prompting downgrades from Truist as well as KeyBank. Carol?
All right, keeping an eye on those analyst calls. We are also closely watching media stocks this morning. Paramount reported a $6 billion write-down of its cable TV networks, including Nickelodeon and CNN, but the company did report its first ever quarterly profit for its streaming business. The company also announced cost-cutting measures. Also looking at production studio Lionsgate shares after a miss on revenue in the fiscal first quarter. Stock just up about 1.25%. The company says it is still reeling from those Hollywood strikes that delayed its production timeline. So let's talk a little bit more about broadly what's going on in the specifics of these two companies. Bloomberg's Hannah Miller has been reporting on these earnings. You've had a really, really busy week. We know that. Paramount, help me make sense, because we've got the stock rallying in today's session. I'm thinking about Warner Brothers, 24 hours ago, that dropped about 9% on its big write-down. What's the difference?
Well, Paramount still has this Skydance deal that is supposed to be finalized in the first half of 2025. So that would be a merger with Skydance Media, and that has introduced a lot of unknowns in what's going to happen here. There's still a lot of bullishness around this deal coming through.
So Skydance is Larry Ellison's son. He's coming to buy Paramount.
I believe his name is David.
Okay. What's he going to do with the streaming business in terms of, because they're writing down the traditional linear networks, but they've got the streaming business that for a lot of companies is growing. In Paramount's case, it doesn't look like it is.
Yeah, so it's going to be all about cost efficiencies for Skydance. They've identified about $2 billion worth of cost efficiencies. And right now, Paramount is actually working to reduce $500 million in costs, including through layoffs. So we're going to see more tightening of the belt. Skydance is very big on that. So it's going to be very interesting the next few months as we see this play out.
Hannah, in general, in terms of what's going on in the media space, nothing new. We've been talking about that people are moving away from linear television, right? And then it's all about streaming. Is this just a continuation in terms of the stories that we're seeing this week?
Yes, that's right. We're probably going to see more media companies reevaluate their traditional TV networks and perhaps
do they
more
go away at some point? Can they go away?
They still make a ton of money, right?
They do, yeah.
They're still cash cows. They're just not rising stars.
Yes, exactly. It's, investing more in the streaming businesses, perhaps looking at joint ventures, partnerships where you can strengthen your streaming business, combine forces. But right now, traditional TV is struggling. Everyone is reevaluating and looking at, how the market conditions have changed rapidly over the past 2 years.
Business Week just did a story about CBS, like basically having like the top shows and constantly kind of churning out things that people are watching.
But what shows are on CBS?
There's the...
It's all about
We don't know because we don't watch it.
I wrote the story. It's all about
I do like CBS Sunday morning.
Yeah, there's a Young Sheldon spinoff that's coming up, Georgie and Mandy's First Marriage, that they're very excited about. There's NCIS spinoffs. It's all about using familiar characters and storylines, rebooting it, and keeping those audiences.
I was going to say, it's like
dominant.
nothing's changed for decades.
It was, yeah.
Forgive me, it was a great story, but it reminds you that, there's still stuff going on.
Yes.
All right, very cool. Hannah, thanks so much for joining.
You don't watch CBS at all?
I don't watch any linear TV, right? I don't.
Matt's always on his phone.
Really? No, I just have the Bloomberg app, and then I watch like HBO, which I guess they decided to call it Max.
Yeah,
exactly. All right. Thank you so much, Hannah. Great discussion, and I mean, what a fascinating industry this is to watch. Coming up, private equity and the peculiar rise of America's car wash obsession. We'll explain the connection next in our Wall Street Beat. This is Bloomberg.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg.
All right, everybody, this is Bloomberg Open Interest. A quick check on stocks now that we're, 22 minutes into the trading day, and I feel like we're not changing much. Turns out I'm good at math. All right, everybody, just up about 0.25% on each of those major equity averages. We keep saying whimper. That's what it feels like, Matt.
Yeah, out with a whimper, right? But we had a decent day yesterday, and I think the key here is something that you mentioned at the top. It doesn't feel like there's a lot of fear. It's just kind of boring. I normally wouldn't say that, but I think that's good news right now.
Yeah, I think it's good that we all just kind of calm down and take stock of where we are. So having said that, you got something to do.
Yeah, I want to talk about take my car wash. Time for Wall Street Beat. The U.S. car wash industry is growing like never before thanks to private equity. From New Jersey to California, cities and towns are feeling the sometimes unwelcome effects. Now some have decided to slow the surge.
Car washes are taking over the U.S. With 60,000 locations across the country, it's a $14 billion industry that's growing fast.
They figured out how to cut expenses just about every single point in the journey. Labor's down, right? The footprint of real estate is down often because these are smaller facilities. The cost of water is down because they're being a lot more efficient with water. When you look at the numbers, you can see why private equity is so excited. There's about 280 million cars and trucks across the country, and they tend to get pretty dirty. Secondly, the industry is already big and growing substantially. It's been growing at about 5% annually. A firm called Leonard Green and Partners from Los Angeles began investing in Mr. Car Wash, and that really turned into a tidal wave of investment. Now there's 50 plus groups investing in these chains and really expanding them across the country. So the real strategy here is the membership model. One private equity analyst told me that if you were to change 10% of drivers to this membership model, you would increase the industry's profit from $2 to $3 billion on that front. Big cities have seen an incredible growth, so much so that you're seeing these so-called saturation bans take effect there, where municipalities are pushing back and saying, hey, I think we have enough car washes, we can slow down a little bit.
All right, I have a membership at my car wash because I go so often.
Of course he does.
There are no unwelcome effects for me.
Don't you like washing your own car? Didn't you grow up washing cars?
I sometimes do, but I do it so often that I just don't have enough time to wash my own car every time. So I'll go to the Charles Oakley, the local Scarsdale car wash.
This is not a paid endorsement.
Whenever I can.
Matt is not a paid spokesman for
It's a basketball player. No. Anyway, I think it's really fascinating that private equity is getting so big into this. Mr. Car Wash is one I used to go to in Berlin, so it's a global chain.
You know what's interesting? I saw this statistic that more car washes were built in the last decade than all the preceding years combined. That's a lot.
Yeah, well, we have a lot of cars on the road.
And people aren't doing it themselves.
And people keep their cars longer and longer. So, you know, if you're not going to buy a new one, the next best thing is like new wheels or wash it. And
it's also kind of an easy spend, I think, in general, right? Like it doesn't,
and it depends
on where you go.
It's a little bit expensive, right? Unless you're a member, like you can spend $40, $45 with the full wash and then a little bit of a hand wax and dry at the end. Okay, we got to go. Speaking of autos, coming up in the next hour, we're going to speak with the CEO of a website on which I spend many hours every week, Car Gurus. Plus, we're going to talk about something that I really love, which is sandwiches.
Sandwiches. Well, that's later on.
Yeah.
And salads.
We're going to talk to the CEO of Potbelly later on. In terms of what you need to be watching next week, on Monday we get the New York Fed, one-year inflation expectations. On Tuesday we get PPI data, and we get earnings from Home Depot as well. Wednesday we get CPI data, so a lot of inflation, and then earnings from Walmart and Deere next week. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Carol Massar. Katie Greifeld and Chanelli Bosek are off on this Friday. Coming up, everybody, a turbulent week in markets draws to a close with debates on what's next for stocks, bonds, and central banks. Also, the week ahead brings a slew of economic data as investors search for more signs of resilience in the world's largest economy or for some weak spots. And with fears that U.S. consumer spending is softening across the board, we will get the view from the C-suite twice this hour with the CEOs of Car Gurus, a car shopping site, and the sandwich chain Potbelly. So you get a sandwich and then you jump in a car.
I love it. I love it. Let's get a check on what's going on with the markets. A little bit of a whimper to end the week, at least for now, right? The volatility has proven us that we can see whips around, but the S&P 500 is down about 0.3% after a positive finish to yesterday's trading session. You have the NASDAQ 100 right now down about 0.5%. The U.S. 10-year yield coming back down. Yesterday, we briefly went above 4 on the 10-year yield. We're still holding up there in the 2, but the 10 is back down to 3.93.
Yeah, just a tease there, right there. All right, it's a busy week for economic data coming up. We get New York Fed one-year inflation expectations. That's on Monday, followed by some key inflation data on both Tuesday and Wednesday. And then, don't forget, we get retail sales data. That comes your way on Thursday. And then the University of Michigan consumer sentiment. That will come 1 week from today on Friday. Cameron Dawson is New Edge Wealth Chief Investment Officer, joining us on how equity markets are positioning. Cameron, this is a market that does trade from, I feel like, economic data point to economic data point at this point. But what's front and center for you in terms of what's next for the stock play?
Yeah, it certainly is that growth story, which is that we continue to see this narrative ping pong versus growth falling off a cliff or everything's perfectly fine. And certainly that's why data next week will be watched so very closely. Because if we are going into a weaker growth environment, it does suggest that you would need to see GDP and EPS forecasts cut. And usually when you're cutting forecasts, you're also derating multiples. But if growth is more resilient, then of course, maybe we can make those growth forecasts. Then it's a question, of course, of what that means for the Fed. We've been hearing from the Fed this week that they don't seem to have the same urgency as bond markets. So when you put it all together, we do expect this equity market volatility and bond market volatility to continue.
All right, in terms of the Fed and really the inflation picture, I want to focus in on, Cameron, because you point out that as inflation comes down, we don't see companies with a lot more pricing power. Now, earnings season has been great, right? But Delta, Pepsi, ConAgra have all come out with reports that point out they just can't raise prices anymore. The consumer is done with it. Is that a problem going forward?
I don't think it's a problem for the Fed. It's actually really good news on the CPI front, but we do think it's a problem for corporate profit margins. One of the things that we've learned over the last few years is that inflation is really, really good for corporate earnings. It gives them pricing power. It drives top line revenue growth. It allows them to be able to pass on input cost increases to the end customer. And result is margins are better. But if you go into an environment where you're hitting a wall and how much you can raise prices, it means that companies are having to eat these input cost increases, which is why we think margins are the biggest watch item as we go into 2025, because we continue to hear from companies that they just can't raise price anymore. It pushes more pressure onto volumes to deliver. But what we're also seeing is that they're having to cut price in some areas in order to get higher volumes. So it just makes watching that corporate margin line ultimately important.
So super important. Hey, Cameron, I want to ask you, because last month you guys, you were on and you said for fresh capital, we look at quality names and laggard indices, value, international, small cap, but don't chase junk. I guess what I'm always interested in a week like we've had, how much of your thinking about where to place fresh capital, how much of that has changed?
Certainly taking some air out of growth multiples has helped, and we did do some upgrading in quality even in our growth portfolios, where we took advantage of prices coming in significantly and some positioning also coming in. But the message still here is that we think that you have to remain ultimately focused on quality. We think that we're still in this rather uncertain economic environment, which means that junk may rally in a short period of time because yields fall. But if you do actually see economic weakness come to bear, it just means that yields could be falling for a bad reason and junk can reverse all of those gains. So super disciplined about valuation, but also very, very focused on quality.
In terms of what you want to stay away from, Cameron, are there any other shoes to drop? You know, we saw the carry trade pop up over the last week, and I think many people probably hadn't been watching for that. So are there other positioning worries? Are there any brown swans? What keeps you up at night?
Well, one of the areas that we still see positioning is fairly stretched is within large cap growth and the mega cap names, which just means that we shouldn't be all too surprised if there is more volatility there, because you're still sitting with positioning in the 96th to 98th percentile, which just means that people are still very much on one side of the boat. The good news about the last week is that where we were seeing positioning overall be in extreme levels for things like short Japanese yen or long US equities, they've moved out of extreme. They're still stretched, which just means maybe a source of continued volatility, but not nearly as stretched as they were at the beginning of the week.
Cameron, bottom line, do you invest like a recession's coming at some point?
We don't invest specifically in anticipation of a recession. What we tend to find is that defensives that do really well during recessions tend to have what we call episodic volatility to the upside. So you get a burst higher as everybody surges into your traditional staples and utilities, but they tend to give it all back up over the course of the recovery, which means that for very long-term investing, our preferred approach is to focus on quality. We see it as an all-weather kind of investment strategy, where we may lag in times where junk is doing really well, but over the course of the entire economic cycle, we can invest with names that have defensive qualities to them, that blocking and tackling from company management teams, without having to be in typical defensive businesses, which of course lag when you have a big rally to the upside.
What about value? We had a guest on last week who pointed out that over the last 11 elections, value outperforms growth for the 6 months after the vote. Do you like value here?
We like value for incremental capital, but it has to come with a very sharp focus, again, on quality, because a lot of the value index has very low quality names in it that might get a short-term boost. Maybe it does last that 6 months, but buying something just because it's cheap has certainly not worked over the long run, at least in the last 20 to 30 years. So what we try to do is marry within value of some left behind areas where we see light positioning. We like the business models. They do do trade at discounts to the overall market. And then that allows us that if you even get that short-term pop, you participate in it, but you don't give it back on the other side when things start to move on.
I got to say, Cameron, it does feel like everybody's kind of a lot calmer than how we started the week, a little quiet. So
Calmer
I feel
than
like
you are.
I feel like
Calmer than you are, dude.
I feel like then that opens the door for me to ask, what's with the astronaut behind you?
Spaceman?
Oh, this is New Edge's unofficial mascot. So this is our lobby in Stamford, Connecticut. And so we have our spaceman mascot.
I love it.
We need a mascot.
That's very cool.
I want a mascot.
Well, we do. We have fish. We have fish all over the building.
Oh, that's true. That's true. All right, Cameron, thank you so much. Have a great weekend. Cameron Dawson of New Edge Wealth joining us right here on this Friday. All right, let's get a look at the stocks moving at this hour. Let's get back. It's really quiet, but let's see what Abigail Doolittle is watching. Abby.
Yeah, there's quite a bit of action, Carol, for the chip space, actually. Taiwan Semiconductor, trying to get my words out on this Friday, now higher by about 0.6% after saying that sales in July did surge by 45%. Continued AI demand for those chips. But not so long ago, this stock had been down, and earlier in the pre-market had been higher. So lots of uncertainty in this chip space, as you can see, with NVIDIA down just slightly, but the fluctuation, the uncertainty of what is ahead relative to the big rally that this stock had at one point, up 180% into its peak so far this year. AMD down 1.7%, and Intel, which is really in a bad way, down more than 70% over the last year on continued issues, down 3.6%, a key area to keep an eye on. As for some individual movers and turning to more of a bright spot, let's take a look at Eli Lilly, up 5.6%. This after gaining nearly 10% yesterday on that blowout quarter and guide. It's not every day that you see this kind of strength continue, but we are seeing that for Eli Lilly. So just really want to remind everybody of the buyers continuing to step into Eli Lilly and the idea that Zepbound and Mounjaro are very strong. Investors want a piece of it. And then finally, this is really interesting to me, Matt. Take a look at the shares of Expedia. I know that you guys have been looking at it before, up 7.77%. This after a 12% earnings beat, sales were better. They are warning of soft demand, but investors looking past this. And the reason this is so interesting to me, it seems everything else or a lot of other companies related to travel, whether it's Airbnb or TripAdvisor and so many others, American Express saying that experience and dining is weak, and the shares of those stocks being punished a little bit after talking about that kind of weakness. Not the case with Expedia. Investors looking right past it on this Friday.
Yeah, it's interesting. I noticed that yesterday, last night too. Carol and I broke these earnings at 4 o'clock with Romaine. You know, they go through every single company that puts out earnings. I noticed that too, and I thought maybe they took their lumps already, Abby, but they're actually up 10, 11% for the week.
Yeah, it's hard to know exactly what it is that investors like about this story so much relative to the other ones. Maybe the fact that the company is a little bit larger and also in so many different areas of travel that diversification perhaps makes it a little bit easier for them to weather that storm. But the management themselves, that company, is saying that they are seeing some weak demand. So, and just to put this gain into context, this is great. Take a look at this on the week, a tremendous week, up 11%. So sometimes in a tough market, investors go where the strength is, go with the momentum to the upside, and this seems to be one of those plays this week.
All right, and meantime, you look at something like Airbnb this week, and it's down almost 10%. So a very different story, even though, you know, similar
Well, they don't
stories.
have the diversification that Abigail mentioned. I think that's a really important point. Abigail Doodle, thank you very much for that. Abby giving us a look at some of the individual stocks moving this hour. Coming up, we're going to talk about Car Gurus, putting the pedal to the metal.
You don't like cars, do you?
In its latest quarter with an earnings beat. We'll find out what's driving the strength
See what
of
they
the
did
company.
there?
Yeah, the CEO is going to join us. Jason Trevisan. This is Bloomberg.
covers earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's get to high interest now. Look at what's making headlines around the world. China has lodged a complaint with the World Trade Organization over the European Union's decision to impose anti-subsidy duties on Chinese electric vehicles. The move comes after the EU placed tariffs on some car imports from China as high as 48% last month, and it escalates a dispute that's straining the relationship between the two global powers. It's been a tough couple of years for Wall Street bonuses, but a new report suggests that might be about to change. Bankers are set for bonuses to swell by as much as 35%, according to compensation consultants Johnson Associates, with debt underwriters standing to see the biggest bump of all. And top executives from Citadel had a hand in giving two giant pandas a home in San Diego. Ken Griffin and Peng Zhao, CEOs of Citadel and Citadel Securities, respectively, were lead donors to the San Diego Zoo Wildlife Alliance to prepare Panda Ridge for the bears' arrival. And we thank them.
They look so sweet, but don't get close.
No, they'll rip your arm off.
They will,
yeah.
Indeed. Can we talk cars?
Yes, let's talk about company news right now. Online car sales platform Car Gurus making its third consecutive quarter of double-digit growth, sending the stock off to the races here. You can see it's up almost 20%. The company's CEO, Jason Trevisan, says, quote, "Our marketplace business continued to accelerate, achieving the largest quarterly revenue increase since 2021, driven by higher adoption of add-on products, continued migration toward premium subscription tiers, and expansion in our global paying dealer base."
What does that mean?
There's a lot of CEO speak there.
Yeah,
Let's talk to the man himself. Jason joins us right now to talk about the quarter that was. Is it a global business? Are you looking at a global dealership revenue flow?
It is. It's global in the sense that our marketplace exists in the U.S., Canada, and the U.K., and so we consider that global.
It's a service, I have to say, that I look at almost every day. What I love about Car Gurus over the competitors is that you can filter out for so much. However, I have a couple of questions. If I look for example, a manual Ferrari or Porsche, a lot of sellers disguise F1 and PDK transmissions as manual, even though there's no stick. They're just flappy paddles. The same is true if I look for a convertible Corvette. A lot of sellers will say a coupe is a convertible because the top is removable. Is AI going to help us solve these little glitches?
It sure is, and we have been trying to solve those glitches for a long time, and we've done a good job at it. We get inventory feeds from tens of thousands of dealers and individuals on literally millions of cars, and it's very messy data. And we've always considered ourselves a search and a data business, and so we have cleaned that ontology, we call it, and made sense of it to try to provide the best search results possible. AI is making that undeniably better. We're using AI in upper funnel searches to help people understand what type of car they might want. and not based on deciding between car A and car B. They're saying, I'm a father of 3, I live here, and these are my activities. What type of car should I like?
Yeah.
Almost no car has room for rear-facing car seats. Like almost none.
Which is crazy.
Yeah.
Because you have to have them. Hey, Jason, I care what Matt is buying and what cars he's interested in, but what I really care about is what consumers are doing, because there's some, color commentary in terms of it looks like consumers are trading down, maybe looking for a deal or looking for a cheaper car. What can you tell us about consumer sentiment?
Yeah, consumer sentiment right now is all about vehicle affordability. With interest rates high and the fact that used cars and new car prices are both about 30%, 35% higher than they were pre-COVID, consumers are having a hard time finding cars that they can afford. So affordability has really skyrocketed to be the number one factor that consumers look for. We see that on our site. We're the largest automotive, and so we have the most shoppers, we have the most inventory. So we have the best view as to all of the shopping trends, and consumers are looking for lower priced cars and stating that affordability and reliability are their 2 number one drivers.
Anything there, though, Jason, that tells you that maybe a recession's coming?
We fortunately, even in varying macro environments, dealers need to sell cars and consumers need cars. They may hold on to them longer, they may drive them longer, but they still need to buy used cars. We don't think that a recession is coming from our perspective. We don't see the signals for it. And when we look at some of the macro signals, our expectation is that it will be a softer landing. But we certainly see, while consumer spending remains high, they're looking to spend less on cars.
I wonder about the headline prices. For the most part, what you see is what you get, but I've noticed that dealers from Long Island, New Jersey, and Chicago are the worst at adding thousands of dollars of fees in the small print. How do you get around that? Because it's not a great customer experience if you think you're getting a GLS for $49,000 and then you find out at the end of the deal it's really $59,000.
I totally agree. That's a terrible feeling. So we do a lot to try to fight that. So the first thing we do is we have dealer ratings, and that allows consumers who have that experience to voice and share that. And dealers that do that on our site will absolutely see a lower dealer rating, and as a result, their search results will not get shown nearly as much. The second thing we do is we kick dealers off our platform. If we find out that dealers are doing that, if they have hidden fees, then we will not allow them or their inventory to be on our platform.
Hey, one other thing I want to ask you about, because we have talked a lot and done a lot of reporting here at Bloomberg about the interest in car buyers for hybrids over EVs. What kind of color can you give us around that debate?
We see the same, or the shopping behavior that we see on our site is similar to what you're seeing in the headlines, and you just gave a great example of that. That doesn't affect the financial results, say, of our business as much, because whether a dealer is selling a hybrid or an EV, we're helping them understand the consumer trends in the market, how they can turn their cars faster on their lot, and giving them intelligence on pricing. We're also at the same time giving consumers the benefit of other consumer reviews of cars. We're allowing them, like I said before, to compare cars better than we ever have before and really help them find the right car for them based on what matters. And that's where AI is playing a big difference. Historically, a consumer would need to know, this is the type of car I want. Now a consumer can say, these are the 10 most important things to me. Help me find the car.
I just want to say dealer ratings, 2 thumbs up. I think you're right about that. It works well. One question about Carfax versus AutoCheck. Carfax is great, and you can click through and find out right away if it's been in an accident, how many previous owners, etc. AutoCheck always leads me to a screen where they want me to give them $20 or $30. Why even use the latter?
I can't speak to the value propositions of those 2 businesses. I think understanding the history of a vehicle is incredibly important. We do everything we can to give as much information on not only the dealers, like we were just saying, but on the cars as well, because it is, when you're using...
This is keeping on the markets here. Dollar extending losses. That's the Dixie down 0.2%.
And we do everything we can to empower the consumer as much as possible in what is can be at times an overwhelming purchase process.
All right, lots of fun. So enjoyed checking in with you. Jason, thank you so much. Jason Trevisan, he's CarGurus CEO. Forgive me, stumbling because I'm looking at the share price. It's up 17%.
Yeah, it's absolutely ripping face right now.
Last night I was looking at the year to date. It was down on the year, and now it's up on the year just because of the surge that we're seeing. A bunch of analysts, too, upping their price target on the name.
The earnings report impresses, and it's an addictive platform, I have to say. If you start spending time
From
on
someone who knows.
Yeah.
This is what he watches. He's not watching streaming or TV. Anyway, still ahead, superhero success at the box office has Disney splashing the cash abroad. Ugh. It's Friday. I'm having a trip.
This is a movie, like all the kids love this.
We're going to explain in today's Social Climbers. Getting it out here. This is Bloomberg, and this is Open Interest. Yeah, don't you watch?
I don't watch comic book movies,
You're missing out.
Yeah.
Morning from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes every.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It is time now for Social Climbers. The company's making waves on this Friday morning. First up, Disney breathing some new life into superheroes. After the breakout success of Deadpool and Wolverine at the box office, Disney plans on spending $5 billion in Europe to produce movies and TV shows over the next 5 years. Next up, Amazon has a new secret weapon in its same-day delivery operation, a fleet of Kia Souls. The boxy cars will handle quick deliveries that the company currently delegates to its Amazon FlexGig economy service. The move is designed to give the online retailer more control over its deliveries. Finally, McDonald's is hoping to tug at Gen X heartstrings and their purse strings. The burger giant is introducing a new collector's meal that include collective cups featuring brands like Hot Wheels, Hello Kitty, and Grimace. The promotion comes as McDonald's reported its first sales drop since 2020. Matt, is that going to make you buy?
No, but I love Grimace.
All right, who doesn't? You can follow all the latest company buzz on TrendGo. Just check it out on your Bloomberg terminal.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Looks like we're starting to see a little bit of a turnaround in markets here, at least some green on the screen if you look at the S&P 500. Let's get a check on what's going on in the markets with Abigail Doolittle. Abby?
Well, it is, of course, Friday, so on a weekly basis, it's interesting. Right now, we're looking at the possibility of an up week for the NASDAQ 100. It would be the first in 5 weeks, but the S&P 500 on the week still down about 0.5%, but off of the lows as markets today, to your point, do turn around a little bit. I think a key driver for next week will, of course, be that dollar-yen at the lows, down 3.3% as that carry trade unwound. It does look like there could be some more ahead of that just looking at the charts, but right now you can see that dollar-yen down just slightly. Crude oil getting a nice bid, and then take a look at this 2-year yield backing up about 14 basis points, back above 4%. Now, I was just mentioning the NASDAQ 100 possibly having an up week. If we put this into the context of the last month or so, the selling that we've had for these indexes, the Russell 2000 is the one index that has a small gain. You can see that the NASDAQ 100, the SOX, and the S&P 500 all down quite a bit. The SOX, that chip index, that pressure from NVIDIA and some of these other ones, TSM, notwithstanding today's positive results around the July sales surging, AMD really dragging on that index, and then there's the NASDAQ 100 and the S&P 500. I suspect next week it won't just be the yen that will be key in these chip stocks. It will also be some of the data. On Tuesday, we're looking at U.S. PPI, and then Wednesday, CPI, and then Thursday, U.S. retail sales, and then, of course, Friday, University of Michigan expectations for the month of August. So these could be big drivers. And then there's one earnings mover, Carol, that we have not talked about yet today, and it is surging. That is Sweetgreen. Take a look at it here on the year, up 209%. The last time I looked on the day, up 27%. They put up a good quarter. They beat the sales. Importantly, they raised the full year guide. Key metrics very strong. And there is a 14% short interest. So I suspect that some of this move, and certainly some of this parabolic move today on those very good results, well, probably a bit of a short squeeze.
All right, Bloomberg's Abigail Doolittle, thank you so much. Got to say, I love a salad for lunch, but is it still salad days for the consumer? Let's put that question to Potbelly CEO Bob Wright. The fast casual chain just reported its 13th consecutive quarter of year-over-year retail margin growth, and he joins us on this Friday. Bob, great to have you here with us. Talk to us a little bit about business, how it's going, and what you are seeing from consumers specifically, if they are still spending.
Yeah, it's great to be with you. It is a challenging time for sure. The consumer is, you know, they're focused on managing their wallet after all these years of inflation, and then we see what others are seeing. Their wages haven't quite kept up with that, so they're just doing some trimming. And you see restaurant visits under a little bit of pressure, especially from more infrequent consumers. But in our quarter, we were up in sales 0.4% on top of 12.9 a year ago. We built 4 new shops. You mentioned our 13th consecutive quarter of shop margin expansion, so the profitability is there for us. And Potbelly's really about a long-term growth strategy, especially through franchising. So we think we put another quarter in place that built on that promise of the capability of the brand to grow.
We do want to talk about that build out and that franchise model. Go back to comp sales, as you said, up 0.4% versus almost 13% a year ago. Why is there such a big difference?
Well, a lot of it is what I think you've seen in the industry starting this year. The January turn in the consumer behavior definitely kind of came to be with all of our customers and the restaurant consumer more broadly starting in 2024. And what we've seen in particular is our less frequent and less digital customer is the one that may be looking to peel back some visits, not with Potbelly. There's not a value challenge with Potbelly, but just in general, they're managing their overall spend and turning to the refrigerator maybe once or twice more often than they had in the past. So that delta in sales growth for us is, and the challenges for us this year is rooted in that consumer. I will say, however, the digital side of the business for us continues to grow, and that's reflective of those customers that we do have a more affinity-based relationship with. In fact, 40% of our business now comes through digital channels. Pre-pandemic, that was in the single digits. And it's up 200 basis points from last year. And the majority of that 200 basis points of growth is people moving from third-party digital channels into our Potbelly-owned digital channels. So we're very pleased with what we control. But there's no question that the broader consumer and those that are a little less loyal to a lot of different brands are looking for reasons to hold on to those visits. That's why we rolled out our $7.99 skinny combo this quarter.
Right. A little bit more
at the beginning of this quarter.
A little bit more expensive. You know, some of the fast food chains, which I'll differentiate Potbelly from, you know, like a Burger King, McDonald's, Wendy's, obviously, but they're going at the $5 price point. Why do you pick $8?
Well, I think when you see a lot of, especially the fast food chains, and do significant discounts on core items, the amount of business that it takes to overcome the break even on that is significant. And what we did is we studied what our consumers are actually telling us. Those less frequent customers said, look, if you can get me below $9 at lunch, that makes a difference in my decision making. And we believe going below $9 all the way down to $7.99 made an even bigger difference from them. In fact, those customers that have ordered that $7.99 combo, it's a full meal. They're not looking for a discount on something that still leaves them hungry after lunch is over. They want to have a meal and they want a good value and they want it to make sense with the rest of the menu. Those customers that have ordered it from us give us 7 points increased scores on value and a 5-point bump on intent to return. So it's doing exactly what we wanted while still being healthy for our overall business.
You know, I'm sure you don't watch your stock price on a daily basis, or you're not going to run the business to change the stock price on a daily basis, but you've outperformed Sweetgreen since they went public. We've got a chart here, and your stock has come down since the beginning of the year. What do you think needs to happen to turn it around and boost it back up?
I think we're in the middle of that transition, and particularly the growth investors are looking at our stock and they're looking for just a few more proof points over the next quarter or two that the growth is really there. When we started as a primarily company-owned business model to shift to franchising and to get that franchise growth acceleration really moving is something that not a lot of brands have seen, and not a lot of investors have seen that done successfully. We're in the midst of that success. We have 663 open and committed shops. More than a third of those, or about approximately a third of those, are those committed by franchisees to build. They're on track with their development commitments. Not only that, but when they're opening shops, they're opening them at volumes that are better than they expected and higher than the system-wide average. But I do believe that a lot of the growth investors are just watching for another quarter or two to see that that unit growth development truly is part of the story, and that the rest of our execution with digital, with operations execution, our ability to continue to deliver a great menu is part of that transition.
But just to go a little bit further, Bob, I mean, with a stock that's down 31% so far here in 2024, that's got to put a little pressure on you guys to watch overall costs. So how are you incorporating that kind of into the financial picture?
Yeah, we talked about that last quarter and this quarter. Look, we're a pretty straightforward investment. Our adjusted EBITDA and the multiple that we get rewarded for being a growth company is pretty much where our value comes from. And so protecting that profitability, you might have seen in Q2, we made $8.5 million. It was the very high end of our guidance range, even with a little more of a difficult top line. How do we do that? Margin extraction at the shop level, again, a record 13 quarters there. And then we're meeting our G&A. We're being very careful not to trim areas that are going to feed that growth, but we think it's our responsibility to manage the overall P&L and make sure we're finding profit extraction in the short term to hold that profitability to the year.
Bob, last question. You mentioned 40% of the business is digital. I mean, do you anticipate that at some point it's a lot more than that? What's the business model going forward? Is it also important to have the in-store or in-restaurant experience as well? Give me an idea, percentage breakdown, though, over the next couple of years.
Yeah, I'm so glad you asked. We haven't set a target on where we think digital should be or where we desire it to be. We're not an online business like maybe a pizza business or wings or something that, you know, trying to move almost all of their business digitally. Our in-shop experience is very important to us. And frankly, people order digitally and still experience their meal consumption in shop. They can order for pickup and walk to a table and go ahead and consume their meal. It is reflected in our prototype. We've shrunk our prototype by about 500 feet to reflect that future, but that prototype still has seating. It still has that great potbelly feel inside the shop, and it still allows for people to use us the way that makes sense for them. I do expect our digital business to continue to grow, particularly because of the Perks loyalty program that we have. We see frequency improvements in every single cohort in those Perks customers, and we think that's the engine that keeps building the digital. And then, of course, catering. We had a great quarter in catering, and that continues to move into the digital space as well. So I think those two will be the key drivers of digital growth, but we have not set an arbitrary goal to set it at a specific number.
All right, going to leave it on that note. Listen, have a great weekend. Bob, we appreciate it. Potbelly CEO Bob Wright joining us, and shares of Potbelly right now up about 4.6%. All I'm going to say, Matt, is I'm hungry. Yeah.
We'll go out and get lunch as soon as this program's over, Carol.
All right, coming up, the domestic economics of international trade. Michael Strain of the American Enterprise Institute on how free trade affects jobs. That is coming up next. This is Bloomberg Interest, Open Interest, and this is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Time now for our daily Wall Street Week conversation. One thing that Democrats and Republicans have agreed on is America's need to be more competitive with China. But the parties' trade policies still differ. Wall Street Week's David Weston asked the AEI's Director of Economic Policy Studies how trade policy is being used to contain China.
In terms of a bilateral trade deficit, not the trade deficit between the United States and the rest of the world, but the trade deficit between the United States and one other specific country, in this case China, tariffs can be more effective. And if you look at the bilateral trade deficit between the U.S. and China, what you saw is that it did go down. But it really kind of matters how you measure trade deficit. And so the measure I'm referring to just counts the number of goods coming to the United States from China. If instead you want to look on a value-added basis, so of all the stuff the U.S. imports, how much of the value added, how much of the different stages along the supply chain in any given final good came from China? And there you see that the trade war with China was much less effective at reducing trade with China. Instead, what happened in a lot of cases was that, China provided a lot of the value in the manufacturing of a certain good. And then China shipped a product that was almost finished, but not totally finished, to another country, to Mexico or to Vietnam. Mexico or Vietnam put the finishing touches on that product. It comes to the United States. That is technically not an import from China. It's technically an import from Vietnam or from Mexico. But China, may have contributed 90% of the value or 80% of the value of the manufacturing of that good. And so, really, we're still importing from China in an economic sense. It just doesn't show up in the official bilateral trade deficit.
Michael, in your paper, you refer to Jake Sullivan's talking about a new Washington consensus, because it feels increasingly like both Democrats and Republicans are kind of moving away from free trade. Make the case for free trade. What do we expect? What do we get out of that? What's the case on the other side of the equation?
So, a lot of politicians talk about trade as a jobs program, and I think that's the wrong way to think about trade. What trade is really about is consumption. What trade is really about is productivity. What trade is really about are higher wages for workers, higher incomes for households over the long term. That's why you want to trade. You want to trade because trade allows each nation to specialize in that nation's comparative advantage. That makes the workers in that nation more productive. That makes them more valuable to businesses. That makes businesses compete more aggressively for them. The way businesses compete more aggressively is by bidding up wages. So now you've got higher wages, higher incomes, and higher living standards. That's the way we should be selling trade. In terms of the level of employment, that's really a job for the Fed. The Fed's job is to make sure that we have maximum sustainable employment, to make sure that we are at full employment consistent with inflation being low and stable. And so if you have a period where you've got, too much unemployment, the Fed should be stimulating the economy to get people back to work. If you've got a period where you've got too much inflation, then you've got excess labor demand, the Fed should be cooling things down. Trade really doesn't have a lot to do with that. Trade really doesn't have a lot to do with the level of jobs in the economy. Trade is not about how many people are working. Trade is about what are workers doing. And if you allow free trade, what you're going to get is a situation where what workers are doing is what they are best at, what they are most productive doing, and that's how you get higher wages and higher living standards.
So speaking of the Fed is very much in the news this week after those somewhat disappointing jobs numbers last Friday. A lot of talk about rate cuts, maybe even emergency rate cuts, things like that. So how is it doing right now from your perspective? Before those jobs numbers, you said it was too early to really be cutting rates. Do you have a different view now in that balance between unemployment on the one hand and price stability on the other?
Yeah, so before we got the last jobs report, in my judgment, it was premature to call for the Fed to cut in September. I thought the right thing to do was to wait for more data, to wait for a couple more employment reports, to wait for a couple more inflation prints, and to wait for more of the weekly data that comes in before making a call. Maybe the right thing to do would be to cut. Maybe the right thing to do wouldn't be to cut. But where the economy was prior to the last jobs report looked like an economy that was too strong for rate cuts. And it looked like an economy where the relaxing of overall financial conditions, stock market boom, creating a lot of wealth that drives consumption, that dynamic, the market was doing a lot of the Fed's work for it.
And that was Michael Strain of the American Enterprise Institute talking with Bloomberg's David Weston. Tune in to Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
In June, a mystery investor made a record $2.7 billion wager on long-dated treasuries, creating waves in the ETF market. That investor has now revealed himself as Brent Schutte of Northwestern Mutual Wealth Management, and he says that the firm's recession call is very close to happening. Joining us now is Bloomberg's Emily Grafeo for ETF Friday. So what, he bought TLT in size?
Yeah, it was the largest TLT inflow ever, and this was back in June, but
this really excited the ETF crowd because TLT was a fund, this is BlackRock's 20-plus year Treasury bond ETF, that people were just timing wrong. All of 2022, people were piling in, and then it performed really badly, and then when it was performing well, people were flowing out. So this actually seemed like a pretty good trade. At least for right now, he's up almost 3%, but it's been a very volatile week.
So what is he saying now?
So now he's saying he bought in June thinking a recession is getting closer. Now he said we're inching ever closer, just looking at the recent economic data that we've had. So he's going to hold this, he said, at least for a year, 18 months. And this is a bet that he's making on behalf of retail.
I was going to say, walk me through this trade, because it's not like Northwestern Mutual is like, hey, let's make a $3 billion bet.
That's right.
They hold a lot of client assets, right? So is it spread among retail accounts?
It's spread among retail accounts. So that's why it's $2.7 billion. It's not like this was one trader sitting with all this money and investing it on behalf of himself. But he's the chief investment officer of the wealth management business, so he kind of oversees what's going in and out.
As someone who watches the ETF world in a week where I feel like, we're talking about the Fed needed to make aggressive cuts right now, and we're thinking about recession, or I feel like we're talking about a lot more, how do you think about his move against kind of the broader ETF space?
Well, I mean, it's been a volatile week, so I think this was a well-timed trade, at least for now. We'll have to see how it works out. But it's been very interesting because we haven't seen an escape, like a rush to the exits in the ETF space. We've actually seen net buying on the week in terms of equity ETFs, and we're still seeing a lot of buying in these speculative areas of the market. There's
Seriously?
a 3x semiconductor ETF, so it goes 3 times leveraged a semi index, and it's been getting inflows like almost every day.
That's
billions
kinda wild.
of dollars.
That's
so
wild.
I think that's at least one sign that there's still bullishness in the market even after the week we've had.
TSMC would say, I told you so, right?
That's
Based on what they came out with today.
All right, Emily, thanks so much for joining us. Emily Grafeo there. You can tune in to ETF IQ. That program airs every Monday at 12 p.m. Eastern to learn more about the industry. Let's get, though, to the trading diary, what you need to be watching next week. On Monday, we get the New York Fed one-year inflation expectations. By the way, we're hammering this in because these eco data points have really been driving big swings in the market, especially when it comes to inflation. So Tuesday, we're going to get the first piece of inflation data with PPI. Earnings come out from Home Depot. On Wednesday, we get more inflation with CPI, and then earnings from Walmart and Deere on Thursday. So a lot going on.
See what it does to shape the trade next week. Let's get to what's happening on this Friday. Let's get a quick check on the markets. Folks, some green across the board. A little bit higher, just up about 0.2% on the S&P 500. NASDAQ up about 0.1%. Very quiet today. And taking a look at the 10-year note, just down a hair, if you will. We're looking at a yield of about 3.94 here. So kind of quiet.
Was that hair comment on purpose?
Oh my God, what is that?
So
who let them in?
We had, other than today, it was a roller coaster week. And Carol has joined me today. We have experienced roller coasters in the past together. In fact, we were on air together during the Great Financial Crisis.
Right.
This is, I think, from 2010.
See what the crisis did to you?
Yeah, I lost all of it. I was already in the process of losing my hair. But, I thought a lot on Sunday and Monday about the time that we spent together on air, because I was used to coming on the program with you and saying, wow, the Dow has fallen 1,000 points.
It's really interesting because we were on air together on Monday, certainly on Bloomberg Business Week. And it was interesting because you said, watching what was happening in Japan overnight made you a little bit worrisome. I have to say, it didn't feel like the Great Financial Crisis, where you have to watch kind of the financial industry. Do we start to see strains within, lending and so on and so forth, things slowing down? That would get me a little bit nervous. Having said that, we'll see what the data brings next week. But
one thing that we're hearing from everyone we talk to about any kind of comparison to the GFC or LTCM is that you don't have the kind of leverage embedded in this market that you did then. Certainly not for the consumer. And that should be...
Slow your roll is what they're saying.
Exactly. Coming up next week on Open Interest, we have a busy C-suite for you. Mark Bristow of Barrick Gold and Kate Johnson of Lumen. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with
Live from San Francisco, this is Bloomberg Technology. Paramount up as the Nickelodeon and MTV parent follows Warner Brothers in a big write-down of its cable TV networks. And cybersecurity firm Akamai jumps as the DDoS specialists post strong numbers amid scrutiny of the cybersecurity sector. Plus, tech for Kamala. We speak to the technology leaders and Silicon Valley Democrats backing the vice president's bid for the White House. I want to get straight to financial markets and the NASDAQ 100. Very tech-heavy index. You have the mega caps and the higher multiple software names. What you're seeing is a 5-day chart of the NASDAQ, and it is completely flat, 0% over the course of the week. But there is peril within that, because if the NASDAQ 100 closes down negative on a weekly basis, that would mark 5 straight weeks of declines for that index, which is the worst run of weekly drops going back to May of 2022. If it's positive, it snaps a 4-week decline streak, which it had seen in April, and things look a little bit rosier. We are worried about growth. We're worried about a little bit geopolitical risk, but earnings have been a mixed picture where in aggregate, we're probably feeling better about the technology sector. In part, AI infrastructure. That brings us to TSMC. The chipmaker sales grew by 45% in July on strong demand, in particular, it would seem, for AI accelerators. Those are the US ADRs, or US listed shares of Taiwan Semiconductor, up 0.8% in the US session. Bloomberg's Ian King is here with me in San Francisco. The data is for the month, and we're trying to sort of extrapolate out and say, well, for the quarter, what does that look like? But I guess, big picture, it's bullish, because TSMC is the chip factory for the world, basically.
No, exactly. All roads lead to Hsinchu. Yeah, no, 45% is dramatic, right? That's tremendous compared to where we were last year, but we have to put that in context. Part of that was last year things were depressed, so a lot of smartphone market-related chip orders weren't that great. But if you're worried about this AI infrastructure build-out, if you're worried about what NVIDIA is buying, what AMD is buying, what even Intel is buying these days, this tells you, nope, they're still putting orders in, and those factories are still working flat out.
Okay, in very simple terms, TSMC is a contract manufacturer, so the biggest chip names go to TSMC and say, here are our very special chips, make them for us, please. That brings me to NVIDIA, which reports August 28th, and they are the market right now for AI accelerators. Look ahead to August 28th and what we're kind of expecting, and does TSMC kind of inform what we might get?
I mean, to an extent, yes. I mean, TSMC has a lot of customers. NVIDIA is one of the biggest, but Apple is also a huge customer. Qualcomm is also a huge customer. So it's not a direct linear relationship there. But at the same time, everything we've heard, all of the concerns we've heard about NVIDIA, can it continue this growth run? Nobody is doubting the fundamentals of demand. We've also, as you've seen lots of reports about some problems with some new chips that they've had.
Yes.
But they've come out themselves and said, there's still demand for our old stuff. Don't worry about it.
That was specifically about design or engineering issues around Blackwell, which would be the latest generation accelerator. TSMC is interesting because it's literally concentrated in Taiwan, a lot of the activity. But the story here in the United States has been the flow of public money from the CHIPS Act, or government money, to onshore our industry. And there's a piece on the Bloomberg terminal by Mackenzie Hawkins about how now, present day, much of that money's been allocated from the CHIPS Act. What are the numbers behind that, and what's the impact been?
Yeah, I mean, the key point that she makes in her story is the hard work has been done, which is like, hey, we're going to give you this, and we're going to give you this, but nothing has actually, no checks have been mailed, right? This is all promissory, right? And as a US taxpayer, like we both are, that's actually a smart thing, because you want to see these things built and in operation before you actually pay for them, right? This is, a very complex industry, and it's very brutal economically, as we've seen with what's happening at Intel. So you want to make sure that these things actually get built, the equipment goes in, and then the money gets distributed.
As you've educated our audience on for quite a while now, it takes a lot of time to build manufacturing capacity for chips as well. Bloomberg's Ian King here in San Francisco. Thank you. Let's get back to that story about Paramount that we alluded to at the top. Actually, an interesting or positive reaction in the shares. It is a write-down of $6 billion on the legacy cable TV networks, very similar to the news this week that we got from Warner Brothers Discovery. There are some points of distinction with Paramount in terms of the properties, and some other news in there as well. Bloomberg's Hannah Miller is back in New York City. So Paramount, the numbers on the write-down, the story behind the write-down specific to Paramount, what's going on?
Yeah, so it's very similar to Warner Brothers Discovery, where they're writing down the value of their traditional TV networks. And this is after, the streaming wars have broken out. They've taken to reevaluating their cable television as streaming continues to grow more and more popular. What's different here is that with Paramount, you have the backdrop of its deal with Skydance. That is expected to finalize in the first half of 2025. There's still a 45-day period where, people can submit competing offers, but there is a lot of bullishness around Paramount because of this pending deal.
I'm reading through your story on Paramount. And by the way, Hannah Miller, pretty new to this beat. How busy have you been in those first few weeks of covering the media industry? But Paramount, part of the story is cost reduction and cost cuts as well. Is that directly related to the write-down, or is that a different story?
So before we learned about this write-down, there's this whole $500 million cost-cutting effort that Paramount has undertaken. And then Skydance has also identified $2 billion worth of cost efficiencies. So all of this has played into that. They're working to tighten the belt. Another big piece of news coming out of the earnings call yesterday was that there are layoffs coming, that 15% of the U.S. workforce is going to be cut before the end of this year. So there's a lot going on with Paramount as it prepares to finalize this deal with Skydance.
Hannah, I think I said this to you in the show 24 hours ago, but I always try to find the technology story within this. And what's common between those two names is the pain in the legacy TV network side is because of the move to streaming. But actually, Paramount's streaming business, just based on the growth numbers, it seems like they're doing okay.
Yeah, so for Paramount, they actually lost subscribers for their Paramount Plus streaming service during the second quarter, and that was because of a one-time event, the end of this deal in South Korea. They're very optimistic about it otherwise. They have seen revenues increase there. So, despite this setback, like other companies, like Warner Brothers, they're very excited about their streaming service.
I was referring to revenue jumping 13%, but you're exactly right. Paramount Plus service lost 2.8 million subs due to that South Korea you just outlined. Bloomberg's Hannah Miller, happy Friday. Thank you very much for your reporting. Now, coming up on the show, Roger Lee, the creator of layoffs.fyi, a website for tracking tech layoffs, is going to join us to discuss all the job cuts in aggregate that have been announced and his data, and it's timely. Let's take a quick look at shares of Cisco. They had been positive or higher this Friday's session, Cisco, now softer 0.6%. Reuters is reporting that Cisco will lay off thousands of employees in a second round of job cuts this year, and that Cisco could announce those job cuts as early as Wednesday of next week. It did move the shares, and Wednesday of next week, by the way, August 14th, Cisco reports earnings. We'll keep an eye on that story and see if Bloomberg has any advancements on it. Be right back. This is Bloomberg Technology.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Morning from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
We should keep talking about tech jobs and layoffs. Over 126,000 tech employees have been laid off so far in 2024, with companies increasingly citing AI as a reason for the job cuts. I want to bring in Roger Lee, who's the startup founder and the creator of layoffs.fyi. It's a platform that's dedicated to tracking tech layoffs since the COVID-19 pandemic in 2020. And you and I were just discussing this during the commercial break. I look at all of the news headlines and the cadence of headlines, probably starting early June through to now, but you've got the data. So summarize the scale of what's happening in the industry right now versus prior years where we saw heavy layoffs as well.
Yeah, that's right. So according to layoffs.fyi, we've tracked now 126,000 tech employees laid off so far in 2024. The good news, that's actually down 42% from the same time last year. And if you look at the quarter-on-quarter trends, tech layoffs have generally been leveling off since their peak in Q1 of 2023. Of course, it has spiked a little bit in the past couple weeks. The bad news, 2024 is still on pace to have more layoffs than any other year this decade, except for 2023. And of course, it's all a small comfort if you're one of those 126,000 people laid off.
We've just illustrated that point, Roger, with a chart which was showing your
So according to the Commission, the EU is carefully studying details on the Chinese request for World Trade Organization for consultation over the EU tariffs on Chinese electric vehicles, according to WTO rules.
So what your data may or may not track is there a reallocation of resource to new jobs if the justification is AI?
That's definitely what we're seeing in a lot of the companies' announcements for the layoffs, that tech companies are increasingly citing AI as the reason. For example, earlier this week, Dell cut thousands of employees as part of a sales team reorg that included creating a new team focused on AI sales. And then earlier this year, Intuit laid off 1,800 employees and cited that they're doing so they can invest and make more hires to help build AI into its tax prep software. And it is definitely an allocation of resources. Building AI is expensive. And according to salary tracker comprehensive.io, a senior AI engineer in the Bay Area earns $208,000 per year just in base salary. And that's 16% more than a non-AI engineer and doesn't even include stock. So if you include stock options, equity, that pay package can total easily $500,000 to $1 million. Not to mention all the costs involved in infrastructure and hardware for building AI. So, with the economic environment still tight, companies are finding that the only way to increase investment in AI is to cut costs elsewhere, and hence all the layoffs that we've been seeing.
Yeah, as Bloomberg Technology producer Marguerite Gallerini just reflected on in our team chat, maybe we're in the wrong line of work because it's lucrative if you are a computer scientist or software engineer in that space. There's a point you made a minute ago about 2024. We are in early August, and so let's try and extrapolate out. I look at the number of companies, for example, rather than the jobs in aggregate that are making these announcements. Have you a sense in the direction of travel for the remainder of the year?
Yeah, typically what we see is that Q1 and Q4 tend to be the biggest quarters for layoffs. That's often because companies do their annual budgeting around the end of year, which leads to those layoffs. Whereas the middle of the year, summer period that we're in right now, actually tends to be slower in terms of layoffs. Obviously, there's some notable exceptions that you see on the screen here. So unfortunately, I would expect that tech layoffs may pick up again as we head towards the end of the year and early next year, as companies take stock of their year, forecast into next year, do their annual budgeting, and decide whether they have the right team to move forward.
So let's do something else and do this in aggregate. You started tracking this data at the early days of the pandemic. How does this 4-year period or so compare to history? I think about the dot-com bubble, the global financial crisis. Are there ways to compare and contrast, Roger?
Yeah, it's tough to say. Layoffs at FYI, we started in 2020, so don't have the numbers from those two time periods. Although I will say the scale of the tech industry is just so much bigger than during the dot-com era or even the global financial crisis. So in aggregate numbers, I believe that this current period of layoffs is going to be the most that we've ever seen in the tech industry, just because the scale of the tech industry and the number of people working in this industry is so much higher now than in previous years.
Roger Lee, creator of Layoffs.fyi, thank you for your analysis and sharing your data with us. The chart depiction in particular really helps to illustrate what's happening in this industry. We're also going to look at shares really quickly of Akamai. We're going to be having a conversation up next with the CEO, but in the cyberspace, this is a DDoS specialist. You see the stock off session highs, but up almost 10%. A good quarter, but the question that the analysts and the street has is, this is a company that's maybe inconsistent in the number of quarters it strings together. Conversation coming up with Tom Layton, who is the CEO of Akamai. Maybe he'll push back on that, what the street's view of his company. We'll see. This is Bloomberg Technology.
So according to the Wall Street Journal, Iran is better positioned to launch nuclear weapons programs, according to the new US intelligence assessments, again cited by the Wall Street Journal.
about this case, the more it reads like a Hollywood script. The nature of the killing, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's time for Talking Tech, and in the news, the owner of the company behind Temu, Colin Huang, has become China's richest person, amassing a fortune of $48.6 billion US. That's according to the Bloomberg Billionaires Index. Huang's rise has been fueled by China's changing shopping habits and expansion outside of the region with its Temu brand. Plus, Amazon inks an e-commerce deal with TikTok and Pinterest. Users can now link their profile from the social media platforms to their Amazon accounts, allowing customers to buy products directly from ads. This as social shopping becomes more popular here in the United States. And Turkey's Instagram ban hits female entrepreneurs. Orders dried up from female-led businesses who relied on the popular social media platform to drive sales. Turkey abruptly blocked access to Instagram on August 2nd without explaining why. That was a very e-commerce themed and focused selection of news stories out there today. The earnings story also continues, and we continue to look at cybersecurity and Akamai. The company reported earnings after the closing bell Thursday. Co-founder and CEO Tom Layton joins us now for more. There are loads of words and adjectives and praise used by the sell side, Tom. A clean print, strong quarter, growth. But what there's less discussion of is why. What were the specific factors in the quarter that put Akamai up front?
Well, we have several market-leading products in security, obviously very important today given the large number of damaging attacks, ransomware, data exfiltration, and our enterprise compute business doing very well. We talked about just really getting started in that aspect of the business this year, and now we think we'll exit the year at $100 million a year annual run rate in revenue, with a lot of exciting potential for the future. And I think those are great proof points that investors are now seeing.
On the enterprise side, I find that very interesting. Is it demonstrative of broad strength in your client base, those industries' sort of willingness to spend, or is there something specific that Akamai is doing that allows you to sort of outperform in a difficult environment?
Well, security is important for every major enterprise, even in tough economic times, which we're seeing some of now. And we have the market-leading products, and the major enterprises really need them to be safe. And in compute, I think we have a very compelling value proposition. We can provide better performance at a much lower price point. And when you can do that and help a major enterprise save money, well, this is a good time to be able to have that happen.
Tom, strength in the areas you outlined, compute security, and then a little weakness in CDN. I would like to talk about what's happening in your industry overall. I think we start with CrowdStrike, endpoint specialist, you DDoS, but what was that week and situation like for Akamai? Was there any tangible positive read-through for you, or any way that you capitalized on what happened?
Well, we don't use that software ourselves, so there was no impact to Akamai, and we helped our customers, where we could, but that was in an area where we don't really do business. I think there were a lot of learnings for the industry as a whole. First, it really is clear you just can't be doing updates all at once everywhere in the world. Most of the time that's okay, but eventually you're going to have an unintended consequence. And if you update the entire world at one time, you got a disaster. That's a lesson we learned at Akamai pretty painfully about 20 years ago. And ever since then, we phase our updates after you've been through QA and you're confident. You still just go one stage at a time. So in case there's something that was unanticipated, you catch it before you cause a problem. I think also there's a much better understanding that reliability matters, and it takes a lot of investment. But you see what happens when you have something like this. I think enterprises will pay a lot more attention to reliability going forward.
I hear you on that. I'm not a cyber expert by any means, and I know that a lot of CIOs, cyber managers, CISOs watch this program. And for them, top of mind is a sort of academic debate. Agent versus agentless delivery or security of that, delivery of security. Do you see, though, away from the academic debate on the best security systems, action? Your enterprise customers saw the news cycle and picked up the phone and said, we are changing how we do cyber.
No, they were just trying to get out of the disaster, I think. I think going forward, there'll be a time of reflection into how do you prevent this from happening? How do you keep a vendor from, having this consequence? And it's not just a situation of having multiple vendors, because that might even increase the problem. Because if any one of them has a big issue, you got a problem. But really selecting vendors who put the extra effort and investment into making sure things stay reliable as possible.
Tom, I guess closer to home for you, a higher profile DDoS attack on Azure in June. What did you make of that, and Microsoft's handling it, and how did it impact you?
DDoS attacks are probably the oldest kinds of cyber attacks out there. They go back more than 20 years as well. That's an area where we have leading services to help defend customers. In fact, just last week, we saw one of the top 10 DDoS attacks of all time coming out of the Middle East. With the war there, we're able to defend a very important financial enterprise from that kind of an attack. So even though it's been around a long time, we are still seeing some very large DDoS attacks, and it's important for enterprises to have state-of-the-art defenses, even today.
DDoS. Tom Layton, CEO of Akamai. It's great to have you back on Bloomberg Technology on your strong quarter, but also I appreciate discussing news of late. Now, coming up on the show, we're going to talk about how some of the world's in tech think about Kamala Harris's campaign with Tech for Kamala co-founder Shannon Nash, and also Matt Mayen, the mayor of San Jose. That conversation is coming up next. Cue the beautiful pictures. Expedia, 8.6%. Strong quarter, positive discussion about the summer months. Different to what we heard from Airbnb. An interesting one to track. This is Bloomberg Technology.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
You can watch the full story of that at Bloomberg.com, and some of the recent guests here on Bloomberg Technology have also been weighing in on the election and Kamala Harris. Listen to this.
There's going to be huge amounts of money that come in on both sides.
I think there are a lot of people like myself who are really enthusiastic and excited about what the Kamala Harris campaign stands for.
She's been a longtime supporter of the tech industry.
She will do very well in the debate, and she's vibrant. She's all over high energy.
She's from the Bay Area. She understands technology. She understands innovation.
She shares a lot of values that many of us in the tech industry have, particularly with regard to immigration and ensuring that we are continuing to drive innovation in this country.
Let's keep the conversation going with Tech for Kamala, a grassroots group of about 1,200 tech workers that just came out in support of the Democratic candidate. Tech for Kamala co-founder, former Wing CFO Shannon Nash, joins us now alongside the mayor of San Jose, Matt Mayen. And Shannon, good morning. Welcome back to Bloomberg Technology. Those points made in those sound bites and the backing that this new organization is giving actually are the same points that many Silicon Valley voices, venture capitalists in particular, made in backing of J.D. Vance. And I just want to point that out because we've sort of had equal coverage here on the program. But what compelled you in the first instance to be a part of this movement, and what is it that you see in Kamala Harris as being the right president for the technology industry?
Yeah, I'll start really quick with that. I think what we've had is a few people with big microphones, if you will, to be able to talk about their support of Trump and Vance. Why we founded Tech for Kamala was to give voice to the over 7 million tech workers, people who work every day at some of the most well-known tech companies, VCs, founders, operators, engineers, marketers, you name it, and all the industries that are related to tech, to give voice to other people who actually feel completely different and, in fact, are supporting Kamala Harris for all of the work that she has already done in supporting things like responsible AI, STEM education, just being a real innovative leader. So that is why we founded the organization. And I got to tell you, Ed, within like a week, we had over 1,200 people who wanted to jump on the bandwagon and also announce their support. So, it's one vote for one person. Whether you have a lot of money or a big microphone, we still all get one vote. And so this movement is aiming to give voice to the millions of people who have one vote and want to make sure that their vote is heard.
Mayor Mahan, your city, San Jose, is just so closely and intimately linked to the technology industry as well. You come at this, I guess, from the political perspective, but why do you think that the technology industry is an important voice in backing your preferred candidate?
Well, Ed, before I was mayor of San Jose, which is the capital of Silicon Valley with nearly 1 million residents, really the hometown for tech's workforce and home to many leading technology companies like Adobe, Zoom, Cisco, PayPal, and on. I was in the tech sector myself. In fact, I first met Kamala Harris about a decade ago at Airbnb, which was just down the street from a startup that I was involved in founding and leading. And I was very impressed with her. She came in sharing her work on public safety, which continues to be top of mind for all of us, and she has great experience there. But she also engaged with a number of us who were tech entrepreneurs and founders around innovation topics. She understood the importance of having a diverse workforce and supporting immigration, intellectual property, and the kinds of infrastructure investments that we need, and common sense approach to regulation. So, really excited that she's the top of the ticket.
Shannon, the mayor makes an interesting point, which is policy, specific policy. When it comes to technology, antitrust, artificial intelligence, I think a lot of people are asking questions. Are there specific ways that Vice President Harris will be different from President Biden's administration on the policy side as it relates to tech?
Yeah, look, I think that she's coming out with a lot of her policies. As you know, she's got 90 days or less, right, in terms of making her voice heard. What I will say to you is that we believe in an administration that continues some of the things that President Biden was working on. I think that she will also bring a fresh perspective. She's from here. She was an attorney general. She has spent a lot of time, as Matt has said, really listening to, what would be innovative for tech. And so I think that we're going to see a lot of policies and things that are really helpful for the tech industry, but also that are inclusive. And I think that's really important to point out about, something that I think a lot of people in tech would like to see.
Mayor Mahan, local issues. Our guests in that soundbite and Shannon just now reflect on Kamala Harris being from the Bay. And outside of technology, there are issues actually statewide, but the clearing of encampments or encampment sweeps, for example, following the SCOTUS grants pass decision. It's an interesting case study. How do you feel that issue will be addressed by the Harris campaign? And how central as an issue do you think it will be in a presidential election at large?
Look, I want a partner in the White House who is not going to use Silicon Valley or California more broadly merely as a punching bag. I want a partner who is pragmatic, who understands our region, who's going to help us deal with the very real challenges we face. You mentioned homelessness, which is an area where we are getting more pragmatic. San Jose saw a 15% reduction last year. We need a partner in Washington who's going to help fund innovative solutions. Same goes for public safety. That's an area where I appreciate that Kamala Harris has been a pragmatic centrist, and I think that's the right approaches.
May I just jump in and ask, from the Trump-Vance perspective, the messaging of their campaign is that Kamala Harris has been responsible for what they see as being big issues with Bay Area and California cities. Your city is under the microscope to that extent. Are you worried about that message resonating from the Trump-Vance campaign?
No, I'm not, because I think Kamala Harris has a record that stands on its own, and she can speak to her policy positions, which it's kind of ironic. She gets attacked from both sides for being too tough on crime or being associated with what some perceive as California's crime problem. I think she's right down the middle, and that's exactly where I am. Somebody who understands there has to be consequences for committing crime, but we also should invest in rehabilitation and support those with addiction and helping them get treatment. So I think she's got the right pragmatic approach, and we need that kind of partner in Washington as we navigate some very real challenges that our state faces.
Shannon, I want to finally go back to the idea that we talked about at the start, that many came on this program and said, J.D. Vance understands entrepreneurs. He has been a venture capitalist, whether you see that as a positive or otherwise. They see him as being supportive of technology because of his direct industry experience. What would your answer to that be? And do you see the same level of support for entrepreneurship from Kamala Harris?
I think that Kamala Harris, actually, I see more support, quite frankly, from Kamala Harris for entrepreneurship. I think that she's shown that already, just by the simple fact that, you've reported on how quickly so many people have mobilized. It hasn't even been 2 weeks, right? In terms of supporting her and supporting this ticket. I think her VP pick is also really impressive. And so what I would say to you is, it's one thing to have people come on this show with big microphones. It's another thing to listen to the people, the 7 million people that are in tech. Listen to what they're interested in, what they're interested in for their future, for their families, who in the White House will most represent them. And I think that clear choice is Kamala Harris.
Tech for Kamala co-founder and former Wing CFO Shannon Nash and San Jose Mayor Matt Mayen. Thank you both. Okay, I want to go back to markets and look very quickly at what's going on. As a reminder, it's kind of a big moment for the NASDAQ 100. On a 5-day basis, we are basically flat, completely flat, as you can see on your screen. But if the index drops on a weekly basis, that will be 5 straight weeks of declines, the worst run of weekly declines going back to May of 2022. If we end in positive territory by more than about 0.2% on the week, then that would snap 4 straight weeks of declines, and I guess the narrative would be a little bit different. Earnings a big factor. Nvidia isn't until August 28th. That's kind of where we're looking. Bitcoin check out as well. Early in the week, when we had that big financial market pressure on Monday, Bitcoin was nearer to $50,000. It's now nearer to 60 or just above $60,000 per token. But you can see it's kind of traded in an interesting sideways pattern throughout the week. And it's becoming part of the discussion around the election that we just had. Coming up on the show, we're going to be joined by Alexandra Burby, get the private markets take, investor at Sound Ventures, for her investing thesis on how to approach AI from the VC perspective. This is Bloomberg Technology.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion. I think this is also how I grew up, making your own clothes and making something that's very special and very unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something very special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies don't make them profitable and the credit quality is good.
Nobody covers business like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Okay, it's time for VC Spotlight, and today we're taking a look at Sound Ventures. It's an early-stage VC firm founded by Ashton Kutcher and Guy Asiri, which is invested in companies like Airbnb, Spotify, OpenAI, and more. The firm currently has over $1 billion in assets, and Sound Ventures investor Alexandra Burby joins us now, having recently joined the firm herself. It's good to have you here in San Francisco in person.